Welcome to my 6 hours completely free option trading for beginners course updated for 2025. Yes, 6+ hours, and this time I'm going to add even more live trading examples and all the secrets to scaling my portfolio to over $4 million in 2025. Because I noticed that nothing on YouTube right now goes into detail enough and explains things simply so literally anybody could understand. Here's a full list of timestamps for everything I'll be covering in this course, as well as you can find them in the YouTube play bar. I could have easily charged thousands of dollars for this, but for you guys, it's 100% free. And this full course is specifically designed to take you from a complete beginner, even if you don't know a thing about option trading, to a confident, intermediate, and even advanced trader by the end of this course that's equipped with the knowledge to create safe, consistent, and completely passive income so you can retire early with options. Because that's exactly what I achieved many years ago. Yes, it takes years to actually scale up a portfolio. I'm not going to try to sell you any fake dream. This definitely won't happen overnight, but it's worth watching this free course all the way through because option trading is something that you can do on the side. It only takes 1 hour per week to scale a safe, consistent, passive income. I have over 11 years of experience now. I started at 19 years old with just $2,000, and at the time of recording this video, my portfolio is $4.3 million. Last month, I made about $250,000, $243,664 to be exact. Options has allowed me to retire well before the age of 30 and travel the world full time. But I don't say this stuff to brag. I say this just that you understand that you can absolutely do the same thing for yourself and live a life of freedom and work from your computer. So let's get into it. All right, let's talk about what an option actually is. Think of it like this. Most people know how stocks work, right? You buy shares of a company. If the price of the stock goes up, you can sell it and make a profit. Pretty simple. But options, they're a little different. Stocks come in shares, and by owning a share, you just own a really, really small portion of the company. Whereas with an option, they come in the form of contracts, not shares. And one of those contracts controls 100 shares of whatever stock that you own. So why 100? Well, there's not really any particular reason, but all you need to know is that one contract equals 100 shares of any stock. Two contract controls 200 shares, and three controls 300, and so on. I hope you're taking notes because that's an important thing to remember. Now, this is just one piece of the puzzle. It's all going to come together in the next few minutes for you, and we're going to be stacking and learning and building your foundation to the advanced level by the end of this course. So an option contract gives you the right, but not the obligation to buy or sell a stock at a specific price on or before a certain date. So you have a choice. You have the right to buy or sell a stock at a specific price, but you don't have to. You don't have the obligation to. Let me break it down so it really makes sense for you. Imagine this. You find a house that you really like. It's perfect. It has a nice open kitchen, a spacious backyard. It has everything that you're looking for. Now, the seller of the house agrees to sell it to you for $300,000, but you're not ready to buy it just yet. Maybe you need some time to figure things out, get your finances in order, talk it over, or whatever the case may be. So instead of committing to buying a house right now, you pay the seller $5,000 to lock in the price of $300,000 for the next 1 year. You say, anytime I can buy this house for the next 1 year, let me think about it. Let me get my stuff together. No one else can buy this house except for me. I'll give you $5,000. That $5,000 is kind of like a reservation fee, or what we'll call later the premium. Okay, because that's what it's called in the world of option trading. You're essentially paying for the right to buy the house at $300,000 within the next 1 year. Now, here's the fun part. Let's say in 2 months, the value of the house shoots up to $350,000. Wow, it shot up $50,000 in just 2 months. That's crazy, right? Well, there's even better news than that. Because you have paid $5,000 to reserve the right to buy that house for $300,000, and it's now $350,000, that $50,000 is yours when you decide to buy the house. The house still is worth $350K. So because you locked in that price for $300,000, you now actually have a gain of $50,000, $50,000 more dollars than you had. So if you were to buy it immediately for $300,000 and sell it immediately after the market value of $350,000, that $50,000 would be yours. You would pocket that in your pocket, and that $50,000 will be gained right there minus the $5,000 that you paid to lock it in. So on the flip side, if the house drops $250,000, you say, hey, It's fine. I only give you 5,000. I don't want to buy for 300,000 anymore. It doesn't make sense for me. So remember, you have the right, but not the obligation to buy that house. And that's the same way an option works, a call option to be specific. You don't have to buy it. That wouldn't make any sense. You can just walk away. And the only thing that you lose is the 5,000 that you paid upfront. That's it. Nothing else. They're about flexibility. You're not committing to buy or sell anything right away, but you're paying for the option to do so if that makes sense for you to do so later on. So compare this to if you were just to buy regular stock, right? You would have had to pay $300,000 for that house immediately. And if the value goes up, that's great, but you still have to have the $300,000 right away. But the option trader is actually still better in the situation because he only had to pay $5,000 to get the same benefit of $50,000. So the investment that he made is really small, and the results that he got, the reward is huge because he doesn't actually have to buy the house. He can actually sell the rights to someone else. So you see, you can flip $5,000 into $50,000 without even having to own anything. You can just trade the option itself, and the option can rise in tremendous value. Whereas if the house value goes down, okay, it's really bad if you're a stock investor. The option trader loses a bet of $5,000, but the person buying the house will lose a lot more value if it goes down $50,000. So you see, an option is a very cheap way to make a bet on something either going up or going down. So a stock investor has to put in a lot into the stock. The option investor only has to put in a very small fraction to make a really big move if the asset moves in the direction that the investor chooses. Stocks are great, and you can see them as a combination with option trading. Option trading and stocks go together. They play a very key role because an option is trading an underlying stock, but only trading stocks is like playing checkers, whereas option trading, I like to call it more like chess. Now, here's where it gets very interesting. Every option trade involved has two sides, the buyer of the contract and the seller of the contract. Let me explain both sides so you really understand what's going on. When you're the buyer of an option, you're the one paying upfront cost, just like paying the $5,000 for the house as an example. In exchange, you get the right to buy or sell the stock at a specific price. You're betting the stock price is going to move in a way that benefits you. The seller, on the other hand, is on the opposite side of the deal. They're the one collecting the money, the premium that you pay to make a bet. But here's the catch. The seller is obligated to fulfill the terms of the contract. If you, the buyer, decide to use your right to exercise the option, then the person that sold that option, they are obligated. But the buyer is not obligated, but the seller is obligated. So while buyers are paying for flexibility, sellers are taking on the risk in exchange for earning that upfront commission or premium, the option premium. But you're going to see later on in this course how I am actually going to teach you how to sell options for income, sell the options to make a consistent passive income that is on a weekly and on a monthly basis. I'll show you how a seller can also minimize the risk to almost become like a casino, a machine that generates consistent cash flow. I want to show you how to gain an edge in the market so you can pile up your cash, grow your net worth, and have more monthly and weekly cash flow coming in from selling options. But in this course, I'll be teaching you everything from buying to selling and all the strategies with many examples. So let me give you a quick example so this makes sense. Let's say that you're buying a call option on Apple stock. Don't worry, I'll explain what a call option is in just a second. But let's say Apple is trading at $220 per share and your betting is going to go higher. You pay $500 for the contract, which gives you the right to buy Apple stock at a specific price within a specific certain time frame. If the stock price goes up, you can exercise your option and make a profit. If the stock price doesn't move or even drops, you lose the $500 that you paid and the seller keeps it as their profit. That's how that relationship between the buyer and the seller works in options trading. So now that you understand the basics, what options are and how they work, let's go in a little bit deeper. There are two main types of options. There's calls and there's puts. These are the foundation of everything in option trading, so it's important for you to understand them. A call option is basically the right to buy a stock at a specific price before the option expires. Think of it as a bet that the stock price is going to go up. For example, if you think Tesla stock is going to rise, you buy a call option that lets you lock in a lower price now so you can benefit when the stock eventually goes up, climbs, and goes up in price. On the other hand, a put option is the right to sell a stock at a specific price before the option expires. This is more like a bet the stock price is going to go down. For instance, if you think Nvidia stock is going to drop, you would buy a put option that lets you lock in a higher price to sell it later, even if the stock's market value completely plummets. The stock value goes down to very low prices, you will actually benefit when you're buying a put option. So a put option helps you make money even when the market goes down. That's the whole point of a put option. So you can make money with put options when the market goes down, and you can make money with call options if the market goes up. Here's an easy way to remember it. With a call option, you're saying, I want to call this stock higher, meaning you think the price will go up. With a put option, you're saying, I want to put the stock to someone else. I want to put this stock lower because you think the price will go down. Simple enough, right? These two types of options, calls and puts, are what we're going to be using with all of our strategies. Option trading, it just calls and puts. These are the only two things that you really need to understand. Now, later on in the course, you will see how I mix them up, different expiration days, and different strategies around these options. There's a lot of versatility in option trading. You can really control the risk, the return. They are so phenomenal as an asset, as a vehicle to building wealth. And I've been absolutely in love with options for the past 11 years. That's why I've got my education in finance, economics, and data analytics. I absolutely love this stuff and I love teaching it. Everything we do from here on out, we built on this foundation of calls and puts. So just to really solidify this in your head, make sure that you write this stuff down in your notes if you can. In a call option, the buyer wants the stock to go up above a certain price, and the seller of a call option wants it to not go up above a certain price. In a put option, the buyer wants it to go below a certain price. The seller of a put option does not want it to go below a certain price. All right, now that you know what options are, the difference between a call and a put, let's take a closer look at how an option contract is structured. Every option contract has a few key parts, and understanding this is absolutely essential if you want to trade successfully. Don't worry, I'm going to break this down step by step so it's super clear. First up is the strike price. This is the price at which you can buy or sell the stock if you decide to exercise the option. And when I say exercise, that's a term for going through with the deal. You're exercising your right as the buyer. Going back to the house example, if you say, yes, I want to purchase this house for $300,000, the $300,000 was the strike price of that example. The strike price is the price that you agree to buy or sell a stock, no matter what the stock is trading for on the market. For a call option, the strike price is the price you can buy the stock at. For a put option, it's the strike price that you can sell the stock at as the buyer. Whether an option is profitable, what we will be calling in the money, depends on the relationship between the strike price and the stock's current price. Let's look at an example with Tesla. If Tesla stock is trading at $420 per share and you have a call option for a $400 strike price, your option is in the money. Why? Because you can buy Tesla at $400 while the stock is currently worth $420, giving you an instant $20 per share gain. On the flip side, if you have a put option with a 40 strike price, that's also in the money because Tesla, you can sell it at 440, but the price is 420. And a put option benefits when the stock's price is below your strike price. See how that works? But if the stock price doesn't reach the strike price, the option is considered out of the money. For example, if Tesla is trading at $420 and you have a call option with a $450 strike price, it's out of the money because you'd have to pay more to buy the stock than it's actually worth. It wouldn't make any sense. So there are more terms for you to write down, and these terms have very different meanings depending on if it's a call or if it's a put option. For a call option, if the stock goes above the strike price, it is considered in the money. If the stock goes below the strike price, it is considered out of the money. For a put option, it's inversed. If the stock goes above the strike price, it's considered out of the money. If the stock goes below the strike price, it's considered in the money. And for both calls and puts, if the stock is right at the strike price, it's considered at the money. Rewind that if you need to, and make sure that you fully understand it, because now we're going to move on to the next term. Let's talk about expiration date. This is another key part of an option contract. It's exactly what it sounds like. It's the deadline for deciding whether or not you're going to use the option. After this date, the option expires and becomes completely worthless if you haven't used it and if you haven't sold it. Remember, in the definition of an option, it says that you have the right, but not the obligation to exercise it by a certain date. That certain date is called the expiration date, which is what you personally get to choose. Here's why the expiration date matters so much. Options lose value over time, especially as they get closer to expiration date. This is something called time decay. Think of it like this. An option with 6 months until expiration has way more potential for the stock to move in your favor compared to an option that is going to expire in just a week. If you were to buy a call option, you would prefer a longer call option with all things being even. Imagine right now I gave you the right to buy Nvidia stock for $100 per share in the next week or the next 10 years. You would probably say, I would like the option that's expiring in 10 years, please. Because of that extra time, this 6-month option is going to cost you more to buy. That option is going to have a higher premium. But as time goes by, the value of the option starts to drop, sometimes slowly at first, and then much faster as it gets closer to expiration. This is why it's so important to pick an expiration date that matches your trading goals. Options lose value over time, like a carton of milk. It goes bad and it goes expired, and you can no longer drink that milk. Fresh and valuable at first, but every single day that passes, it gets closer and closer to becoming, expired. So if you wait too long, it's completely worthless. Nobody wants expired milk, and nobody wants an expired option. Which is worth more to you, a carton of milk that expires in a week or two, or a carton of milk that expires tomorrow? That's how you need to think about options as well. The more time it has, the more valuable it is. But as you'll learn later on, it's not just that easy, because the further out an expiration date is, the more expensive the option is. So there is inherently a trade-off between time and money. Let's go back to Tesla for a second. Imagine Tesla is trading at $420 and you're buying a call option with a strike price of $440. If the expiration date is 30 days away, the option might cost you $5 per share or $500 total because each option is 100 shares. But if the expiration date is only 2 days away, then it might only cost you $2 per share or $200 for the contract. Why is this? It's because the stock has way less time to reach the strike price of $440, so the option is less valuable. Let's pause there for a second, because that's going to be very important for you to remember. A $5 premium, when you look at an option chain, which we will look at very soon, when it says 5, it really means 500, since it's quoting you the price per share, but an option contract is 100 shares. So whenever you see 5, it's 500. If you see 7, it's really 700. So when I say I sell an option for 7, I really mean I'm selling it for $700 per contract. So that's how you should look at an option chain when we look at that lit. So the same thing with the strike price. For a 15 strike price for one option contract, 15 is a per share price. It means if you were to exercise the 15 strike, you would be purchasing $1,500 worth of that stock. Again, I know this might be a lot, so just make sure that you're writing this down. There's no need to memorize this stuff. This stuff will come naturally to you over time. So watch this part again if you need to. And whatever you need to do, don't worry about asking questions in the comment section below. I will take a look at the comments here. You can also look at my description. I do have a full program. I do coaching as well, so you can check out the first link if you had any questions right now or wanted to learn more about my programs. So let's talk about the key takeaway here, which is that an expiration date isn't just a deadline. It also affects the price of an option. Options with more time until expiration are more expensive because they give the stock more time to move in your favor, but they also lose value more slowly at first. Short-term options, on the other hand, are cheaper upfront, but they lose value very quickly because of time decay. If the stock doesn't move quickly enough, you can lose money even if your prediction was right, just because you ran out of time. Now, let's move on to the premium. This is the juicy premium. This is where the money's at. The premium is the price that you pay to buy the option. It's the $5,000 that you paid in the house example. It's essentially the cost of the contract and is determined by a few different factors, like the stock's current price, the strike price, the time left until expiration, and something called implied volatility, which is what we'll be getting to in a little bit. For now, just think of the premium as the upfront cost that you paid to control a stock without actually having to buy it. Here's an example. Say that you have Nvidia stock trading at $140 per share and you buy a call option with a strike price of 130, the premium for this option is $15 per share, which means it's going to cost you a total of $1,500 for the contract. That $1,500 is your total investment in the trade. It's also the maximum amount you have to lose no matter what happens. You can't lose more than what you pay for an option. Now, if Nvidia's stock price doesn't move or drops below $130 by the time the option expires, you will lose $1,500 that you paid. But if Nvidia's stock price rises above $130, the value of an option will increase, and you can either sell that option anytime that you want for a profit, or you may also exercise it or continue to hold it and make more profits. Now, here's where things get a little deeper. The premium that you pay for an option is actually made up of two different parts: intrinsic value and extrinsic value. Intrinsic value is the real, tangible value of the option based on the stock's current price and the strike price. Let's say that Nvidia is trading at $140. You have a call option with a $130 strike price. The option has a $10 intrinsic value because it's $10 in the money. Nvidia is at 130, but if that option was available on real option trading platforms, the premium would be more than $10 because there's still something else that is also valuable. That is time. And time and volatility and other factors are extrinsic value. Everything that is not intrinsic is extrinsic value. So if an option's in the money by $5 but it's worth $7, that means it has an extrinsic value of $2. Time is money, and time has a value. This is called extrinsic value. Extrinsic value is the part of the premium that represents the potential for the option to gain value in the future. This includes things like time value, how much time is left until expiration, and implied volatility, which measures how much the stock is expected to move. For example, if Nvidia is at $120 right now, and you buy a call option on Nvidia with a $130 strike price for $5, all $5 is entirely extrinsic value because the option isn't in the money at all. It's not really even that close to in the money, but the option has value. And this value is because of time and volatility. It may go into the money. It may happen, but right now it has not happened yet because the stock has not reached the strike price. So if it does reach, good. And if it doesn't, that's bad if you're an option buyer. But the whole entire value at this point of time will be extrinsic value. None of it is intrinsic. Keep in mind, for a put option, a lot of this is inversed. It's the complete opposite. As time goes by, the extrinsic value of an option starts to decrease because the stock has less time, aka less potential to reach the strike price. This is why time decay is such a big deal for option traders. The closer you get to the expiration date, the faster the extrinsic value decreases and the less your option is worth. This is something you'll want to keep in mind every time that you trade options. Now, let's talk about the underlying asset. Every option is tied to something called an underlying asset, which is just the stock or the ETF or even crypto the option is based on. But I pretty much only deal with stock options, and I think you should too because it's the much more simpler and much safer than all other asset trading vehicles. For example, if you're trading an option on Tesla and the underlying asset is Tesla stock, if you're trading an option on the SPY, which the ETF, is tracking the S&P 500, then their underlying asset is the SPY ETF. The price of the underlying asset directly impacts the value of the option. In fact, the option is just a derivative. They call it a derivative. That means it's derived from the underlying stock. So as the underlying stock changes, it has an impact on the option. We'll talk about that behavior and that entire process later on when we cover the Greeks and more about how the Greeks work with option trading. If the stock price moves in your favor, the option becomes more valuable. If the stock price moves against you, the option becomes less valuable and it loses value. The type of options you're trading, whether it's a call or a put, also plays a really big role in how the option behaves. Remember, a call option gives you the right to buy a stock at the strike price, and a put option gives you the right to sell a stock at the strike price. If the stock price goes up, a call option increases in value, while a put option decreases in value. If the stock price goes down, put options increase in value, while call options decrease in value. It's really that simple. And once you understand how these pieces fit together, you can start to trade them and start taking advantage and making your own decisions to make income. All right, now that you have a solid understanding of what an option is, who the buyer and the sellers are, and the key components of an option contract, let's bring it all together with a quick summary. Options are contracts that give you the right, but not the obligation, to buy or sell a stock at a specific price before a specific date. The buyer of the option pays a premium for this right, while the seller collects the premium and takes on the obligation to fulfill the contract if the buyer decides to exercise. There are two main types of options: calls, which are bullish, and puts, which are bearish. And every option contract has a few key parts: the strike price, the expiration date, the premium, and the underlying asset. Now that we've laid all the groundwork, we're ready to dive deeper into how these parts work together and how to use them to your advantage. Let's break down how call options and put options work in real world scenarios, and I'll show you exactly when and how to use them. Imagine Palantir, ticker symbol PLTR. It's trading at $100 per share, and you believe the stock price is going to go up. You decide to buy a call option with a strike price of $110 and an expiration date of 30 days from now. Let's say the premium for the option is $5 per share, which means that you're going to be paying $500 for the contract, because again, each option contract represents 100 shares. Here's what happens. If Palantir stock rises above 110 before the option expires, your call option increases in value. Let's say that Palantir stock price climbs to $120. The option now has $10 of extrinsic value per share, the difference between the 120 stock price and the 110 strike price. Since the option represents 100 shares, the total in intrinsic value is $1,000. If you subtract that from 500 premium that you paid, the profit would be $500. Not bad, right? But what if Palantir stock price doesn't rise? Let's say the stock stays at 100 or even drops below, $100, stays below 110. In that case, your call option doesn't have any intrinsic value because you wouldn't buy Palantir at 110 when it's trading for less than that 110 mark, right? So the option expires worthless and you will lose $500 in premium that you paid to purchase that option contract. That risk of buying a call option is a risk, and you can lose the entire premium if the stock does not move in your favor. And that's why in finance, there's a fundamental law of risk and return. And we'll be talking about risk and return and which options make sense to buy, which options don't make sense to buy, when to take profit, when to manage. All of that is coming in this course. I promise you, you are going to be an intermediate, if not advanced trader by the end of it. Now, let's flip things around and look at put options. A put option works in the opposite way of a call option. It gives you the right to sell a stock at a specific price before the option expires. You buy a put option if you believe the strike price is going to go down. Let's use SoFi as an example. SoFi is trading at $15 per share and you believe the stock price is going to drop. You decide to buy a put option with a strike price of $13 and an expiration date of 30 days from now. The premium for this option is $1 per share. So you pay $100 for the contract because one option contract represents 100 shares. Here's what happens if the stock price falls to $11 before the option expires. The option will have $2 of intrinsic value per share. That's the difference between $13 strike price and $11 strike price. Since the option represents 100 shares, the total intrinsic value is going to be $200 after subtracting $100 that you paid for a profit of $100. But the fact of the matter is, it'll actually be worth more because I said before expiration. So if there's still time to expiration, there's not just going to be intrinsic value of $200, but that option is also going to have extrinsic value. So this option that you bought for $1, it may be trading for $2.75, $2.90. And it depends on multiple factors, which we will discuss, but there's intrinsic value and extrinsic value. So if the option is in the money, SoFi stock, fell to $11 per share and you have a 13 put option, you're definitely going to be up, $200 in intrinsic value, but you may also have additional extrinsic value. So that's going to make the option more valuable for you. If SoFi stock price stays above 13 though, the put option won't have any intrinsic value. And if it expires, it'll expire worthless. If there's still some time, that option may be worth something. But as time approaches expiration and the closer it gets to expiration, if it's still out of the money, it's not below the 13 strike price put option that you bought, it's going to approach $0 or worthless. You'll lose the entire $100 that you paid, just like with the call option if the stock does not move in your favor. The key takeaway here is that when you buy options, your risk is limited to premium that you pay, but your potential profit can be much greater. Now, let's take this a step further and talk about how to choose the right strike price and expiration date for your options. These decisions are absolutely critical because they directly impact your risk, your potential profit, and the likelihood that your trade will be successful. When choosing a strike price for a call option, think about how confident you are the stock price will go up. If you're very confident, you might choose a strike price that's slightly out of the money, meaning the stock price hasn't reached the strike price just yet. These options are cheaper because they don't have any intrinsic value yet, but they are a lot riskier because the stock needs to move. It has to move higher for you to make a profit. If it doesn't move higher, you're going to be out of all the money that you paid at expiration. So let's take an example. If Amazon is trading at $204 per share, you might buy a call option with a $270 strike price for $2 per share or $200 for the contract. This is less expensive than an in-the-money option, but the stock needs to rise above 270 for the option to be profitable. On the other hand, if you want a safe trade, you might choose an in-the-money call option. These options are more expensive because they already have intrinsic value, but they're less risky since the stock doesn't need to move much for you to profit. It's already in the money. It already has an intrinsic value. For example, if an Amazon call option that you purchase for 220 strike price, it will be worth, a lot more because the option is already in the money. If Amazon's at 240 and you buy a 220 strike price, you're already starting off with $20 into the money. So that option is definitely going to cost at least $20, most likely more, depending on how much more time is left. The same logic applies to put options. If you believe a stock is going to drop significantly, you might buy an out-of-the-money put option. These are cheaper, but require a larger price move to be profitable. For example, if Nvidia is trading at $120, you might buy a put option with a 110 strike price for $3 per share or $300 for the entire contract amount. If Nvidia stock drops to $100, you'd make a significant profit because the strike price is at 110, stock goes to 100, you are $10 in the money. And if it's $10 in the money, you paid $3 for that contract, you have effectively taken a $3 investment and turned it into a $10 investment. Or you've taken $300, you've turned it into $1,000 with a profit of $700 total. The expiration date is just as important as the strike price. If you choose an expiration date that's too soon, the stock might not have enough time to move in your favor, and you could lose the entire premium. On the other hand, longer expiration dates give you more time for the stock to reach your strike price, but they're also more expensive because they're including more time value. When you're starting out, it's usually a good idea to choose options with at least 30 to 45 days until expiration. This gives you enough time for the trade to play out while minimizing the impact of time decay. If you're trading short-term options, you need to be very precise with your timing because time decay will absolutely work against you and eat into your option premium. If you're trading longer-term options, you have more flexibility because the time decay is very slow on long-term options, giving you more room for the stock to move in your favor. Another factor you'll need to consider is implied volatility, or IV. Implied volatility measures the market's expectation of how much the stock price will move in the future. When implied volatility is high, option premiums are more expensive because there are a greater chance of a large price swings. When implied volatility is low, option premiums are cheaper because the market expects less movement. For example, if Nvidia's implied volatility increases due to an upcoming earnings report, the premiums for both call and put options will rise because the market expects the stock to make a big move. If you buy an option during a period of high implied volatility, the stock doesn't move as much as expected, the option's value will decrease due to a drop in implied volatility, even if the stock price moves in your favor. This is called the ID crush, and it's something you'll want to be aware of when trading options. This IV crush can be a real game changer, and not in a good way. If you don't plan ahead for it, you can buy really expensive options and lose a ton of money because an IV crush can erode an option's value overnight. Here's how it works. When there's a big event on the horizon, like an earnings report, a product launch, or some major news that could affect a stock, implied volatility tends to go up. This happens because traders expect the stock to make a big move, either up or down. And that uncertainty drives the price of the option. It makes it more valuable and more expensive because uncertainty is a risk. And the person that is selling the option wants to be paid more for that risk. The person buying the option has more opportunity to make money because something big may happen. Okay. So let's say that you're trading options on Apple and the company has earnings reports coming out in just a few days. The implied volatility on Apple options spikes because everyone is anticipating a big move. You decide to buy a call option with a 230 strike price and you pay a premium of $7 per share or $700 for the contract. Now, if Apple stock price shoots up after earnings report, you might make a nice profit. But if the stock barely moves or the move wasn't as big as the market expected, the implied volatility drops immediately after the event, and the drop can crush the value of your option, even if the stock price moved in your favor. That's why it's called IV crush. You paid a premium based on high implied volatility, but once the uncertainty is gone, the option loses a lot of its value very quickly, a snap of the fingers. This is why it's so important to be aware of implied volatility when trading options, especially around events like earnings. If you're buying options, try to avoid doing so when implied volatility is extremely high. Later on, I'll be showing you an example. After I've laid all this groundwork and foundation, we're going to be looking at real examples of implied volatility and how I trade volatility. So for now, instead, look for opportunities when volatility is not too high and not too low. Look for opportunities in the market and start to understand that implied volatility, when it's higher, is better to sell options because it's expensive. When volatility is low, it's better to buy options because options will be trading for cheaper valuations. On the flip side, if you're selling options, high implied volatility is actually a really good thing. You know, when I sat next to a trader on Wall Street and there was a lot of volatility in the market, and I asked him, how does he deal with it? He said, I love it. It's fantastic. Volatility is an opportunity for the option trader. So keep in mind, selling options comes with its own risks, which we'll talk about later. Now that you've got a handle on the option basics and the option contracts, let's change the pace here. And I'm going to screen share on my phone and we're going to explore what trading options looks like so you can see for yourself what it actually looks like a trading platform. All right, guys, let's take a look at my brokerage platform right now. I'll go over how options looks like in my portfolio and stuff like that and things to look out for and calls and puts, what we've talked about so far. So you can see my portfolio is at $4.3 million. The past 1 week, I'm up $61,000. So, this is the passive income approach that I go for that you can also, learn about and coach with me if you're interested in growing a portfolio like this from 5 figures to 6 figures and 6 figures to 7 figures. It does take time. This is not a get rich quick. But here's what a brokerage platform looks like. And here's some options. You can see at Apple, this option is up 21,000. At Google, it's a call option as well. This is a buy. You can see here 9/19 expiration, so September 19 of 2025. We got 10 buys here on Google. I'm up 18,000. Trading a little bit of crypto ETF, IBIT. I got a little bit of PayPal, some Palantir, some Tesla, more Palantir, Snapchat, Nvidia. These are options, okay? These are option positions that I have. Now, if you want to open up an option, for example, let's go to PLTR and let's go over, for example, something like buying a call option. You can see I do have a lot of Palantir, and I've talked about Palantir since IPO, since I've been doing YouTube for 5 years. Here's how it works. You see, if I go to trade and I go to trade options, you'll see here that at the top, there's expiration date. So there's a February 7, there's a March, right? And I can go for July. I can go for January 2026. I can go to January 2027. And for example, let's say that I wanted to buy a call option for January 2027, okay, for a very long time out. Okay, I could buy a call option like this. This will be called a leap option. We'll cover leap options later on in this course, but a leap option is a call option. Okay, we just call them leaps because they're far out. So You can see here how I can go buy, sell, I can go call and put. These are the only 4 actions that you can do in option trading. So I can go to buy, call, and now I can buy a call, like I can click here at the premium. You can see the premium here is $39.80. You guys know that $39.80 is actually going to be, per share. Since each option is 100 shares, if I click into here, you will see that the total cost is $3,975. So if I were to execute this trade, it would cost nearly $4,000, which, is still a good value, because to control 100 shares, a pound here, it would cost, 100 times 108, which would be $10,800. So, you still get a discount when you buy an option. It's still way cheaper than buying stock. So you get a really good deals on buying and call options. So this is what an option chain looks like. There's buy calls, there's sell calls, and there's different expiration dates that you can go through. Now, before we get into anything else, there's a huge twist. Up until now, you've learned that you can make money from options in 2 ways: by exercising the option or by selling the contract and keeping the premium. But here's the thing, almost no one actually exercises their options. That's right, most option traders don't buy contracts with the goal of exercising them. Instead, they make money from something completely different: the fluctuation in the options contract price, aka the premium itself. Let me explain. When you buy an option, whether it's a call or a put, you're not just locking in the right to buy or sell a stock at a set price. You're also buying a contract that changes in value every second that the stock is trading. Just like stocks go up and down in price throughout the day, option contracts also change in price. And that's where most traders actually make money. Here's how it works. Imagine you buy a call option on Apple with a 230 strike price. And at the time that you buy it, the option contract costs $5 per share, or 500 total, since each contract controls 100 shares. If Apple's stock price starts rising, the value of your option will also start increasing. Maybe later that same day, the contract's price jumps to $8 per share. Now, your contract is worth $800. You didn't exercise anything. You didn't buy the stock. You just sell the option contract itself, and you keep the $300 of profit. This is the biggest way that option traders actually make money, by buying contracts when they're cheaper and selling them when they are more expensive. Instead of waiting for expiration and exercising the option, they simply sell the contract before it expires and cash out the difference. Let's go over an example on Tesla. So say that you have a Tesla option. Let's say it's expiring very soon. So February 14, Valentine's Day. Let's say that it's an option that you bought at $350, right? This is actually an option that I recommended not long ago on YouTube. So let's say that you have this option right here. So check it out. Okay, this option has a $350 strike price, right? Has a premium of $26.65. Let's go over 2 scenarios. The first scenario is you exercise this option. So you exercise this call option, right? You now have 100 shares. How much are those 100 shares worth? Well, the current price of Tesla stock is $373.10, okay? So if you were to exercise, your option would be worth, it'd be in the money by $22.35. Pretty good, right? Well, not really, because the option premium is worth $25.65. So what do you prefer? Do you prefer to exercise and have a value that's above $350 of $22? Or do you prefer to trade the option and sell the option for a $25.80 profit? You probably prefer the $25.80 profit than exercising and getting a value of 22. And that's because when you exercise, you get rid of all the extrinsic value. You only have intrinsic value of how much the option's in the money. And since time is money, even an option that expires really short term still has time. So even if I show you an option that expires in 0 days, as I'm recording this video today, okay, even today. So this option is in the money by $22.83. The stock would be, if you exercise, $22.50, but the option is worth $22.70. So even if the option expires in a few hours, it still has 20 cents time value. So would you rather exercise an option for $22.50 or sell the option for $22.70? Probably sell the option for $22.70 because it's $20 more. This is true for every single option. You would never, ever exercise ever in your life, pretty much. There's very rare situations. I cover some of those rare situations outside of this course. They're very rare. So for the most part, You don't have to ever exercise. You don't have to worry about that. Just trade the option itself. Now that you understand this, we can start diving deeper into how options gain and lose value and how you can position yourself to take advantage of these price fluctuations. Let's start talking about actual strategies you can use. The simplest and most common option strategy is a single leg trade. And a single leg is another term that we are using to refer to strategies where you buy or sell a single option, either a call or a put. Now, there are also multi-leg strategies that involve multiple puts, multiple calls, or even combining them together to make super advanced strategies. But obviously, we will get into that much later in the course. Simple leg strategies are super straightforward, easy to understand, and a great starting point for beginners. Let's start with buying call options. Buying a call option is a bullish strategy. Bullish meaning that you think the stock will go up. And it's bullish strategy because you're betting that the stock price is going to go up. If the stock price rises above the strike price before the option expires, you can make a profit. The beauty of buying call options is that your potential profit is unlimited. There's no cap at how high a stock price can go, but your risk is unlimited to the premium that you paid for the option. Let's use American Airlines as an example this time. American Airlines is trading for around $16 per share as I'm making this video. The stock price might go down in the future, but let's just use the current stock price. Let's say that you believe the stock price is going to rise to $20 per share in the next 30 days. That's a huge move. You decide to buy a call option with an 18 strike price and the premium is 0.5 per share or $50 for the contract. If American Airlines stock price rises to $20 per share before the option expires, your call option now has a $2 intrinsic value per share. That's the difference between the $20 stock price and the 18 strike price. Since the option represents 100 shares, the total intrinsic value is $200. After subtracting the $50 premium that you paid, your profit is $150. That's a 300% return on your investment. But what happens if American Airlines stock price doesn't rise above 18? Let's say that the stock stays at 16 or even drops. In that case, your call option doesn't have any intrinsic value and it will expire worthless. You'll lose the $50 premium that you paid, and that's it. That's the most that you can lose when you buy a call option. This limited risk and unlimited profit potential are what make a call option so attractive to many traders. If you were to look at a profit and loss chart for buying a call option, it would be a simple hockey stick shape. The left side of the chart represents when you're losing money, and the right side represents when you're making money. At the very start, when you first buy the call option, your loss is limited to the $50 of premium that you paid. That's why on the chart, the lowest point that you can go is -50, because no matter what happens, you can't lose more than the premium that you paid. Now, let's look at the break-even point. Since you paid 50 for the option, you don't actually start making a profit until the stock price rises above 18.50. Why 18.50? Because that's the strike price plus the premium that you paid. As soon as it's 18.5, that is your break-even. Everything above 18.5, you start profiting. So at 18.75, you're actually going to make 25 cents. You're going to make 25 cents on a premium of 50 cents. So you made about 50% on your money actually. At $19, you have now made a 50 cents on your 50-cent investment for a total of $1. So you turn 50 cents into $1. And that's how you double your money with a call option. Now, I want to talk about at the very start, if you're buying your first call option, if you put up $50, you need to know that your investment is limited to the $50 of premium that you paid. That's why on the chart, the lowest point that you will see is a -$50. You can't lose more. And that's why the bottom of the chart, it won't go lower than -$50 because no matter what happens, you can't lose more than the premium that you paid. Now, let's look at the break-even point a little bit closer. Let's say that you paid $50 for the option. You don't actually start making profit until $18 plus the premium that you paid. So let's say that the premium that you pay is 75 cents. Now you can see how this chart changes. The break even before was 18.50 because of the 50-cent premium. But if the premium is now 75 cents, your new break even is going to be 18.75, as you can see on the chart. Now, let's flip the script to talk about buying put options. Buying a put option is a bearish strategy, meaning that you're betting that the stock price is going to go down. If the stock price falls below the strike price before the option expires, your put option increases in value. Just like a call option, your potential profit can be very significant, but your risk is limited to the premium that you have paid. Going back to the American Airlines example, let's say that American Airlines is trading at $16 per share. And this time, you believe that the stock price is going to drop to $14 per share in the next 45 days. You buy a put option with a 15 strike price and a premium of zero point 0.5 or 50 cents, $50 for the whole entire contract. If American Airlines stock price falls to $14, your put option now has an intrinsic value of $1 per share. That's the difference between the 15 strike price and the $14 stock price. The total intrinsic value is $100. After subtracting the $50 premium that you paid, your profit is $50. But just like with call options, if the stock price doesn't move in your favor, you will lose the premium that you paid. If American Airlines stock price stays above 15, the put option expires worthless and you're out $50. If you were to look at a profit and loss chart for buying a put option, it would be the opposite shape of a call options chart. Instead of sloping to the right, this one slopes down to the left because now you're making money when the stock price goes down. At the very start, when you first buy the put option, your maximum loss is limited to the $50 of premium that you paid. That's why the lowest point on the chart is negative $50 because even if the stock price goes up instead of down, you can't lose more than what you paid. So this chart is going to look very similar to the call option. A put option is just a mirror reflection where a call option benefits as the stock goes up. The put option benefits when the stock goes down. Now, let's take a look at the break-even point. Since you paid $50 for the option, you don't actually start making profit until the stock drops below $14.50. Why $14.50? Because the strike price is 15. You paid 50 cents. So because you benefit when this goes down from 15 down to 14.5, you're just making the difference of the premium. So you're just getting the premium back. But at 14.50 and below, this is your profit zone. This is where you start taking profit. And you can make profit all the way down to $0 per share. If American Airlines goes to 10, you're going to make $4.50. If it goes down to 8, you'll make $6.50 of profit. So if you picture the chart, as you can see, when you start off and you pay money to buy an option, you start off in a negative. You start off with negative $50 and it stays flat until $14.50. And then it starts sloping upwards because you're making money, you're making profits when it goes below $14.50. At this point, you might be thinking, okay, all this sounds cool, but how do I know when to buy a call option or buy a put option? Well, that's a great question. It comes down to your outlook of the stock. If you believe the stock price is going to go up, or if you believe, the stock price will go down. If you believe it'll go up, you buy a call option. If you believe it'll go down, you'll buy a put option. So with that being said, I actually want to show you right now some factors that I look at when I'm trying to determine if a stock is bullish or bearish and by how much and what direction I think the stock will go. So this is a great opportunity for us to go into technical analysis so we understand when should we buy a call option and when should we buy a put option. Alright, let's go over fundamental analysis right now. I'm going to be using two examples. One of them is going to be Palantir, and the other one is going to be NVIDIA. I want to go over this because it's really going to help you understand how to value a company. Technical analysis is important, but fundamental analysis is also incredibly important. So check this out. I'm going to go to the statistics tab here of Yahoo Finance. Again, keeping it free, keeping it simple. This is basically the best way to analyze, aside from reading annual reports, and that's what I do during my Discord calls. I'm going to annual reports, going deeper into the research. But if you're a beginner and you just want to keep it super simple, here is like the lay of the land for fundamental analysis. The first thing you want to look at is the market cap. I mean, how big is the company that you're investing in? Make sure that you have a market cap that is above 10 billion because you don't want to invest in companies that are too low in the market cap. They oftentimes have lots of volatility. They're oftentimes extremely bad for trading options because they don't have liquid options. They don't have much volume. They don't have much open interest. So they're just bad. Make sure that you're always trading a $10 billion company plus. Now, Palantir is a pretty big boy. It's a big company and, they've grown a lot. So check it out. The most important thing I would probably say is PE ratio, but PE ratio can be very confusing. So the PE ratio for the general stock market is probably around, it's usually between like 20s, 25, something like that, right? S&P 500. And you do want to keep your stocks around that range. So if a stock has more than 40 PE ratio, that's, pretty expensive. It's pretty expensive because price earnings is saying the price that you're paying for the earnings that you're getting in the company. So if it's above 40, that's expensive, okay? If it's under 10, that's really, really cheap and that's really amazing. But how come some companies have such huge PE ratios? Well, it's kind of interesting because PE ratio is very important. You want to stick around 30. However, some stocks break those rules. Palantir is a company that breaks that rule, and I need you to understand why it breaks that rule so you can understand price earnings ratio better. So again, price earnings ratio is the price that you pay and the earnings that you get. So if the price is say, $100 and, it's earning $1, the PE ratio will be 100, which is extremely high, right? And Palantir is 654. And a lot of people will say, that's incredibly high. Why would investors pay this? Are they stupid? This is nonsense. This is a company that I don't want to touch. And that's fine. This course isn't telling you like, hey, pick this stock or that stock. I'm not giving you any stock picks. I'm teaching you how to think and so you can make decisions for yourself. That's what this course is all about. So you have all the foundation and then you can make consistent income trading options and learn how to, invest in the stocks that you're trading options on, right? PE ratio 650. The reason why it can be so high is because PE ratios can change drastically. Sales cannot really change that drastically. And that's why we need to talk about PE versus price to sales. The earnings of a company, especially when it has become just recently profitable, can grow a lot, right? So, for example, Amazon, Tesla, a lot of these hyper growth companies had negative earnings. They didn't have any earnings. They were negative. They were losing money. And then all of a sudden, a company like Palantir, let's say that it has $293 billion market cap, it can go from negative earnings to becoming a slightly positive earnings company, right? And the PE ratio will be extremely high. Time, they will become more profitable and their percentage or their margins will go up. Also, they can cut costs at any time, right? So a lot of these companies are spending lots of money, so they artificially have lower earnings and very high prices. And the market knows this, and that's why they're okay paying such a high PE ratio. Because, for example, Palantir, they can, double or even 10x their earnings in a single year. So if they 10x their earnings in a single year, this PE ratio all of a sudden goes from 650 to 65, right? So Palantir is a good example of a company that's getting more expensive because the growth is very fast. And now I want to show you NVIDIA because the reverse has happened with NVIDIA. NVIDIA had a PE ratio that, it was essentially 80. Then, as they continued to grow, and again, earnings have become better and better, despite the price going up, the PE ratio went from 81 to 72 to 68 to 62 to 47 to 38. So you can see here how the PE ratio just within, a bit over 12 months has went down by half. Okay, it has gone down by half. So if you can extrapolate this and say that the company has become half as cheap on PE ratio, then in another year, for example, NVIDIA would be 19. And then another year, it's going to be 9.5. 9.5 is crazy discount. So in just 1 year, if it halves again, you're going to have a deeply discounted stock. And obviously what's going to happen is it's not going to be deeply discounted. It's going to have to adjust. So the price will go up to adjust for the low PE ratio. So the low PE ratio won't even happen because investors won't let it happen because the price will just go up to reflect the value of the company. So for example, if the earnings double, right, this won't go down to 19 because investors will say, hey, I'm still okay buying it at 38 PE ratio. We have a lot of growth ahead and the stock will just double. That's how stocks grow because they have earnings. Investors pay for those earnings. And if the earnings continue to grow and investors are okay paying the same multiple, then it grows in proportion. But yeah, so this is a very interesting way of looking at stocks and understanding PE ratios. If, for example, NVIDIA raises their earnings by double and they double their earnings, but now investors say, well, it's going to have less growth in the future. I'm okay paying a 30 PE ratio. Well, you're still going to get a lot of growth because essentially you have double the earnings, even if the PE ratio goes down by 30%, 30% less of 39 is essentially 30. You still have a lot of growth, right? It won't be 100, you won't double, but you'll still make 70% for example, right? You'll have a 70% rise in the stock price, even if the PE ratio goes down. Okay. That's what's happening with Palantir here. And that's what you need to understand. Now, if you're a little bit confused, you're like, well, how does the PE ratio like work? How do I compare it? Yeah, it can be very confusing. This is why analysts on Wall Street have a full-time job and they're still wrong all the time. So I need you to understand that price to sales will actually be a little bit better if you're trying to analyze technology companies with really, really high PE ratios. And that's because price to sales is different from PE. P is the earnings of the company. Sales is different because the sales, you can't really manipulate that, right? Sales is sales. It's how much you make before all of your expenses. So, I go over a lot more of this within my community and I answer questions like this. And I also go over examples for every trade that I make. Keeping it very basic, I want you to just understand PE and price to sales. And basically that these are the two most important metrics for analyzing a stock fundamentally. Some more things that I personally do is I create valuation models. I create valuation models on price to earnings. I also create cash flow models. I'm looking at the revenue. What is the revenue going to grow to? What is a reasonable PE ratio for the future? Is this future for this company? Is this company, very likely to generate a lot of cash flow, like something like a Walmart? Or is it, more shaky, like a Tesla? Maybe they get autonomous drive. Maybe they don't, right? What scale will it be successful? What are the risks? So these are all very important metrics for valuing a company fundamentally, and fundamental analysis is definitely a very advanced topic. So let's do the technical analysis portion of this course right now. I'm going to be using two different stocks, and I want to show you the key indicators that I use, and I want to keep it super simple and very beginner friendly for you to understand and analyze a stock properly using technical analysis. So check it out. SoFi right now trading for $12.70, and I want to go over the chart and just kind of tell you what has happened with the chart and then how I would analyze this if I wanted to make a decision whether to buy or sell or trade a specific option. So look, SoFi has traded as high as $18 per share. You can kind of see here very logically on the chart, back in January 2025, it reached a high, and that was the highest point in the past 6 months. So I'm looking at a 6-month period, and this is the best time frame to really use. If you go out really far in terms of date, then, that's like really, really old data. And if you use too short term, well, that can also, kind of skew the picture as well. And too short term data is also not as useful. So 6 months is the perfect amount of time to really analyze the charts. And by the way, when I was working at a hedge fund, the quant analyst who was incredibly smart, he was a genius, also said that 6-month time frame was what he used. So yeah, sticking to 6 months, you can see here that SoFi reached the high of $18 per share and then has been basically on a bear trend along with the entire market in 2025. Unfortunately, been a lot of volatility, but you can kind of see here what's going on. It reached the high 18 and then it reached another kind of peak here at about $17 per share. This is really interesting because you can essentially draw a trend line here. So if I were to draw, there's a new version, by the way, of Yahoo Finance. But if you draw from here to here, you can see that it's been very interesting and has actually predicted kind of the downward pressure in the stock. You can see high 18, high 17, and then essentially we just hit another peak at $13 per share. Now, here's the interesting thing. Although this is a bear trend and has been bear trend, at some point you want to see where the stock can find support. You can actually see a pretty nice support here, a double bottom pattern. So a double bottom pattern is basically within a fairly short amount of time, a stock hits a bottom, tries to recover, hits a bottom again, and then investors say, hey, we really think that, this is a bottom. Based on investor behavior and psychology, they think that the stock is low here. And there was heavy selling pressure. You can even see here by the volume, there was just very heavy red days. You can see multiple big red days of selling pressure. So the stock has basically have, pretty good support here. And now we're back on the uptrend. So that's kind of visually what you should be looking for. Aside from the visuals, you can now see that I'm using 3 different indicators. The first one is the Bollinger Band, hands down, the most important indicator that you can ever use in trading, period. Okay. The Bollinger Band essentially looks at what is normal and what is not normal. Okay. What range do we see the stock going? Okay. And the Bollinger Band is based off of statistics and math, some basic statistics and math. I won't go too deep into this course. It'll be a very long explanation. Let me give you this short and simple explanation. This Bollinger Band is using something called the bell curve. A bell curve kind of looks like this. Okay. You'll see it on the screen right now. Okay. And you can see that in the middle of the bell curve, about 68% of the data is within one standard deviation. Okay, what does that mean? Well, if you look here, the Bollinger Band, pretty simply said, it gives you some options. Yahoo Finance will give you a period. Go for 20 days. 20-day period just means like basically 20 trading days, which is like roughly 1 month. And the two standard deviations, this is what I'm explaining to you. Two standard deviations, a two move standard deviation would be about 95% of the data on the bell curve, okay? And let me explain it to you a little bit more simply. As you can see the bell curve on the screen right now, the zero standard deviation, or like the very, very center standard deviation, would basically be, let's say that you were a man, you are 5'10", and you have a son. Your son on a zero standard deviation is going to also be about 5'10". Based on genetics, you'd be about 5'10". Now, let's say one standard deviation would be 6'1", and two standard deviations would be 6'4", right? So you can basically see how the Bollinger Band works for the stock right here. You can see that SoFi is trading within the Bollinger Band a majority of the time, and this is a two standard deviation Bollinger Band. And again, going back to the example, two standard deviations to the right would basically be if you're 5'10", your son is 6'4". Two standard deviations to the left, okay, one standard deviation lower would be 3 inches lower than your height, so it would be 5'7", or 3 more inches lower would be two standard deviations, which would be 5'4". So you can see how, stock trading, it has a lot of applications very similar to life for, in this example, human height. So at the top of the Bollinger Band, it would be, unusual on the top end, and the bottom of the Bollinger Band, it would be unusual on the bottom end, okay? So the two standard deviations here basically tells you that the stock should be trading within this level. If it's trading outside of this level, it would be as unusual as the height example I made. Also, you can do an income example. So the average income in the United States is $60,000, let's just say, right? And one standard deviation would be making $100,000. Two standard deviations would be making $140,000. And then, you can also go on for more standard deviations. However, it doesn't really make sense. And let me show you an example why it doesn't really make sense. You can actually change the Bollinger Band to 3. What this would do is it would make your trading even safer. And you'll see why. So if I go to 3 right now and I click done, you can now see that this Bollinger Band has expanded. So it is telling you more unusual data. So, for SoFi to go up to $15 here in the next month, this would be very unusual based on the Bollinger Band. Or for it to fall down to like $8 per share, that would also be very, very unusual behavior. However, at 3 standard deviations, it's not that good because you're getting so unusual and you're getting so low risk that you're giving up a lot of the return. So I'm going to change this back to 2. And what this means essentially for you to review this course, if you sell put options, you should be selling closer to 9. However, this is just based off of the Bollinger Band. Let's talk about the other indicators and how to use them. Because the center of the Bollinger Band, for example, is 1140. And since SoFi is above, I would kind of go closer to that 1140. Now, this red line is the moving average. It's just saying, hey, if you take all the data for the past 50 days, I'm using a 50-day moving average. Some analysts, some traders, some investors like 60, some like 90, some like 30. I like just using 50. 50 is a good mix of really short-term and somewhat short-term and maybe some longer-term data. So using 50, I can pretty much make a better decision on SoFi that the 50-day moving average is hovering right around $12.20. So if I wanted to make a smart decision, and let's say that I wanted to sell a put option, I would sell it at about $12. Now there's multiple data points to support this. Middle of the Bollinger Band, 1140. Moving average, 1220. So, I'm getting an idea in a sense for, a good strike price to sell a put option. So here it would be $12. Now, the other indicator that I use is RSI. The RSI is basically very interesting for telling you the strength of momentum. So how strong is momentum of investor sentiment? So right here, you'll see that it's 55. 20 would be oversold and 80 would be overbought. 55 is right around the center. And my overall analysis of SoFi in this point of time, we have many examples throughout time as I'm making this long course. It's taken me months to make this course. The technical analysis here tells me that SoFi is somewhere in the middle of its Bollinger Band. It's not overbought or oversold. And based on the moving average, it's right around its moving average. Therefore, what I would be doing right now is I would pretty much put a short-term neutral price target on SoFi in the short term. And even it's a little bit more on the expensive side since it is, towards the top of its Bollinger Band. For this reason, the best strategy that, I would use right now and, have my Discord calls on Mondays and Wednesdays, and I do my coaching, and SoFi is something that I trade all the time. A very simple decision for me to make on SoFi, and what I will do when the market opens up, today is I will just be selling a put option for the $12 strike and collecting income on SoFi and looking to generate cash flow and acquire shares of SoFi for lower than the current price. The current price is 12.70. If I sell a put option at 12, I'm getting a 70-cent discount and I'm going to get paid for basically nothing. I'm getting paid to buy a stock that I want to own. So that's why selling puts is a great strategy. And this is why, the Bollinger Band and the RSI and the moving average are the only really three indicators that I will use. And just for some comparison, just so you understand, there is so many different indicators, and a majority of them are just complete BS. After working in the industry, I've seen some of the best people just using the simplest indicators, just really using simple strategies, simple indicators. And I believe that to be the best to scale, to retire, to generate the income that you're looking for in retirement. And yeah, just to have enough money to really live your life without having to work. And in retirement, if you want consistent cash flow, safe cash flow, reliable income stream, you really want to go for simplicity rather than too much complicated techniques, complicated indicators. I don't believe in any of that. I've done very well just sticking to the basics. And just so you can see the indicators, a lot of this stuff, I don't even know what it is, like the awesome oscillator, the center of gravity, the Chalkin, money flow, the choppiness index, the Darvest box. I mean, a lot of this stuff, like you can see, I'm scrolling here, the Keltner channel, a MACD can be useful, though I don't use it all the time. I mean, there's so many indicators, and the majority of them you do not need whatsoever. So I'm going to save you a lot of time, a lot of hassle, and just tell you, keep it simple. And that is the best way to be profitable. All right, now that we have discussed technical analysis and what I look for in technical analysis, so let's talk about something that I'm personally very passionate about. And let's give you the foundation of what selling options looks like. We've talked about buying calls and buying put options. Let's flip around. Let's talk about selling call options, which are actually referred most of the time to covered call options. And let's talk about selling put options, which for me, I'm going to discuss and show you what a cash secured put is and selling put options. But in general, let's talk about the overview. Selling options is an amazing way to generate consistent passive income. And pretty much all my favorite strategies involve selling options because, as I mentioned, you get to become the casino. You get paid to trade stocks. When you sell an option, you're essentially collecting the premium up front. That cash actually enters your account right away. You can buy groceries with it. You can do anything that you want with it because it enters your account immediately. And your goal is for the option to expire worthless. So you keep that premium as profit. Let's start with selling call options. Selling call options is a strategy where you're betting that the stock price will stay below the strike price by the time the option expires. When you sell a call option, you're agreeing to sell the stock at the strike price if the buyer decides to exercise the option. In exchange for taking on this obligation, you collect a premium upfront. Now, this is actually done as part of a strategy called a covered call, which means you already own stock. And I'm going to explain and show you how this works in just a second. But don't get intimidated by the new name of the strategy. A covered call is just a method of selling call options. You can also technically sell calls without owning any shares of stock, which is called a naked call. That is a much riskier strategy. It involves unlimited risk, and I would not recommend that for a beginner at all. This is only something that I do in my one-on-one coaching where I'm working with higher net worth individuals, folks who have $100,000 plus. So let's just stick to a covered call option, which is essentially selling call options and you own 100 shares of a stock. Okay, so let's say that you own 100 shares of Apple and your stock is currently trading at $220 per share. You're not planning to sell your shares anytime soon, but you wouldn't mind generating some income while holding onto the stock. So you sell a call option with a strike price of $230 and expiration dates of 30 days from now. For selling this option, you collect a premium of $5 or $500 for the contract in total. That $500 is yours to keep no matter what happens. If the stock goes down, sideways, or up, it can go like this and that in the third. It doesn't matter. That income is yours to keep. All right, so let's take a look at the option chain and what an option chain is. An option chain allows you to pick an option that works for you, whether it's buying a call option, buying a put option, selling a put option, or selling a call option. It gives you the ability to pick and choose if you want to sell or buy a call or a put. It also gives you the ability to look at expiration date. If you're using a different broker, it might look different, but it's still the same. It's like a Honda or a Toyota. They do the same thing, and they still get you to the same location if you drive the car with 4 wheels properly. So same thing here. You can look at the expiration date and pick an expiration date that meets the strategy that you're trying to implement. So if it's a leap strategy or a long-term strategy, then you'll pick an expiration date that's far into the future. And if it's a short-term strategy, you have that full control. Now here, what you'll see is there's rows of different options with different strike prices, 240, 235, 230, and etc. Robinhood here has the break-even prices, chance of profit, the percentage change, the dollar change, and the option itself here. So these options are not going for much because this option was expiring in 0 days, or it's a 0 DTE option. And here we have some options where you can click here and then you can understand the Greeks, and you can look further into the bid ask, the high and low, the volume, the open interest, and all the Greeks down here, which you learn about very soon. Here's what a bid and ask spread is. An ask is essentially where if you were to buy an option, you would buy at the ask because someone is asking for that price. A bid is if you were looking to sell. So if you were looking to sell, then you would bid to sell at this price. You can see there is a slight difference, and that's because this is a bid-ask spread. Okay, there's a spread. To create volume, there are market makers on Wall Street who are providing liquidity to the market. You can see here, the volume is 4,468. So the market has volume, but a lot of this volume is not actually humans trading. It could be algorithms, could be market makers working on Wall Street. It can also be humans, hedge funds, etc. Right? So when you look at bid ask, there is always going to be a slight discrepancy. It's never going to be the same. A bid, again, is if you're looking to sell an option, you're going to have to sell closer to the bid. If you're looking to buy an option, you're going to be going closer to the ask. And that's why even if your brokerage platform has 0 fees, it still costs you a little bit of money, at least a few dollars, to make every single transaction per contract. Volume is the amount of contracts that were traded today. So you can see here, Apple has 4,600 contracts that were traded just today, which is actually the majority of total volume, or the open interest is what we call the total volume. The open interest is 6,192. This is the open interest, how many contracts have been traded in all of the history for this specific expiration date and a specific strike price. So volume is today, open interest is all the contracts in the past, and implied volatility is the expected volatility over the next 30 days as a percentage. So here, this number 22.5 is an expected implied volatility here for the future. This is what the traders are actually believing that the stock will have in terms of volatility for the future, which is one of the very few future-focused numbers that we have in trading in general. Now I'll explain how a covered call works and why it's called that. Let's say that you own 100 shares of Apple, and the stock is currently trading for $220 per share. You're not planning to sell your shares anytime soon, but you also wouldn't mind generating some extra income while holding on to the stock that you already have. So you'll sell a call option with a strike price of $230. For selling this option, you collect a premium of $5 per share, or $500 for the total contract. That $500 is yours to keep no matter what happens. Here are the possible outcomes. If Apple stock price stays below $230 by expiration, the option will expire worthless, and you'll also get to keep the $500 premium as pure profit. Plus, you still own your 100 shares of Apple. If Apple stays at $220, it goes down, or even if it goes up a little bit, you're good. Even if it goes all the way up to your strike price of $230, you're still good. As long as it doesn't go above it, you won't be at risk of assignment. And just to clarify, assignment is another option trading term. It just refers to when the buyer of the option, no matter if it's a call or a put, decides to exercise their option. Then the seller would get assigned. So assignment is something that you can only see happen if you're an option seller. So back to the example. As long as Apple doesn't go above $230, this is the ideal scenario for you because you've made money without having to potentially sell your shares. But what if Apple's stock price rises above $230? Let's say it goes to $240. In this case, the buyer of the call option might decide to exercise their right to buy the stock at the $230 strike price. You'd have to sell your 100 shares at $230, even though the stock is now worth $240. This is not necessarily a bad thing, especially if you originally bought those shares, those 100 shares for $220 or, really anything under the $230 strike price. This is actually a really good thing because you're making profit from selling the stock and you're also collecting the $500 in premium, which you get to keep for even putting this trade on in the first place. But even if you don't make that much profit, you're covered because you already own 100 shares of the stock. That's why it's called a covered call. And that's the reason why this strategy is so great and why I love option selling strategies, because there pretty much is absolutely no downside if you're making money. The only issue with the covered call is you might make a little bit less money than just holding a stock in case the stock really rises a lot. But in all other scenarios, you're going to be better off than just a person holding stock. The only downside is that profit is capped. If Apple keeps rising past $230, $240, or even $300, you don't get to participate in those extra gains. You've agreed to sell $230 per share, so no matter how high the stock goes, your profit is locked in at that level. That's a trade-off of when you're selling covered calls. You're giving up some potential upside in exchange for collecting guaranteed income upfront. But here's why that's actually a good thing, in that most investors don't really understand how good a covered call actually is. Think about it. How many times have you held a stock, watched it go up, and then it dropped right back down before you ever took profit? Happens all the time, right? Stocks don't just go up in a straight line. They move up, they move down, and a lot of traders never lock in their gains. With a covered call, you're locking in profit along the way, ensuring that you're getting paid no matter what happens. If the stock moves up, you still profit from the stock appreciation plus the option premium. If the stock stays flat, well, you have the option premium, you got paid. And if the stock drops slightly, you offset some of the loss with the premium that you've collected. This is why covered calls are such a powerful strategy, because they give you a consistent, reliable way to generate income, even if the stock doesn't move much at all. Instead of just sitting there hoping for the stock to go up, you're getting paid to wait. Now, let's talk about another important aspect. What happens if the stock drops significantly? In this example, Apple was trading at $220 per share. We sold a covered call for $230. But what if instead of going up, Apple dropped to $200 per share? If that happens, your call option will expire worthless, and you'll keep the full $500 in premium as profit. That's the good news. But your 100 shares have also lost value. Now they're worth $200 instead of $220, meaning that you have a paper loss of $2,000 on your stock position. This is where a lot of traders start to panic, because even though they collected $500 in premium, their stock is down $2,000. But here's the thing. If you were planning to hold Apple long-term anyways, this isn't really a loss unless you sell your shares. Plus, you can immediately sell another covered call for the next month, collecting more premium, and to continue lowering your cost basis. See, every time you sell a call option, that's income. So you can count that as a lowering of your cost basis. So if you bought Apple for $220 per share, you sold a $230 covered call, and you collected $5, your actual average cost is now $215 because you've collected $5 in income, and that $5 works against your average cost of $220. So you have a new cost of $215. Your brokerage may not say this, but if you track your trades, this is basically what it is. Now, when the covered call expires, and let's say that you sell another covered call option. Let's say that the stock went down to 200, like the example we're making where the stock went in the opposite direction of where we hoped. So if the stock went down to 200, you collected $5 for the 230 covered call. Now the stock's at 200, your average cost is 215. You can sell another covered call. Let's say that you sell a 210 covered call, but this time you collect a $7 premium. Now, if you take into account the new $7 premium, then the 215 average cost that you have minus the $7 premium is now an average cost of $208. But you have sold a 210 covered call. Voila, there you go. Now, even if the stock sells off, it's going to sell off above your new average cost. So with a covered call strategy, it's actually incredibly easy to make money. And even if the stock goes down, you're still going to make money, just you have another covered call to go, or maybe another covered call to go. And this is exactly how I've been able to profit with covered calls over a very long period of time, almost no matter what the market does. Now, let's talk a little bit more about cost basis. You might be thinking to yourself, well, what is that really? Well, cost basis is simply the price that you originally paid for your shares, but it can change over time depending on how you manage your investments. When you buy a stock at the stock price, well, that's your initial cost. You can say that's your average cost when you take all the shares and you divide it by how much money you actually purchase all those shares for. But if you start collecting premium from selling covered calls, you're effectively lowering your cost basis with every single trade. Let's go back to Apple, for example. You bought 100 shares at 220, so your cost base is 200. You sell a 230 call option for $5 per share. Now you have a new cost basis of 215. Let's say the option expires and you go ahead and sell another option for $7, as we already mentioned. Now it's 208. Let's say that the stock does not go to that strike price of 210 in that second example. Well, we sell another covered call, again at 210 or 215, and let's say we collect another $5. Now our average cost is 203. And in another month, we do another $5. Now our average is 198. And you can continue to do this on a regular basis. As long as the stock doesn't go above your strike price, then you would lose. Well, in terms of losing, I mean you would get assigned, but you don't actually lose on a covered call. You just continue to make money month after month, expiration after expiration. If the stock goes up, you look really smart. If the stock goes sideways, you look like a genius. If the stock goes down, you still pretty much look like a genius. So in all scenarios, up, sideways, or down, a covered call is a great long-term strategy to making consistent income, lowering the cost basis of the shares that you already hold, and really creating a retirement income on stocks that you already have, whether they're high quality stocks or they're high growth stocks, or even if they're dividend paying stocks, you can still collect income from covered calls. Later on, we'll talk about the double dividend strategy that I have, which is a very interesting retirement strategy that I actually come up with myself, and we'll go over that later on in this course. If you were to look at a profit and loss chart for a covered call, it would have a cap on the upside, but limited downside protection. Instead of an unlimited profit potential like a regular stock, a covered call flattens out at a certain level because you've agreed to sell your shares at a fixed strike price. At the start, when you sell the covered call, your maximum profit is already locked in. In this case, you sold a 230 call on Apple and you've collected $500 in premium. So the most you can ever earn on this position is going to be $1,000 of capital appreciation, the stock going up, and then $500 in premium. So a total of $1,500, which is actually a very nice return. If Apple stays below 230 at expiration, the option expires worthless. You get to continue to do covered calls, and that 500 is yours no matter what. If Apple stock goes above 230, your profit stops increasing because you're required to sell your shares at that strike price. Even if Apple skyrockets to $1 million per share, you don't get that upside. That upside is reserved to the person that purchased the call option. You have sold the call option, and you've agreed to a specific return. You said, hey, I want this premium up front, I want a guaranteed income, and I get some upside. So you basically, know exactly how much money you're making. This is what makes option trading awesome as well, because a lot of people think it's very risky. And although it can be very risky if you're the option buyer, you have really big risk, you have really big reward. As an option seller, you have a defined return. So you have pretty much a guaranteed premium, and then you know exactly what your return is in what time period. And now, you can calculate, hey, I'm making X amount of dollars per month, and it's a very predictable income stream. And this is why it's so amazing for retirement. Now, we've talked about covered calls. Let's talk about selling put options. Again, this is one of the best strategies, and I don't even mean that lightly. This is literally the best strategy along with covered calls. And then later on in this course, we'll put the selling puts and covered calls together and show you a system to run the wheel strategy, which is the combination of these two strategies. Selling put options is a strategy where you're betting that the stock price will stay above the strike price by the time the option expires. When you sell a put option, you're agreed to buy the stock at the strike price if the buyer decides to exercise the option. This strategy is often used by investors who wouldn't mind owning the stock at a lower price, and they're actively trying to purchase the stock but get a huge discount and get paid to wait. Now, as you might be expecting, this is similar to selling calls because there's also multiple ways that you can sell a put. And again, I'm going to be covering what is called a cash secured put, because instead of having the shares to cover yourself, if you get assigned, this time you'll need to buy 100 shares per contract of the underlying stock at the strike price that you choose. So in order to cover the obligation to buy a stock, you will need money to buy those shares, right? That's why we call it a cash secured put. Now, let's get into an example. Let's say that Apple is trading for $230 per share. You'd be happy to buy the stock if it drops to $220. You sell a put option with a $220 strike price, an expiration date of 30 days from now. For selling this position, you collect a premium of $5 per share, or $500 for the contract. That's $500 that's yours to keep no matter what happens. Here are some possible outcomes if Apple's stock price doesn't go below $220 by expiration. The option will expire worthless in all of those scenarios. If the stock's at $235, if it goes up, if it goes sideways, if it goes down to $221, $222, all of that just means that that $500 is yours and nothing happens. The option expires worthless. Now, if the stock goes to $220, okay, that's your strike price. So here you are at risk of being assigned. Again, being at risk for being assigned isn't really a bad thing if you want to own the stock anyway. So you're saying, hey, I might get assigned. That's all right. I got the cash to buy this stock. I have the cash to buy 100 shares. The 500 is yours if Apple stays above 220. If Apple goes below 220, the 500 is still yours, but now you have to buy Apple for 220. Isn't that actually crazy? So essentially the stock's at 230 and you have to buy it at 220 and you get paid for that. Doesn't that seem like too good to be true or something? But this is actually how selling puts works. You're getting paid to take on the risk because someone else is buying insurance essentially. And maybe they think the stock will crash. Maybe they're afraid if the stock will go down, they want to protect themselves. You're a long-term investor. For you, you're happy to buy Apple at 220. And if Apple goes down to 218 per share, you'll have to buy it for 220. But that's okay because, 220 is what you buy it for. You got paid $5, so you know that your average cost is going to be $215. Let's say that Apple goes down to 216. You're still up $1 because your average cost is $215, the 220 minus the premium that you collected. That's really cool. Now, if Apple goes down to 210, well, you'll be, in theory, down $5. But again, it's Apple that we're trading. It's going to come back up at a certain point in time. So Apple went from 230 down to 210. Your average cost is 215. You got assigned at 220. You got assigned at 220. Your average cost is 215. But hey, you decide to hold on to Apple and maybe hold on to the stock, or maybe, as we'll talk about it later, you decide to start selling covered calls and generating income on, the position that you now have. So you can kind of see where I'm going with this. This is a fantastic strategy because selling puts allows you to get into a stock for cheaper than the current stock's value. So if the value of the stock is, 230, selling a put that's out of the money with a delta of 30. Okay, that's the sweet spot delta. Don't worry if you don't know what delta is. We're about to cover it in the next few minutes. Here's a golden nugget. I personally prefer selling strategies like covered calls and cash secured puts over buying calls and puts just because they're easy to manage, they produce income, and they're much safer in the long term if you're looking to retire. So why is that? Because selling strategies, you're basically just looking for something to not happen with the stock. The stock has to stay the same, or it has to stay in the same range. All you have to do is check a couple of times per week. As long as the stock is above your strike price or below your strike price, depending on if it's a call or put, you're in good shape. So instead of, when you buy an option, you need something to happen. Okay, when I was working with the trader on Wall Street, he said, when I buy options, I'm nervous, right? Because I need the stock to move in that options direction. I need it to happen fast before the expiration date, and it must happen in a big volume, right? The stock really has to rise a lot for me to make the money that I want to make. But when you're selling options, you're in the opposite position. Someone is in that, crazy needing mode of, I need something to happen. Where you're like, hey, I'm good. I'm happy right now. I need something not to happen. So in my opinion, it's better to be in that second boat where you're being the insurance company, where you're getting paid income on a consistent basis, whether that's weekly income or monthly income, and that's coming into you. And then, you're managing your risk. You're looking at your position 2 times a week, but then you get to still focus on your job. You get to focus on your career. You still have, active income coming in, because for me, option trading is it's a good passive income source, but I'm never trading actively. For the most part, I do some active trading with my one-on-one students when they're looking to scale, when they already have the bigger money. and it makes sense for them to go full time and stop working. Maybe these folks they're usually 50 plus, they have a few $100,000, they want to go full time, they want to scale a few $100,000 to the 500K mark, or maybe it's the 500K mark to 7 figures in the 1 mil mark, or so on and so forth. Then it can become more active when they already have the capital to make it a full-time job, right? To make it a full-time job, I will say, but it's still very easy, just a little bit extra work and some extra strategies that I give my students. So let's talk about buying options a little bit more. So with buying strategies, you have the potential to make more profit, which is why a lot of people like them. And I'll be talking about something, a leap option later in this course. I'll be talking about a poor man's covered call. I'll be talking about other buying strategies where you can have a small amount of money turn into a big amount of money. But at the end of the day, risk and reward are correlated to each other. They go hand in hand. So when you look at buying strategies that can get a lot of money, they also do include always more risk. There is no such thing as ultra high return, very little risk. That's just, it doesn't really exist in our world for the most part. So it's always a balance between risk and reward, and it's using this knowledge to really create income and to spot opportunities. Back in 2021, I did turn $100,000 to $700,000, and that story will be coming later when we go over the strategy that I used. That's a little bit more of an advanced strategy that we'll cover later on in this course. So a lot more coming to you. I hope that you're taking notes, and I hope that you're ready and hungry to learn, because this is really life-changing information. If you want to understand options with confidence, you need to understand the Greeks. You know how in math or science classes, you probably learned about some Greek letter like pi, for example? Well, options have a lot to do with math and have multiple Greek letters that show us how they move and how they behave. But don't worry if you don't like math, I won't get into too much of that. You just need a simple understanding of math, even just, not even high school level, to be pretty good at options. So if you've ever looked at option chains and felt confused by all the numbers next to the premiums, don't worry, you're not alone. But here's the thing, those numbers aren't just random numbers. They're actually telling you exactly how your options will move based on different factors. And once you understand them, you'll have a major edge over other traders. The Greeks are like a cheat code for option trading. They help you predict price movements, manage risk, and choose the best trades. Without them, you're probably just guessing, which is what causes a lot of beginners to lose money. But don't worry, I'm going to break everything down to you in a way that's simple, easy to follow, and beginner friendly. Let's start with the most important Greek that every trader has to absolutely understand in full detail, which is delta. Delta tells you how much the price of an option will change when the stock moves by $1. Think of this as a speedometer. It measures how fast your option will move when the stock moves itself. For example, let's say that Apple is trading at $220 per share and you're looking at a call option with a 230 strike price. If this call option has a delta of 0.5, that means that if Apple goes up by $1, the options price will increase by 0.5 per share. If Apple goes up by $2, the options price will go up by $1 per share. If the option originally had a price of $3 per share and Apple jumps $2 higher, the options price would increase to $4 per share. Now, here's something really important. Delta isn't just about price movement. It also tells you the probability that the option will expire in the money. So if your option has a delta of 0.7, that means there's a 70% chance the option will expire in the money. If the delta is 0.2, that means that there's a 20% chance that the option will expire in the money. This is huge for traders because it helps you decide which option to buy or sell. If you're buying options, you generally want higher delta options, 0.6 or higher, because they move faster with the stock price. If you're selling options, you usually want lower delta options, 0.3 or lower, because they have a lower chance of expiring in the money, meaning that you keep more of the premium. Now, let's talk about the second most important Greek, which is theta. Theta tells you how much an options price will drop every single day due to time decay. This is a huge deal because all options lose value over time, and theta measures how fast that happens. For example, if a call option has a theta of negative 0.05, that means the option will lose 0.5 cents per day or per share every single day just because of time passing. If the option starts at $3 per share, then in one day it'll be worth $2.95. The next day it'll be worth $2.90. This is if all else is even. That means that the stock has stayed the same. Here's a key thing to remember about theta. Time decay gets faster as the option gets closer to expiration. If an option has 60 days until expiration, theta is slow and you don't lose much value each day. If an option has 10 days until expiration, theta is fast and the option loses value much more quickly. This is why buying short-term options is so risky. You're fighting against time decay every single day. The stock has to move quickly in your favor just to keep up with the loss in value. But if you're selling options, theta is your best friend. Every day that the time passes, every single day, the option is losing value. That's value that's going into your own pocket. And since you're the seller, that means that every day the premium goes down, you have already sold that option when you first opened it. So if you sold it for $3 and the value goes down to $2.50, well, you can pocket the difference and close out that option right now if you wanted to. This is why a lot of professional option traders, they sell options instead of buying them because time decay works in their favor and it's a lot easier, especially if you have a career as an option trader and you want to be successful over the long term. It's a lot of work. So what you want to do is you want to have consistency. So a lot of option traders go for selling options because they have a lot more consistency versus buying options. The next Greek that I want to cover is going to be gamma. Now gamma is one of the more technical Greeks, but I'll keep it simple. Gamma tells you how much delta will change when the stock moves by $1. For example, if a call option has a delta of 0.5 and a gamma of 0.1, that means if the stock moves up by $1, the delta will increase from 0.5 to 0.6. If the stock moves up another $1, delta will increase again to 0.7. Why does this matter? Because options don't move in a straight line. They're sensitive to stock price changes, increases, or decreases as the stock moves. Gamma is highest for at-the-money options because they have the most potential to go into the money or out of the money very quickly. As an option moves deeper in the money, gamma slows down and delta starts approaching 1. That means the option starts moving almost exactly like the stock. For most beginners, you don't need to focus on gamma too much, or you don't even have to look at gamma at all. Just remember that you're buying options. High gamma means that your delta will grow fast if the trade moves in your favor. If you're selling options, high gamma can be very risky because it means that delta can swing quickly against you. The next Greek is called vega. Vega measures how much an option's price changes based on implied volatility. If an option has a vega of 0.1, that means for every 1% increase in implied volatility, the option's price will increase by 10 cents per share. If IV drops by 1%, the option's price loses 10 cents per share. This is why option prices jump before earnings reports. IV increases because the market expects a big move. But after earnings, IV crashes, and that's why options lose value quickly after big events. This is called IV crush, and it's one of the biggest mistakes beginners make. They buy options right before earnings, and they don't realize that options can lose value even if the stock does move in the right direction. For beginners, the main takeaway about vega is if you're buying options, you want IV to increase. If you're selling options, you want IV to stay low or decrease. The next Greek is rho. Rho measures how much an option's price changes on interest rates. It's called rho, and rho essentially isn't as important as any of the other Greeks because interest rates don't really change that much. But if a call option has a rho of 0.05 and interest rates increase by 1%, well, that's going to increase the option's price by 5 cents per share. Here's the thing, interest rates don't really change that often unless there's a big Fed meeting and, there's a lot of inflation in the economy. So I would just focus on delta and theta. And then there's vega, and then, maybe gamma and rho or, the less important ones. Rho is only really relevant for long-term options like leaps because a leap can be impacted a decent amount if the time is very long and the interest rate does change over that period of time. Of course, that could change the value a little bit, but again, it's not going to have the hugest impact. And for short-term traders, you can pretty much ignore rho altogether because it's not going to have any impact at all. Like weekly and monthly income, not really impacted by the Greek rho. The Greeks aren't just numbers though, they're tools that can help you make better decisions. Here's how to apply them in real trades. If you're buying options, pay attention to delta and theta. You want high delta so your options move faster with the stock, and you need to make sure that theta isn't eating away at your premium too quickly. For selling options, focus on theta and vega. You want high theta because time decay helps you, and you want low vega so your trade isn't affected by big volatility swings. If you're trading around earnings or news events, watch vega. If IV is too high, then it's going to be an expensive option. It's not going to be worth buying that option. Understanding the Greeks separates smart traders from gamblers. Once you start using them, you'll see that options aren't just random. You can completely predict them, you can manage your risk, and you can make much better trades. Now that you know how the Greeks work, let's apply them to some real world examples so you can see exactly how they affect option prices in action. When you're buying call options, a high delta will be an option that has 0.6, 0.7, 0.8 delta. Anything above 0.7 delta is going to be a high delta. when you're selling put options, a high delta will actually be something like 40 delta, because a 40 delta is very close to the money. For a sell put, a 40 delta is a lot because we usually sell out of the money options. So 50 delta will be right at the money. A 40 delta will be very close to the money, right? So a 40 delta on a sell put option would be considered high. Whereas for buying a call option, a 70 delta would be a high delta. If you're selling a call option, again, it would be 40 delta, because selling means that you're just slightly, out of the money. So it'd be 40. So when you're selling options, a 40 delta is high. When you're buying options, if you buy a call or you buy a put option, a 70 delta would be high. Now that you understand what each Greek does, let's go over their numbers and what they actually mean, so you can tell whether a Greek value is high or low in a real trade. Let's start with delta. Since it's one of the most important ones, delta ranges from -1 to 1. For a call option, delta is between 0 and 1. For put options, delta is between -1 and 0. A delta of 1 or -1 for puts means the option moves exactly like the stock, 1 for 1. So if the stock moves $1, the option also moves $1. If the delta is 0.75, that means for every $1 move, the option is going to move 0.75. Here's what's cool about delta. It actually tells you the probability that the option will expire in the money. For example, a delta of 0.8 means that the option has an 80% chance of expiring in the money. A delta of 0.5 means there's a 50% chance, basically a coin flip. A delta of 0.2 means there's only a 20% chance of finishing in the money. That's why deep in the money options, high delta, are more expensive. They have a high probability of expiring profitably. And out of the money options, like low delta options, are cheaper because they're less likely to finish in the money. Now, let's talk about theta, which measures time decay. Theta is always negative for buyers and positive for sellers. A low theta, like -0.02, means the option loses $2 per contract per day. A high theta of 0.5 or more is that the option loses $5 or more per contract per day, but it'll depend on how expensive the shares are. All right, now something very important we need to talk about is managing a risk and limiting your downside if you end up in a bad situation. Luckily, option trading is so versatile that it's easy to do this. When it comes to options as a risk management tool, one of the most valuable strategies that you can use is hedging. Hedging essentially means protecting your portfolio for potential losses by using options. Think of it like buying insurance. Just like you might get insurance for your car or your house to protect against unexpected damages, you can use options to protect your investments from unexpected price drops. This strategy is especially useful if you own stocks and want to reduce your downside risk without selling your shares. Let's start with one of the most common hedging strategies, a protective put. A protective put is exactly what it sounds like. You're buying a put option to protect the value of a stock that you already own. Here's how it works. Let's say that you own 100 shares of Apple and the stock is currently trading for $220 per share. You're worried the price might drop in the short term, but you don't want to sell your shares because you believe in the company's long-term potential. To protect yourself, you buy a put option with a 210 strike price and an expiration date of 30 days from now. The premium for this put option is $3 per share, so you pay $300 for the contract. Now, let's talk about what happens if Apple stock's price drops. Suppose the stock falls to $200. Without the put option, your 100 shares would lose $20 per share, or $2,000 in total. But because you bought the put option, you have the right to sell your shares at $210, even though the market is lower. This limits your loss to the $10 difference between $220 and $210. Plus the $3 premium that you paid for the option. So your total loss will be $13 per share, or $1,300, instead of the $2,000 that the stock investor lost. That's the power of a protective put. It caps your downside risk while allowing you to keep your shares and benefiting even if the stock goes down. It can later on recover. And this gives you an opportunity to hedge and protect yourself. But there's another way to use protective puts, and that a lot of traders really overlook, and that's to lock in profits on a winning stock without selling your shares. Let's say that you own 100 shares of Tesla and you bought them for $200. Now Tesla has shot up to over $400 per share and you're sitting on a $20,000 profit. You're happy with the gain, but you don't want to sell the stock because you think it can go up even higher. Or maybe you don't want to sell it because you'd have to pay taxes on whenever you sell a stock that's a taxable event. And also, to add a third reason, you don't want to risk losing your profit if Tesla suddenly drops back down. So you say to yourself, I want to protect myself. Well, this is where protective puts come in. Instead of selling the stock, you buy a put option with a strike price close to the current price. So let's say $390 per share. The cost of this put might be $5 per share or $500. Now, no matter what happens, you've guaranteed that you can't lose your shares any lower than $390 per share. If Tesla keeps going down, you still own stock and you continue to make money on the put option, the protective put option that you bought. What if it crashes down to say, $300 per share? You don't lose your gains. You simply exercise your put and you sell your stock at $309 per share. This strategy is perfect for long-term investors who want to lock in gains while still holding their shares. These investors might not mind paying insurance for their stock, especially if they're up so much on some, really big play. Instead of worrying about a big market drop wiping out months or even years of gains, a protective put lets you stay invested while setting a price floor for the stock. Now, let's talk about another way to use options for risk management: collars. A collar, okay, it's not a physical collar. A collar is actually really interesting. It's something that Mark Cuban did when he sold his company to Yahoo for $3.9 billion. He used a collar. You don't have to be a mega billionaire to use a collar. A collar is a protective strategy, very similar to how buying a put option or buying a protective put is also a fantastic strategy. A collar is a strategy that combines a protective put with a covered call to create a cost-effective way to hedge your stock holdings. Here's how it works. Let's stick with Apple example, okay? You own 100 shares of Apple, currently trading at $220 per share, and you're worried about a potential price drop. You buy a put option with a 210 strike price to protect your downside, just like we discussed earlier. But to offset the cost of the put option, you also sell a call option with a 230 strike price. Let's say the premium for the call option is $3 per share, which matches the cost of the put option. This means that the income you receive from selling the call option completely offsets the cost of buying the put option, creating what's called a zero cost collar. Here's how this trade works out. If Apple stock price drops below 210, the put option protects your downside, just like in the protective put example. If the stock price rises above 230, the call option you sold gets exercised. You have to sell your shares at $230 per share. This means that you do miss out on the gains above 230, but you're still locked in at a profit of $10 per share plus the income from the call option. The collar strategy is a great way to hedge your portfolio without spending any additional money. The trade-off is that it limits your upside potential, but it's a solid choice if your primary goal is preserving your capital while generating a bit of income. All right, now I want to show you what rolling calls looks like and why you would want to roll calls. To wrap up rolling puts, you would want to roll a put when you've lost some confidence, when you want to move your strike price lower and you don't want to take assignment, today or in the near term. You want to have, potentially take assignment, but you want more time on that option. You want to push that expiration. Now let's talk about a covered call, because a covered call is actually very similar. It's the mirror version of selling a put option. So let's go over a covered call. I don't have too many open in my portfolio that are in the money, but I can go over something like Palantir 105 covered call. So I have one contract here, and Palantir is currently at 110 per share. So there's a couple of things here that I want to discuss. First of all, I want to discuss rolling up, what delta to roll up, what time frame to roll up, and why it's beneficial to roll up. So the time frame, usually I go for maybe 30 days or 60 days, something around that, because adding 30 to 60 days gives you enough time to really repair the option and adjust the option and really change the premium associated to the option and, a reasonable amount of money. If you go, too short term, you go week by week, you can't really repair the option much. I mean, what are you going to repair? Like 25 cents? So you're going to, repair much more when you go out 1 month. So let's go to roll this position and I'll show you a full example of this. So again, this option's, expiring in February, end of mid-February. So if I go to something like, again, we'll just roll out 1 month. This is like the, the standard that I do. And if I go from 105 and I go up to 110, you will see here that, oh, actually it is a credit. Okay, that's good. I was concerned that it might be a debit. Actually, let me show you a credit and a debit. This is going to be really interesting and valuable information in terms of rolling. So this right here is going to be a credit. And if I go from 105 to 110, that's beautiful because going up by $5. And on a covered call, that means my shares, I don't have to get rid of them for 105. I don't have to let go of my shares. I can hang on to my shares and let my shares go for 110 instead of 105. So this is a $5 benefit. I'm essentially making $500 extra than I would have. Now, in addition to making $500 extra that I would have, I'm also actually getting paid a credit of $145. So I'm getting paid $145 to make $500 extra. So what's the catch? Like, how can it be this lucrative? Well, it's because I'm still holding 100 shares of Palantir here. So this was a wheel strategy. I sold puts to get in. I added to the stock. I have the stock, and I'm running covered calls as a strategy right now. And the covered call, it went into the money. So I will have to roll this position higher because I personally don't want to lose Palantir. If I were to lose Palantir, it would be a taxable event. I would have to pay taxes because I'm realizing gains. And as soon as I realize the gains, I'm going to lose to the tax man. It's going to go to Uncle Sam. And maybe that money will go back to Palantir because the taxes go to war and stuff like that. But, wherever the government spends the money, it goes everywhere. And, it would be wiser for me to legally reduce my taxes. It would be good to not have a taxable event, especially on the shares that have risen so much. I have $250,000 worth of gains on Palantir. So I don't want to sell Palantir. That's going to be a taxable event when I have to pay taxes. And it's going to be a much wiser move to roll this position higher because when I roll this position up, then I don't have to lose my shares. And if I don't lose my shares, well, the taxable event is rolling from 105 to 110. I'm going to collect the credit here. So I have to pay taxes on the 145 credit. But, the shares will continue to be mine, so I won't lose my shares. So you see, when I'm running the wheel strategy, oftentimes when I have picked really good stocks, oftentimes I don't want to let them go. So this can sometimes be a catch-22 situation because I like the stocks that I trade. So I'm usually not even exiting the wheel strategy in many cases. Sometimes I am, but oftentimes I'm not. So for Palantir here, in this example with, I have the 105 and I can buy that back and sell the 110, maybe I don't want to sell the 110 because it's still a little bit in the money. Maybe I want to sell the 115. Now the 115 is going to be different. Okay, this is a different case. Okay, I showed you rolling it for a credit. Well, rolling for a credit is easy, right? Anyone can roll for a credit. You have to wait a little bit more time, but you have made more stock appreciation because you went from 105 to 110 and you got paid your credit. So it's a no-brainer strategy, right? You can have a second grade math level and say, hey, this makes sense, right? There's not that much here to contemplate even, right? But when you look at this trade, it's a little different. So if I move from 105 to 115, then all of a sudden you can see that this is a net debit. So the debit here that I have to pay is $100, and essentially I have to pay $100 to move from 105 to 115. So let's think about it here. What's going on? Well, going from 105 to 115 means I have $10 now more upside, okay? And the total debit I have to pay is 1. So I pay 1 and I get 10. Well, that's a 10x return. So does it make sense to pay 100 to have the potential to win 1,000? The answer is yes, especially because $5 is already intrinsic value, okay? So Palantir is at 110. And this call option is at 105. So intrinsic value, I have $5 for sure right away. I pay 1 to get 5. But then, if you think Palantir is going to go up or whatever stock's going to go up, right? I don't care. I'm not picking stocks in this course. This course is to teach you the foundation. If, I have $5 of intrinsic value, but I have $10 of total value, 5 being intrinsic and then 5 more being extrinsic value. So, if the stock goes to 115, cool. At least I can ride the stock to 115. So I'm paying $100, I'm getting 5 intrinsic and then 5 more extrinsic value. I would say this is a obvious, very good play. And this is actually something I will do when the market opens up because it's a fantastic trade. It's a really good trade. And as the option approaches expiration, I only have maybe a week and a half left on this option. In the last week to 2 weeks, you really do want to roll the position up, especially if you have the viewpoint of that stock will continue to go up, or the viewpoint that, you don't want to lose your stock, you don't want to get exercised or assigned because you don't want to have a taxable event and have to pay income taxes on a stock that you have gains on. So if you want to hold on to the stock, there's many reasons, right? It could be taxes, it could be you like the stock genuinely, it could be you don't have any other opportunities and you think that this is, the best holding opportunity, then it's a fantastic idea to roll this stock higher, just like you would roll a put option lower you can roll the covered call option higher in the case of the wheel strategy. So when you're running the wheel strategy, not only is it the most versatile strategy because it's a system and a process to selling puts to get in, covered calls to get out, you can even change and roll the covered calls. So, I mean, this is like literally golden best strategy that you can be running. Now's the part that you've all been waiting for. We're going to get into some really exciting stuff, which is selling covered calls live and selling puts live. These are the real live examples where I'm going to put real money to work, which has been a lot of preparation for me. I want to show you this live so you can understand, copy it, and see how this all happens in action. For every single trade that you'll see me do, I'm going to do 5 or 6 trades. I'm happy to buy all 5 or 6 companies that I'm going to trade, and I've already done research ahead of time. All that matters is that I have a high win ratio, meaning that I win more of my trades than I lose. And when I do get assigned, I'm okay holding because these are high quality companies. I'm still going to be a winner either way. I'm winning because I'm collecting premium, and I'm winning because I get to purchase a stock if it goes down. If it does not go down, well, that's perfectly okay as well. I still get to keep the premium anyway. So either way, this is like a non-losing strategy, and this is what I believe to be the best strategy. And I'm really excited to show it to you live and go through examples as well as technical analysis of me placing every single trade. Now, I want to go over some real numbers and examples for you before I go into live trading. I want to help you understand and really visualize this so you can master the strategy. And again, as I promised, I want this to be like the last video you actually have to watch about selling puts to really master this in a really short amount of time. We'll use Microsoft as an example. Let's say that you think Microsoft is at a low and you don't think it's going to go much lower in the next 30 days. So what you want to do is sell a put option contract on it. You can pick the strike price of $400 per share, which means if Microsoft does happen to fall below $400 per share, you're going to be comfortable buying 100 shares at that price. But you don't mind owning at that price because you think that Microsoft is a fantastic company, which it is long term. And for $400 per share, you'd be happy to own it. It's currently trading for $412 per share or so. So you're basically going to be getting paid $5 in premium to buy it $400, where the stock would have to go down $12 for you just to get assigned. If it doesn't go down $12, the $5 is yours to keep. If it does go down $12, you'll have to purchase Microsoft for $400, while today it's trading at around $412 per share. Seems pretty crazy, right? Like, why would someone do this? Well, someone else out there in the world thinks that the stock market might fall, or Microsoft stock might fall, or maybe they have a lot of Microsoft shares and they want to buy some put options as insurance in their portfolio in case that stock might decline for them. They might be right, they might be wrong. Either way, we're happy making this trade because we're following some important indicators and we want to own a blue chip Mag 7 stock for $400 instead of $412, and we're happy with the premium of $5 per share for 30 days out. Now, this is all theoretical, so let's actually open up my portfolio and go into my trading platform and start placing some trades, having some fun, and learning a lot on how to make consistent income selling put options. All right, we opened up my portfolio. We're about to buy bicep over tricep. We'll sell some of these put options. So my portfolio is doing pretty good at 4.3 million, and I want to start off with Alphabet or Google stock. This is a fantastic company that I want to invest more into because they generated 8.4 cents of earnings per share during 2024. So they had their earnings recently. If you look at the PE ratio, it was around 24. If you look at the stock price divided by the earnings, has a PE ratio of like 24, which is significantly cheaper than Nvidia, Microsoft, and Apple, which all trade around like the high 30s. So for me, Alphabet is an absolute steal. And if I look at the technical analysis, this stock is stupid cheap. Like, it fell all the way from 207 down to like 188, and it's at the bottom of its Bollinger Band. So for me, like, literally, I'm happy to sell puts anywhere under the Bollinger Band, and the Bollinger Band is like 186. So let me take a look at a few options and go to trade, Google options. And this is the first option that I'm going to be selling. So again, because I'm at the bottom of its Bollinger Band, I'm going to be happy to sell anything under 185. I'm going to pick an expiration date that's going to go out for probably March 21st because I like monthly expirations. I think monthly expirations are very easy to manage. You sell a put option, you don't really have to monitor it too much. And then essentially most of the time I will be holding up until expiration. Sometimes I'll manage the position early, and we'll talk about that a little bit later on in this video. Again, I promise to teach you everything. So, let's just go ahead and sell this put option. It's unlikely that you'll have to manage this because Google has already fallen a lot. So it's unlikely to fall like even more. You can see right here that if I were to sell a put option for the March 21st expiration, the 180 put option right here, first of all, I'm looking at bid and ask, right? The bid is basically where if you were to sell the stock, you would have to sell it around the bid. If you were to be buying the stock, you have to buy it around the ask. Okay, there's a bid and ask spread because there's market makers on Wall Street that are providing liquidity. The liquidity here is, volume. The volume is 22. The market just opened up. It's like, a little bit after 9:30 a.m. as I'm recording this on a Monday. And the volume is still like pretty low for the day. However, the open interest is very healthy. Like 6,800 is really good. So there's a lot of open interest and demand for these options. So that's a really good thing. The bid-ask spread is like really tight and good. And the delta is actually really low. So my first trade here is going to be like a really conservative trade. Some of the trades that I'll have later on are going to be like SoFi, American Airlines, Archer, and etc. I have some more like names to trade, but this first name is just going to be really safe, passive income. So I'm going to go for the 180 put right here. Now I could also go for 185. This would be like a higher delta trade. So this is 0.39 delta. And in truth be told, like I could also do this because this has higher premium. It has 465 versus like $3, but there's a higher chance of getting assigned here. So both of these options would be fantastic. I already have a lot of Google shares, a ton of Google shares. So I'm just adding to my position. So by selling this put option right here, I already have a sizable position. So I don't want to sell like too many more puts that are going to be too aggressive. Although if I had no position, I would go for 185. So I want you to understand, if you don't have a position, you can go for one or something closer to the money, whereas I'm going to go for 180. So I'm going to click continue and I'm going to go for 5 contracts here. And I'm going to go for something closer to the bid. So I'm going to go for 2.9. I'm just going to try to get a high likelihood of fill because I respect your time and I want to make this video as short as possible. So there we go. I did get assigned. Boom. There we have it. That's the first trade. Let's put on the bottom of the screen $1,459.80. I've sold 5 contracts. That is the first trade that I have made. And so far, we're like a little bit over 10 minutes in the video. So I'm going to try to hurry up and keep going here on more trades. Next trade that I want to do is American Airlines. American Airlines is a stock that I've been trading for a very long time. In my Discord community, since I started Discord, I have every single session that I have done recorded since 2021. And like 4 years ago, you can actually like look, I was trading American Airlines. I've been trading American Airlines for a very long time. And that's because if you look at American Airlines, this stock over the past like 5 years, it's really not done too much. The stock has just honestly like gone sideways. Yahoo Finance is like currently kind of glitchy, but the stock hasn't really had that much activity. It goes up, it goes down, which actually makes it like an option seller's dream. It's really profitable to sell options on American Airlines and run something called the wheel strategy, which, at the end of the video, I'll show you more about the wheel strategy. But the wheel starts off by selling puts, and selling puts is like the best for American Airlines. So if I go to the 3-month chart right here, you will see that American Airlines is actually up a lot, but it's not at its like highs of like almost $19 per share. The stock has actually come down a little bit to reality, which makes it a really good opportunity to sell some put options. So I'll go to sell put. I can go for like a shorter term expiration just to give you guys some variety so you understand that you can go shorter term. And I'm pretty bullish on American Airlines, so I'm gonna go for a higher delta. The delta here is 0.38. Again, good open interest. The volume just started because it's like early in the day, and the bid-ask spread is amazing. So I'll go click continue and I'll place this trade. I'm actually going to do like 50 contracts here. So this would be like $465, pretty good. And this is like, safe, like risk management. It's not a big position. So I'm going to go for 0.31. Again, closer to the bid because I want to get filled right away and not waste any time in this video. There we go. So that's my second trade. We can add $479.40 to the bottom of the screen. So far, I have made that much money by selling put options. Of course, again, I do have to wait until expiration. So cash is in my account, but still going to be some time for this option to expire, which is actually not that much time, like 11 days, which is nothing. Next stock I want to cover is going to be SoFi. Now, SoFi is one of my favorite stocks. It has recently fallen below 15. Now we're trading for slightly above $15 per share. The volatility is really a good opportunity to jump in, and it's pulled back a lot. Like if I go to like 1 month, this stock has pulled back from $18 per share. You can actually see if I go to the chart, that the RSI was like really low when I was looking at the overall RSI. Like it used to be a lot higher, and that is actually trading for closer to like 80, the 80 level, like in mid-December. And now in mid-February, the stock is essentially, I think, coming back up. Like we saw that under $15 per share was just a little bit too cheap, and investors have started to buy it up. Now, something that I'm also like excited to buy SoFi is because sales growth has accelerated in the third quarter to 30% year over year. And the non-lending segment, it's contributing to a lot of its growth. So that's really exciting. And I'm a long-term bull. And I think that just based on the statistics, based on the facts, the net income was $61 million in the third quarter, up from like a loss of like 65 or 67 million from last year. So this stock has become like massively profitable, and like that makes it a really good opportunity to sell puts because the business is an uptrend and the stock has like pulled down like significantly. So you can see that I already have like a couple sell puts here, but I'm going to open up another sell put for the purposes of this video. Like I don't mind opening up more shares to show you guys and teach you on like how I would make money. Like I don't mind at all to sell even more puts. Like it's a high quality company. So if I go for the March expiration, which again is going to be like 30 days out, I'm going to go to sell put, and you can see that the options are like super juicy. Like 6% return on this option right here, essentially, which is really high. So I can go for like the 15 strike, which has a 43 delta, and the 14 strike has a 29 delta. So I'm going to go for the more conservative option. The bid ask is really tight, and the volume is actually like the best so far from all the stocks that we've looked at. So I'm going to go for the 14 strike, click continue. And again, I'm trying to make $5,000 or more in this trading session. So I will like, obviously I'm not going to open too big of a position. Position management is really important. I want you guys to understand that you can't put too much into one position. You still need diversification across put options that you sell, because diversification helps reduce volatility, right? If you have all your eggs in one basket, that's dangerous, right? So you have to understand that you should probably put like 5-10% of your money in a sell put position on a high quality company and have at least 10 positions in your portfolio. So if I go for 0.54 here, this would be $809. And it's a fairly small position. You know, it would be 20K. By the way, keep in mind that the money that you see here, the negative $20,000, is not actually how much like I can lose. I know it looks like extremely scary, and you're thinking to yourself like, oh my gosh, I'm going to make $800, but I can lose 20,000. Well, the max loss here isn't really correct. In theory, it's correct, but it's like calculating the stock going down to zero. It's just not going to happen. Like a high quality stock can't even fall like 50%. If you sell puts on like, you know, Apple, it's probably not even going to fall 10%. Looking at the max loss is really scary. And it would be the equivalent of like getting in your car and the max loss on you driving is you losing your life. You might not live today, okay? That is actually the truth. But most people still get in their car, they drive to work, and we still have to go about our day, still go to work and go to the grocery store, etc. So you see how like getting in the car is also a max loss of like your whole entire life, right? 100%. Well, that's the same thing here. Like the max loss is negative 20K, but it's like not going to happen, right? In fact, it's riskier to get into a car than like the stock going down to zero, because the stock would have to like commit fraud. And even if it committed fraud, it's literally almost impossible for it to go down to zero. So although this is really scary, I want you to understand that the statistics are actually a little bit different. And this option trade of selling puts is actually a lot more favorable. Yes, you're tying up the $20,000, but you're not really like at risk of losing the entire amount, because the worst that happens is you get put the shares and you just hold a high quality company. So this number can be really, really deceiving, and I just wanted to explain that to you. Now let's click review order and submit. Hopefully I talked a little bit and this still fills. Perfect, it did fill. So I got awesome, all 15 contracts. So boom, there we go. That was our third trade. Let's add $839.40 to the total amount of money that I've made so far. All right, perfect. Let's go into the next trade. Next trade I want to do is ACHR. So this is Archer Aviation. This is a really interesting company. It has massive long-term potential in electric vehicle takeoff, essentially, and they have secured partnerships with United Airlines and Stellantis. So what I think makes the stock good is it is smaller cap. It's a 4 billion market cap, and I do want to own it. And I do have 2 put options that I've already sold, and I'm already like up $769. But I do want a bigger position. It is up today, and I would like to own it. Like you can see here how it has really strong support at anything under $9. So I'm going to go to trade ACHR options, and I want to point out that I'm going to go smaller on this position because it's not the safest company, right? The bigger the market cap, the safer it is to trade a stock. And the smaller the market cap, there are some risks, right? It's a smaller company, but it's not super small. 4 billion in good industry and good, potential. I like that. I'm just going to keep the position to like a fairly small trade. The premium that I'm going to collect here is going to be massive. Like, essentially this is around a 6% return in 1 month, because like 8 times 6 is 48, and the premium here is like 52. So it's over a 6% return. And that's like a fantastic return. And the implied volatility is wild. The reason why the premium is so high is because the implied volatility is astronomically high as well. That's because there's higher risk for a small cap stock that has lots of volatility. The delta here is lower, which is 0.23, but I'm going to need a lower volatility because the risk is higher. All right, so each trade that you do, like if I do one contract here, it's going to be a very small amount. So like this is super small account friendly. This is like a very small account friendly trade where you're going to make 50 bucks and you're putting $746. Again, not all of that's at risk. Technically it is, but again, it's not going to go to zero. But you are tying up that amount of capital. So the return that you're going to get here is going to be like a 7-ish% return. I'll put on the screen right now, but I think 53 divided by 747 is roughly around like a 7% return, maybe 6.8% return, which is a really good return. What I'm going to do is I'm going to keep this position small. I'll do like 15 contracts, 15. And there we go. That's like a 11 grand trade. I like that. I'm going to go for 0.53 just to get high likelihood fill. Oops, you see the bid ask just changed a lot. So these options are a little bit less liquid. They have a little bit worse bid ask spread, but let's go for 0.51 and see if I can get filled real fast. So I submit it and there we go. I did get filled. 15 contracts. Perfect. That is the fourth trade that I've made. Let's add $764.40 to the total amount of premium that I've collected so far. Nice. The next trade that I want to go over is going to be Starbucks. Starbucks has had really good performance lately, and I do want to ride the momentum, although I don't really want to buy it at these highs because I made money from Starbucks going from 87 to 100. Like that was a trade that I had in my Discord community, but then I got out of it for 100, which I'm not perfect. I make mistakes, and like I got rid of it for 100. Now it's at 111. So I missed out and I want to jump back into Starbucks. Starbucks generated like over $3.50. It was like 3.55 in earnings per share in 2024, placing its stock PE ratio at around 22, which is a really good PE ratio. That makes it significantly cheaper than other consumer discretionary giants like McDonald's and Chipotle, although I like Chipotle a lot as well, but those trade at a higher PE ratio of over 30. So Starbucks has been a really good value compared to the competitors in its space. And looking at their China growth rates and how they're expanding into China, it's actually really strong. And they've had China grow 10% year over year in same-store sales. Same-store sales is super important. It just means how much are people shopping at the same store? Are they coming to that same store more or less? 10% growth is freaking amazing because when I was working on Wall Street, I was looking at margin expansion, same store sales, like these were big numbers and really important data points that I was looking at. And for Starbucks, it looks really good. So I'm going to go to Starbucks, type in here SBUX, and I'm also going to sell a put option. Now I got rid of this stock for like $100 per share or so. So let me actually look at my history. When did I get rid of it? I actually got assigned for 95. I did make money. I traded it a lot over the past and I have made money on it. So what I want to do right now is I want to get as close as possible to 95, but I'm not going to be able to get that. And that's fine. You can't always have it your way. Like psychologically, I would love to get Starbucks for 95 because that's where I sold it. But my average cost for where I got out of the stock doesn't really like matter, right? And today I need to make a decision. What can I get today, right? And it looks like it's going to be 105. Like 95 has no premium. It has 20 cents. So if I were to go to the 105 right here, the delta is actually really low. So this is like a super safe trade and it's Starbucks. So this has a really large market cap, low implied volatility. So this is a trade where I would personally go a lot heavier. I'm going to go for like, let's see if I go for 20 contracts. Yeah, it's going to be kind of a lot. Let's go for 15 contracts and just keep it standard. And I'm going to go for 1.03. I wouldn't call it greedy, but I'm going to go 1 cent above the bid and I'm going to try to collect $1,500. Perfect. That went through immediately. So awesome. That was the fifth trade that I had. I have one more trade. This fifth trade collected me $1,559.40. So I'm going to add that to my total income collected. I believe I'm around $5,000 now, but just to be safe, let's do one more trade. Let's do a trade on Tesla. So Tesla is obviously like a stock that I've been in for a very long time. I actually have a video where I put over $1 million into Tesla and it went up a lot, it went down. I'm still up like over 6 figures on Tesla, but at one point I was up like over $750,000. So I've given back a lot of my gains. I mean, it is what it is. I'm a long-term investor, right? Like I'm not gonna get attached to like short-term results. I'm looking at far into the future. How can I grow net worth? How can I grow income per month? And that's what I focus on with my clients as well. You know, we're trying to get consistency. So it's not about like going up fast and then losing it. that happened to me, and that's just the market. That's just the nature of the market. But every single period that I check, every single month, I want to be growing, right? So Tesla, I want to say that in Musk, we Trump, or in Trump, we Musk. I say that joke on YouTube, but it's true that Musk and Trump are friends, and I think that's going to mean a lot of good stuff for Tesla in 2025. Q4 earnings call for Tesla, Musk said that we're going to have an epic 2026 and ridiculously good 2027, 2028. That's based on artificial intelligence, full autonomous vehicles, and the Optimus humanoid robot products. And I think that it's wise to get into Tesla early, although it's a very volatile stock. So I'm going to be using proper risk management here. I do have a lot of shares already, but again, I want to point out it's important to not put in too much money in any one stock. Tesla on the technical chart is below the Bollinger Band. It is incredibly cheap based on statistics right now. The RSI is 36, very low. So I'm going to go to Tesla and I'm going to open up a small position because I already have Tesla. Again, I want to be reasonable to help you guys, small portfolios, medium portfolios, and larger portfolios. We're not going to put $1 million into Tesla. We're just going to go, small. Maybe I'll do 1 or 2 contracts. So if I go to sell put, and I go for something like, again, I think monthly option selling is the way to go. So if I go to sell put and I go for, honestly, like Tesla, it's at the bottom of the Bollinger Band. It really can't go that much lower based off statistics. I would be more than happy to buy Tesla at 340. So I'm gonna click continue here, and I'm just gonna go for like 1 contract for like example purposes and actually place this trade. And I'll review this order and I'll just place 1 contract. So nothing super crazy, but yeah, pretty good trade. I'm going to add that to the bottom of my screen. Hopefully now I'm above $5,000 at this point. Now, there you have it. You just saw me make this amount of money by selling put options and collecting option premiums. In the case of a covered call, there can actually be 2 winners. This is really interesting, but because the stock went up, you've made money. And because the person buying the call option will also make money because his call option's in the money. The only thing that you'll actually be like losing out on, if you can call it that, would be opportunity cost. So if the stock goes from like a 100 to 2,000, then you will have to still sell it for $110 per share. That's why it's important to pick the strike price properly. And again, I'll be showing you that when we go over the live scenario. I'm not perfect in picking the ideal strike price, but I do use technical analysis. I look at RSI, I look at Bollinger Band, and I look at moving averages to determine at what strike price do I want to sell the stock at. I also do my research to understand fundamentally what do I believe the stock to be worth, since this is a bullish strategy and you want the stock to go up ideally. So let's go over a hypothetical example before we get into the actual trading, because I think it's important for you to visualize and actually see on a chart how the position will work out if you were to open one. So let's say that Microsoft is currently trading for $410 per share right now. Let's say that you think Microsoft is at a high point. You don't really think the stock is going to go that much higher in the next 30 days. You're still bullish on Microsoft in the long term, but you want to generate some income. You think the stock has strong support. And it's really likely that Microsoft will be, somewhere around $415 or $420 per share. You're not sure exactly where, but you're just sure that the Microsoft isn't going to go much lower and it's probably going to go sideways or up. What you can do here is you can sell a 415 covered call option on your shares. Let's say that you collect $5 in premium. Well, here's what can happen. If Microsoft stays below $415, you're going to be, in pretty decent shape as long as Microsoft doesn't really go too much lower. So if Microsoft's at 400, well, you would lose $10, but the covered call would give you some cushion, so you would actually only lose $5. All the stock investors would lose 10, but you would only lose 5. If Microsoft goes to 415, well, you have to sell the stock for 415, so you'll make $5 because the stock went up. However, because you sold a call option, you still have $5 in premium that came in. So you've made a total of $10, even though the stock only went up $5. That's because you got $5 of upside plus the $5 of premium that you collected. If Microsoft goes to $420 per share, in this scenario, you would make $10 and the person that bought the stock would also make $10. This is because the person that bought the stock would go from 410 to 420. You who have sold the covered call option can only make money up until 415, but technically your break even is 420. And when I say break even, I just mean you're still profitable, but you won't make more than 420. you can't make more than the strike price plus the premium that you collect. So there is a little bit of a trade-off here with the covered call in the sense that you're protected more on the downside. You make good upside, but you don't make as much upside if the stock skyrockets. This is a really safe strategy, and I've seen it used by many financial advisors. I was talking to a financial advisor that was managing NBA client money. I've seen this strategy used by billionaires when I was working at Goldman Sachs. Folks that had 100 million, 500 million already. Now you're at the portion of the video where I'm going to do some live trading, and we're going to go over several stocks. I'm going to run a covered call on them and show you step by step what I look for, how I pick the stock, and how I pick the strike price of the option, and then how I manage the position until close. So the first stock I want to go over is actually going to be Kraft Heinz. I've spotted this opportunity because over the last 6 months, the stock is at a very low, and over the last 1 year, it's also at a 52-week low. So the stock has traded down for the past 1 year. It's actually down 19.75%. I like Kraft Heinz because it's a Warren Buffett company, and Kraft Heinz business is kind of hard to disrupt because it sells ketchup and food products. So if you take a look at the PE ratio, it's 26, and the beta here, I want to point out what beta is. Beta is like how sensitive the stock is to the stock market. So if the stock market moves, let's say 1%, then this stock is going to move 0.5%. It's half as sensitive as the stock market is. So it's a very low volatility play, and the market cap here is 34 billion. I like that the dividend is 5.46%. So what I'm going to do, if I go to chart right here, it's basically not very hard to tell that since the stock is at a very big low and well below the moving average as well, the moving average is 29.55, that I can easily sell a covered call option. So what I'm going to do, and because I am making this video special for you here, I'm actually going to open up 100 shares, and I have to buy 100 shares first. But of course, if you already own a stock and you have 100 shares of a stock, then you can sell a covered call option on any stock that you want. Only thing that you have to have is 100 shares of that stock. If you have 99 shares, you can't sell a covered call. And if you have like 173 shares, I would tell you to buy 27 more shares so you have an even lot size of hundreds, right? So 200. So you can sell 2 covered calls. And to be honest, this is a trade I actually like, so I can buy 500 shares here. So I'll go to review order, and then I will click buy. So obviously buying the shares is really easy. All you have to do is just place an order to buy the stock at market price, and then you'll get the stock, right? So I just purchased 500 shares and I spent $14,000. So far, I'm not going to count that in how much money I've made because that's just stock that I hold, right? So if you hold stock, the whole point of a covered call strategy is to generate income on stocks that you already have or stocks that you just recently bought. Buying the stock doesn't really count towards the premium that you collect. I'm only going to be counting premium in this video. And of course, I do want to let you know that the premium that I collect, it's cash in my account, but I still have to wait until expiration for, that option to actually expire. So now that I have 500 shares of Kraft Heinz, what I'm going to do, I'm up already $13. What I'm going to do is I'm going to go to trade Kraft Heinz options, and I'm going to go sell a call option. Now, for a really slow stock like Kraft Heinz that has low volatility, there's nothing wrong with just going out a lot farther in the future. Maybe it's 2 months, maybe it's 3 months, something like that. So you can see here how the closest strike price is going to be 30, and the delta here is 0.39. The implied volatility is pretty low, but again, we're just looking for consistent income. When I do covered calls, I'm looking to capture in premium and hold high quality companies. Kraft Heinz is a high quality company and it's at a 52-week low. So what I see happening is that the stock could rise to $30 per share. And this right here is a covered call at 30. So if Kraft Heinz goes up, well, we're still going to experience a gain from the current price of $28.91 to $30. So you get a $1 gain, plus you also get the premium here. So the premium here is $72. What's awesome is you can kind of say this is a triple income play because the stock can go up, it pays a dividend, and this covered call also brings in income. So you have 3 ways to make money with a covered call like this. So this is a 30 call. It's going to expire on April 17th, and I'm going to click continue, and I'm going to do the 5 contracts that I have since I have 500 shares. So I'm going to input $73 right here. And again, this is not going to be a lot of money, but hey, it's good, consistent money. So I placed that trade and boom, we got filled. So we'll put on the bottom of the screen here, $369.80. So that's how much we've made so far. And that is the first trade, which is a low volatility trade. Next stock I want to go over is going to be SoFi. Now, SoFi is a stock that I really like for a lot of reasons. So I've covered it in several of my videos. Essentially, I think that the business is disrupting the dinosaurs of which are banks, right? If, when I was working at Goldman Sachs, their systems were very like old, okay? And a lot of banks have a business heavy model because, they have physical stores, they have, a lot of employees. SoFi is really revolutionizing that because they're combining technology and finance, and they're a fintech company. So what makes fintech amazing is that the margins of the business are higher, and the market cap is 16 billion, which is like really low. But if this company, continues on the trajectory that it's going at, right? Like last year, they lost money. This year, they made money. So they've just become a very profitable company, and I see them growing a lot more. So just to point out, the beta is 1.6, which means that if the market moves up by 1%, this stock is going to move 1.6% on average, right? The PE ratio is not like cheap. It's not Kraft Heinz, but this is a fast growing company. So what I'm going to do is I'm going to buy some SoFi stock, and then I'm going to do a covered call on SoFi. Now, I actually don't have that much SoFi stock, so I'm going to go a little bit heavier and buy a good amount of shares. So I'm going to go to shares here, and I'm going to buy 1,000 shares. You can see here how this is still like super small account friendly. It's only $15,000. So actually I want to go a little bit heavier here and do 3,000 shares personally because I want more SoFi, and I think it's a really high quality company. And just taking a look at the technical analysis, by the way, I should really point that out. That would be really important for you to understand. If you look at SoFi, it's like towards somewhere in the middle of its Bollinger Band. This stock was an $18 stock not that long ago, and there's like a strong bottom at $14. So you can see there was like a double bounce. So a double bounce basically is a signal that as soon as a stock reaches a certain level, there's a lot of support for the stock. There's a lot of investors that say, hey, I would like to buy the stock at 14, and I think it's cheap. And you can see that based off of the volume. And actually here it's really interesting because when it sold off to 14, there was a lot of like red volume here. So there was a lot of sellers. So even the sellers only want to sell above $14. They don't really want to sell below $14 because the seller probably realizes, well, a lot of sellers, the market is based on supply demand. Sellers realize that, it's not worth it to sell the stock for under $14 since it is a good value at this level. That basically happened once and then twice and 3 times. Like there was several days of like really good support for the stock. So going back to SoFi, I bought 3,000 shares, and now I'm going to sell a covered call option. The point of a covered call is to generate income, but in a covered call scenario, you also want to give yourself upside for the stock to move up in most cases. So in one scenario, you can just sell covered calls for aggressive income and only collect income, no upside. For me, I prefer to give myself some upside, especially with SoFi. You can see how the stock seems to be coming back up. And let's just say that we think that the stock will go back to this point, which is around, $16.50 roughly. So what I can do is I can go to trade options, and then again, I'm going to go to sell call. And for SoFi, since, there's not a whole lot of events happening, usually like a stock moves tremendously because of earnings, but SoFi already had earnings. Therefore, I feel like, very safe to go out for an April expiration. Again, you can go for like weekly expirations. You can go for, 3 weeks, 4 weeks, 6 weeks, and you can even go as far out as like 2 months or even 3 months. You get paid in direct proportion to time. So a 1 week option might be $1,000, whereas a 1 month option might be $4,000, and then a 2 month option might be $8,000. The premium that you collect is going to be more or less proportionate to like how much time that you're going out. So April 17 was like 2 months out. That means that I don't have to do that much management. That means that I can basically open up this position and just let it ride. So in terms of like managing this position, it'll be very minimal. And I'll tell you a little bit more about that after I place this trade. So I'm going to go for the 17 strike right here because for me, that gives me like the best balance, right? So I can go for like 18, but the delta is not bad. It's 8. However, right now I prefer a bit more aggressive on the income side. So the 17 strike price has a 36 delta. It has volume of 700, a really good implied volatility of 54, which is like double Kraft Heinz. That's a lot. And the $75 that you can collect here in terms of premium is a tremendous amount. It's like 5% or almost 5% on what you're investing. Also, I just want to point out that the max loss here says unlimited. That's not unlimited. It says unlimited because it doesn't understand that this is a covered call. Even though it says covered call, Robinhood is a little bit confused. You can't really lose like anything on the covered call itself here because you have the stock. That's why it's called a covered call, because the stock that you have, when you sell a call option, it's covered. So if it goes above, you'll lose your shares. But the call itself, no matter how much it's negative, it'll be more than compensated for the stock. So what I can do right now is if I hit continue here and I do like 30 contracts, contracts. This is actually going to be significant premium, and I'm trying to hit my goal of making over $3,000 in this video. So that'll contribute significantly to that. So if I go to 0.75, click review this trade and submit, then we should be filled. Yes, we got filled. Perfect. So I'm going to add $2,278.80 to the bottom of the screen. That's how much we've collected. Now I'm going to trade one more stock, and let's see if we can make money and collect enough premium to hit me over the $3,000 mark. Next stock I'm not going to buy a whole lot of is Snapchat. I already have a Snapchat position, and I actually already have two different strategies running here. I have the covered call strategy, which is what I'm teaching you in this video, and it's $12 covered call. And so far it's making me really good money. As you can see, actually I'm up $3,725. I also sold some Snap $10 puts. If you want to watch my live selling puts video, I recently made that as well. I'll have that at the end of this video once you finish this one. It's also a really good video where I challenged myself to make $5,000. So here, looking at Snapchat, what I'm going to do is I want to show you the technicals, of course, and why I want to invest in Snapchat to begin with. So basically, you can see again that I'm picking a stock for the third time that's not at the top of his Bollinger Band, a stock that has sold off and has a clear bounce from below. So here there's a clear bounce from 1050. Here there's another bounce of like 1070. Here another bounce at 1050. So there's like 3 times where the stock really bounced, and now it's approaching that essential bounce zone again, which is called support. Okay, so the support is really strong for Snapchat at 1050. So I know that there's very little downside because, again, for a covered call position, the only way you actually lose money is if the stock itself goes down, right? So if the stock goes down, I mean, you will lose money, but you're still better off than, a regular stock investor, because the covered call is premium. It actually gives you some cushion and margin of safety, but it's not an issue if you like the stock anyways and you're ready to hold it long term. Then that's fantastic. You don't really mind any short-term fluctuations or volatility because you're in it for the long term anyways. So that's like the reasoning for a covered call. Snapchat has a good pattern. Now, to talk briefly about its business, for me, like, Snapchat is social media. Social media is super powerful. Like, obviously you're here on YouTube, TikTok, super powerful. Snapchat has a really young generation on it. And just in general, like, the economy right now is really based off of attention, and, personal branding and content, and all of these things are actually really huge money makers. So I think that Snapchat will continue to do well. And I think the ad cost for Snapchat, they make money through ads, just like it makes money through ads. I think that's going to go up, especially as our demographic gets older, and Snapchat skews a little bit younger. So I personally don't use Snapchat, but I think that, this is one of the few companies that I'm willing to invest in without actually being like a real user of the product, because I understand how the business works and I'm really bullish on it in the long term. So what I'm going to do is I'm going to double down on my position, which is actually really smart anyways, because I'm down 11% on my position. So what I'm going to do is I'm going to go to shares. This will actually be really interesting for you. You can see I have 2,500 shares. If I buy 2,500 more shares, you'll actually see my average cost go down right now. So my average cost right now is $12.21. And Snap is currently at $10.77. So once I buy this, my average cost will probably be somewhere around like $11.50, $11.49. I was gonna say $11.50. So it's $11.49. So I was like a penny off. And that was just like me guessing. But obviously I did the quick mental math and I thought it would be around $11.50. So that's actually wild. That's amazing. So the average cost went down, and obviously my total return went from like negative 11% to like roughly half. It should be around like 5.5%, 6%, which is like where it's at right now. So now I have 2,500 more shares of Snapchat, and I can go ahead and sell some covered calls. So again, for me, it's all about like showing what I'm doing, why I'm doing it. And this is exactly what I explain in my one-on-one coaching. It's also what I explain during my group Discord calls when I'm trading live, which I do every Monday and Wednesday. I always try to explain why I'm doing something so people aren't like just jumping into a position without understanding it. And that's really important for me to be a good coach. So when I go for expiration, I can go for something like shorter term, something like March, because I think I'm going to hit my $3,000 goal in this video. And if I go for an option like 11, so 11 wouldn't necessarily be the best because my average cost is $11.49. So I'm going to have to go for something like the $12 expiration. So if I click continue and I go for 25 contracts, which is how many shares I have open, I go for 0.3. Okay, it's going to be 749. So I think I'll be past my goal. So if I click continue here, I got filled and I made $774. Let's add that to the bottom. And those are my 3 covered call trades. Now, there you have it. You just saw me make this amount of money by selling call options and collecting option premiums. Now, some of them haven't expired yet, some of them will expire soon, and some have a long time to go. But I understand that as a beginner or intermediate trader, you might be thinking, well, those option premiums are nice, but how do I actually manage those positions? Well, it actually depends. So for the Kraft Heinz trade, you don't actually have to manage the position much since Kraft Heinz has a very low volatility. For the SoFi trade, what I would personally do, if SoFi ends up rising a lot and the stock ends up going towards $18 per share very quickly before expiration, obviously, but it happens in a short amount of time, in that case, you would want to roll the option. So for SoFi, you basically have two things that you can do. You can let the shares sell off, or you can basically roll this trade. Now, since it's already expiring in April, if the stock were to go to like $17 per share in like a month, I would probably not do anything. But if the stock went to like $18, $19, or $20 per share, which again is not likely. But if it does go to $20 per share, then what you can do is you can roll the position higher by closing out the 17 call and going up to 18, 19, or 20. Now, you may pay a credit or a debit, and I'll leave you guys the link in the description for a rolling video that I have, because rolling is a case-by-case basis, and there's a lot to learn in rolling that I can't cover in this video. But simply said, when the option hits the strike price, I think about moving it higher and rolling it. Now that you saw me do the basic live, let me show you some advanced techniques that you can use with put options that are a great way to manage your risk and maximize your income. I want to show you how I intentionally sell high delta put options because I get aggressive income and I actually want to get assigned. Okay, I actually have this position on Palantir right now. This is a really interesting position because I sold 150 options right here on the Palantir 95 put. And this is actually an earnings play. This is gonna be really interesting for you. I made this play February 4th. Today is, I'm recording this example February 7th. It's been 3 days. I made $7,716 on aggressively selling this put option. I sold this put option because I intentionally actually wanted more Palantir. I had no idea that Palantir after earnings would shoot up even more. So I'll show you what Palantir was trading at on the 4th when I actually placed this trade. So if I go back to the past 1 week, you'll see on the 4th, Palantir shot up to $102, maybe $103, right? Right when the market basically opened up, we had Palantir trading in the, looks like the 102. Actually on February 4th in the morning at 10 a.m., which is probably when I made that trade, around 10 a.m. I had my Monday and Wednesday coaching calls 10:30. So when I made that live trade, it was between 104, 105, right? So I intentionally sold a 95 put option, which is actually not even that aggressive. I actually wish I would listen to my own advice. Sometimes I'm very conservative, so whatever I think I want to do, I do it a little bit less. I say on my call, hey, I want to go aggressive at the money, but I still went a little bit lower. But this trade worked out like crazy. So it was at 105, and I intentionally wanted to get into Palantir. I intentionally sold a put option at 95, and I sold a lot of them. This was a big position, even for my big portfolio. So 150 contracts at 95 is actually $1.4 million. I went $1.4 million this week on Palantir, okay? So this was obviously not that big of a return. I did use margin. It's a little bit of a separate conversation, but the whole point is I aggressively sold puts. I wanted to get assigned. I was okay to get assigned because I had most of the cash. I had a little bit of margin on this position, but most of it, I had the cash available, okay? I actually was planning to take assignment of 100 contracts and 50 I was going to close if they went into the money. But here I did all 150 contracts. I made $7,700, and this position decayed very, very quickly as Palantir went up. So on the 4th, well, here it is. This was before the 4th, before earnings happened. It was around 50 cents. I sold it for 51 cents, as you can see here. My average credit is 51 cents, okay? And I sold it right here. And essentially, it declined. It went from, 51 cents, it went up a little bit here in 93. I was, maybe I made a mistake, but nope. I stayed the course, not a big deal, right? There's a very small bounce. Although it doesn't look like a small bounce, this takes a little bit of patience because it went from 53 cents to 83 cents. Trust me, this doesn't look big on a chart here, but that 30 cents, it's like what, $4,000 or so. But I stayed the course, I wanted to stick to my strategy. Obviously, I opened up a sell put. I was gonna hold it until expiration, and it fully decayed and this option actually expires in 12 minutes. I'm actually happy that I'm recording this video right now because I've had so many successful trades. I don't always put them on camera. I'm trading them Monday and Wednesday, and usually on Fridays. If everything went well, I don't record my results on a Friday. This is an example actually of a just typical Friday for me, another successful trade. But this trade is significantly bigger, and I did not follow any risk management or position sizing here because, for me, this position would make sense. But if I were saying this to the students, I told them, no, you cannot make this big of a trade, because risk management would state that you should go no more than, about 10% of your portfolio in any one stock position. Obviously, I believe in Palantir, and I personally took the risk to go higher into this position because I had complete belief and want to have high confidence, just like you guys saw with my Apple trade. When I have high confidence, I just go in hard. I go in really hard. So this was an example of actually intentionally selling a put option with a bit higher of a delta here. And I was completely okay to get assigned, but it is going to leave my account. It's going to expire here in the next 10 minutes. To recap on this trade, I'm going to show you one more trade, by the way. I'm going to show you an example trade of something else that I would do right now. We'll use NVIDIA for that example, but you can see how the 95 sell put, 2.7 expiration, sold on February 4th, and yeah, made really good money there. The only thing that I wish, which I kind of messed up here on, was that I have full belief in Palantir, so I should have went for the 100 put option. And if I went for the 100 put option, I would have obviously made a lot more money. But, hindsight's 2020. I can't be right on everything and 100% predict the future, but I did very well on this trade. So I do want to show you now how I would intentionally sell puts. And I actually have these positions open. Actually, you'll see right now. So I have several positions open here on NVIDIA expiring on February 21st, many of them expiring February 21st. Let me explain to you the positions that I have here. And this is actually really freaking beautiful because I have a 127 put, I have a 130 put, and when I had my Discord coaching call, my students asked me, well, this position's in the money. Do we close? I said, no. Take it easy. Relax. We're gonna be all right. So I said relax because 127, 130, I believe NVIDIA is easily a $150 stock, $180 stock in 2025. And I'm happy to own it, right? I don't know in 2025 or not. I'm bullish on it long term. I think AI demand is gonna be massive, okay? AI demand is gonna be very strong, and I'm very bullish on AI in 2025. So it's very interesting because even this week, this option has just went above my strike price. So it's been deep in the money. I need to point this out that the stock was at $112. I'm sitting on 130, 127 puts. Believe me, this position was down a lot. Like many people would cut their losses and say, I'm out. I can't handle holding NVIDIA that's down so much. I can't hold it no more, okay? Those people don't understand long-term investing. Those are more of the panic types, okay? That's bad, okay? My one-on-one coaching, I always say, you gotta, this is right here is the most important thing for trading, okay? You're your worst enemy. So when it comes to intentionally getting into NVIDIA, I would be very happy. In fact, I could show you, I'll sell some more options right now on NVIDIA. I'll show you live. Let me actually sell some more fuel for the fire for the 127. So this would be at the money. This is a very close to the money, super high delta, but I have no concern because I want to get assigned NVIDIA. So you see NVIDIA's this is 10 contracts, up, $150, but I was down a lot. So if I go to the 1 week here, you can see here that this was worth $12. Now it's worth $3. Okay. So I was down 12 grand, right? Now I'm down. Now this is worth $3 grand to buy back. So I made $9,000 this week, or I made back the $9,000. I didn't make the 9, I made back the 9 that I originally put out because I sold this option for $3,500. But check this out. I can just simply go to sell to open and sell to open 10 more, no problem. I do have a big NVIDIA position, I'll be honest, but hey, for the purposes of this video, so I eat my own cooking. I go hard on what I believe in. I'm gonna go for so sell to open. So if I'm selling, I'd be going closer to the bid price. So you can see the bid here is 3.3, the ask is 3.35. I'm gonna go for the bid. I'm gonna click continue, submit. This is gonna tie up a good amount of collateral, and boom, I got filled here. I collected $3,299.60 after fees. So this is actually $3,300. Okay, it's $3,300. And I added this to my position just right now. So this is an example of me going for high delta. I actually didn't show you the delta, so I apologize about that. Let me go back here and show you the delta real fast. The delta here is that it's actually not that high. I thought it was going to be around 42, 43, but it's around 38 delta. You see here the 0.38 delta, and I'm good with that. You can see the theta is a 0.15, so I'm making $15 a day with this option expiring. Obviously, NVIDIA is very volatile. This volatility has been very, very high, and that's what makes this a fun stock to trade. It's profitable, huge opportunity on NVIDIA, and I've made a lot of money on NVIDIA. I have 7 figures in NVIDIA, so I just added more, and now I have a really big, even bigger size position on NVIDIA. This is an example of how I would be selling puts to enter a stock that I already like, and I'm happy to sell high delta puts. I have one more position I want to show you real fast. I had a lot of experience as a software analyst, a tech analyst, but I also really like restaurant stocks. Chipotle is one of the restaurant stocks that I have, and I specifically have 1.67% of my portfolio in Chipotle. Not a huge amount. Again, I'm using proper risk management on Chipotle stock, but you can see right now it's at $57 per share. I have some options here expiring at the 55 sell put. Now I quickly want to open up maybe one contract here to show you how I would also sell puts that are maybe even more aggressive, even more than the 38 delta example that you just saw. I can go to sell put, and I can go for a short-term put. So I can go for a 1 week out put, go really short-term, and then go more aggressive, very aggressive at the money. This would be right at the money. And I'll show you an interesting example. You can actually, you know what? I want to show you 2 things real fast. I'm actually going to do both of these trades, okay? I can do a 58 and I can do a 57. This is a never before seen strategy. I don't think anyone talks about this, all right? I don't think I've ever talked about this strategy, but I want to really teach you the deep foundation here of selling puts that are in the money and a little bit outs of the money. So this right here is a good example of the 58 being in the money, the 57 being just slightly out of the money, basically at the money. And I can sell both of these options, okay? So I can sell the 58 here. You see the delta is 60. This is an in the money put option. So I'm already starting off with it being in the money. The return here is 2% in 1 week. This is a phenomenal return. And it's a high return for sure because it's in the money. You're going to get assigned 60% of the time. Now the 57 put here has a 42 delta. So when I say in this, training example that I want to show you something that has a high delta, this would be a good example. The 57 put here has a high delta. It's not in the money, but it's a high delta. So I can actually execute on both of these. You see the difference here is the 58 actually has a lot of volume. It has 2,500 in volume, good open interest, 2,800. Here, the volume is lower and the open interest is also a lot lower. I'm actually not sure why these 2 options that are so close to each other have kind of a little bit of a discrepancy. The bid 66 and the ask a 70, this is a $4 difference. Here, the difference is $6 with 118 and 122. I would say that's still pretty good. Implied volatility is about the same. Obviously, it's the same stock. So I can open up both these trades. Again, there's no secret formula to what's the best strike guaranteed. No, it's what is the best given your view. My view is Chipotle is slightly bullish. Chipotle's actually been going sideways, which is not a bad thing, okay? When a stock's going sideways, this is a great opportunity to sell put options. I actually have one more sell put option idea I have for you. So let me click continue here though, real quick. And then, yeah, I'm just gonna go for one contract here. Although I do have 2 options selected, that means I will be selling 2 options right now. So let me go for 1.82. I just wanna hurry up. Obviously, I could go for 1.85. I can go for a lot higher. It looks like I actually do not have enough buying power, so I actually have to deposit funds here. Let me go to edit. Let me just make one of these trades because I'm recording this on Friday. I have a lot of stuff that's expiring, so I don't actually have enough money to make either of these trades. So I'm going to clear up some funds real quick. You're actually going to see how I clear up some funds. So if I go here and I go to my total return, I'm going to clear something up so I can actually make the trade for you and fulfill on my promises here. I have Ebook here, which is a Bitcoin ETF. I'm up 13,000. Palantir. I have Apple covered calls. I have a lot of things I'm up. So I actually have a very easy job right now. I'm just going to close whatever's up over 98%. These 2 do close or expire today. So I don't know if I want to close them out. I think I'm just going to go for Apple because Apple, I have a little bit of time left here and is actually going to be a really interesting example for you. So actually what I'm going to do here, and this is actually from the last, section on covered calls. I need to close out this covered call to get some available capital. Closing out the call side of a covered call actually doesn't save me any capital. It only increases, I'm buying something back, but the shares I'm not going to touch. So what I can do here is that I can roll this covered call for income and create enough income for me to do one Chipotle contract here. So the market just closed. I won't be able to do this, but what I wanted to do, and I'll show you the example. I can't actually place the order, but this is what I was going to do. I was going to roll this position. I will have many more examples that I promise you, but yeah, I'm a bit disappointed that I can't do this one. But what I was going to do was I was going to go from February 21st to March 21st. Okay, so I was going to roll out by 1 month, by 30 days, and I was actually just going to roll just at the same strike price. So I was going to go from 240 to 240, and if I click right here, you'll see how I get a total credit of 36.72, which is actually not enough money to do the Chipotle sell put, because the Chipotle sell put at 57 would be $5,700. So I actually need $5,700. So I would need to roll to this right here, and this would do the trick. And this would be a perfectly fine roll because I would go from 240 down to 235. Apple's at 227, right? So I would be fine for this, this covered call will still be an out of the money roll. I would add some time to it. I would collect $6,500 in premium, and then I would have enough money to do the Chipotle sell put. But I know, I'm sure you guys believe me, the sell put is not a big deal, but the market's closed. So in our next example, I'll have more examples for you, plenty more examples when the market doesn't close on me. But I had a lot of coaching clients today and a lot of students that I was helping. But yep, let's continue on with this course and continue to learn. Now, this is where it gets really fun. Let's go over my favorite income generating strategies, which are all about using options to create a steady stream of income and cash flow. We've already talked about two of the most popular strategies, covered calls and cash secured puts. There are many ways you can combine these strategies together to make almost unbeatable strategies. And the first one, which is my favorite, is the wheel strategy. The wheel strategy is one of the best ways to generate passive income using options while still maintaining control over stock ownership. It's a strategy that works well for people who want to build wealth steadily over time, whether that's for early retirement, financial independence, or just creating an additional income stream. The beauty of this strategy is it's simple, repeatable, and reduces risk compared to a lot of other option strategies. Instead of gambling on short-term stock movements, it focuses on getting paid to buy stocks at a discount and getting paid to sell stocks at a profit. It's a way to turn stocks into a cash flowing machine. And the best part is that once it's fully understood, it becomes a cycle that can run over and over again indefinitely, lowering your cost basis, creating income, cash flow, getting in early and profitably into a stock and having a really optimal entry, having a clear exit point. It actually does a lot of that for you. The strategy itself is broken down to three main steps. Step one is selling a cash secured put on a stock that's worth owning, a stock that you want to own anyways. Step two, if assigned, you buy 100 shares of the stock at the strike price. And step three, you sell a covered call on the shares that were assigned to you. Because why hold on to shares and not use shares to create income? So the wheel strategy combines selling puts and covered calls together into one system and process. If the shares get called away, you go back to step one and start the process all over again. This strategy doesn't rely on any stock, massive movements, doesn't require the stock to move up or down a lot, or any market timing, or predictions of earnings reports, or anything like that. It works best on stable, slow growing, or even medium growing stocks, or even slightly bullish stocks in bullish markets, because the wheel strategy actually works in bear, bull, and neutral markets all equally as well. There are some trade-offs, of course, and we'll go over those trade-offs. I'm going to be showing you examples as always. After I cover some of the theory, I go over real examples and some trades where I will be running the wheel strategy, showing you examples of that. One of the biggest reasons, though, this strategy works so well is that it forces traders with discipline. The wheel strategy, when you sell an option, you're looking to get assigned, and after that point, you're looking to sell covered calls and generate income. Instead of just buying stock randomly, every trade is planned ahead of time. Every strike price that's chosen is intentional, and it ensures that the stocks are only being purchased at a discounted price instead of paying the full market value. This eliminates FOMO, or fear of missing out, and buying something which is a lot more expensive than it should be. It's also a foolproof strategy even a beginner can easily start running and be very profitable at, because the wheel strategy basically forces you to get a much better price than what the stock is trading at in the market by starting off the strategy with selling a put. Now, here's why this strategy is so effective. It creates three different profit opportunities on every trade. First, collecting premium from selling a cash secured put, then collecting premium from selling covered calls, and then potentially making a profit on the stock itself if the shares appreciate in value, and then you get assigned. If you get assigned, you sell your shares for a higher price than your average price and the average cost that you got into the option and the average price that you paid. So you have 3 ways to make money. Instead of just buying stocks and hoping that they go up, this strategy generates income every single month, no matter what happens in the stock market. This is why the wheel is such a powerful tool for passive income. Even when the market isn't doing much, the cash flow continues. The key to making this strategy work well is choosing the right stocks. The biggest mistakes people make when running the wheel is selling puts on a stock they don't really want to own. They don't actually want to own it. So when it goes down, they're not really happy with the wheel strategy. The whole point of this strategy is to get paid while waiting for the chance to buy shares at a lower price. But if those shares end up being assigned and the stock turns out to be a bad investment, it completely defeats the purpose. Only fundamentally strong stocks with steady long-term growth should be used for the wheel strategy. Stocks like Apple, Microsoft, Nvidia, Tesla, these are great choices because they have solid financials, strong revenue growth, and they have historically done well over time. You can pick any blue chip stock which follows a good volume, has a good bid-ask spread, and has a good brand that you personally believe in. I just gave you some examples. You can feel free to use these strategies that I'm teaching you on any stocks that you deem to be good long-term opportunities. Avoid speculative stocks with too much volatility. Avoid penny stocks and companies with declining financials. This is a must. Now, let's go step by step and go through selling a cash secured put to begin this strategy. This is the first part of the strategy, and it's where income starts coming in. Instead of buying a stock outright, a put option is sold at a strike price that's lower than the current stock price. This does 2 things. First, it generates premium upfront, which is real cash that's collected instantly and kept no matter what. And second, it sets an intentional entry point for buying the stock, which is lower than the current market price. This means that the stock drops and the shares are assigned, they're bought for a discount. For example, let's say that Nvidia is trading at $104 per share and a cash secured put is sold with a 130 strike price that expires in 30 days. The premium collected for selling this put is $3 per share, meaning 300 in cash is received immediately. Since each contract represents 100 shares, then that means 300 total, right? At this point, there are only 2 possible outcomes. Nvidia stays above 130 by the expiration date, or the put option actually goes down and goes into the money, and then you are assigned the shares and you must buy the shares for 130 per share. However, because $3 per share was already paid and collected from the buyer, they paid, you collected, the seller, and you collected that put premium, your actual cost basis is not 130, it's actually 127, which is the 130 strike price minus the $3 of premium you collected. This means the stock was acquired at a discount and the next phase of the strategy begins. Now that the shares are owned, it's time to move on to step number 2, selling a covered call. This is where another layer of income is generated, turning the shares into an asset that continues paying even after they've been bought. The process is simple. A call option is sold at a strike price that's above the current stock price. This means if the stock rises and gets called away, it's sold at a profit. If the stock stays below the strike price, the call option expires worthless, and the premium is kept and another call option is sold the very next month. Let's say that Nvidia is now trading at 128 per share after being assigned for 130. A covered call is sold at the 135 strike with an expiration of 30 days away. The premium collected for selling this call is $3 per share, meaning another $300 in cash is received instantly. Again, there's only 2 possibilities of outcome. If Nvidia stays below 135 by expiration, the covered call expires worthless. The 300 premium is kept, and another call option can be sold for the next month, continuing the cycle of generating income. If Nvidia rises above 135, the call option gets exercised and the shares are sold at 135. Since the shares were originally acquired at an effective price of 127, an $8 per share profit is locked in, which is a total of $800 on top of the premium collected from selling the put and the call. At this point, all shares have been sold and the process resets back to step number 1, selling another cash secured put, and so on. The wheel continues turning, generating cash flow month after month, while also creating opportunities to buy stocks at lower prices and sell them at higher prices. All right, guys, let's go over my portfolio right now and take a look at different wheel strategy positions I have open right now. All right, so I'm going to go over several different positions, and in fact, a lot of my positions are actually the wheel strategy. Either a sell put position or a call position that I have is most likely the wheel strategy. So let's go one by one. I have many examples. I did want to start off with one that I actually completed. So I'm going to show you some that are in the process, some that I have completed, some that I'm running on the put side and the covered call side. So I'll show you step by step basically everything that you have to really understand. First stock I want to go over is American Airlines. I don't have any shares because I've successfully exited the wheel strategy. And what I want to do is actually go over my history. This is going to be really interesting because very few traders actually go over their history, and I want to show you the wins, losses. I'm going to be reviewing this with you because I know I've been running the wheel strategy a lot on American Airlines. So we're going to look at a lot of my history. Bear with me. You might see some different option strategies. We're just going to go through maybe something like the past year. So let's let this load and let's go over, for example, here. Let's just start here. Okay, it looks like I had sold some call options at 11.5, okay? You can see how I bought them back. You can actually see the successful option wheel right here because I sold them for $5.40 and I bought them back for $30, so I made $510. And then you can see here how I'm running the wheel because, I wanted to get more shares, it looks like. And I'm just remembering a lot of this. We're gonna go over a lot of my history. So right here, you'll see that I sold American Airlines 9.5 puts. I collected 160 here. I did a limit buy, sell, American Airlines 10.5 call, and you can just see a lot of sells, okay? And whenever you see a buy, almost all the time that buy is for, like $6 or something really small, like $10. So it looks like I sold 10.5 puts here for November 2024. You can see here I got assigned. So I got assigned here on my shares. So I sold at 10.5, but you can see call assignment at 11. So essentially I sold at 10.5, I got assigned at 11. This is a short amount of time. This was from November, well, it looks like I sold this on September 25th, and then I got assigned around, so like, 3 weeks later I got assigned. So that was like $500. American Airlines buy, sell, covered calls. So there were some canceled contracts. If it's canceled, that just means that I didn't get the price that I wanted. So whenever you're placing an option, there's a bid and ask spread, right? And if I'm not getting what I want and it's going too low, if I'm selling an option, then I'm going to keep playing around with it. So you can see that I didn't end up executing here. Here I some canceled orders, but I tried 2 times and then I actually got filled here for 100. But you can just see it's a lot of sell puts, and there we go. I got assigned again at 14. So I was selling puts, under 14, it was 10, etc. And then I got assigned many times. So maybe that's not as clear. So let's go over some examples that are still open and still in the process, because that's going to be more indicative of what's actually going on. So here's Apple right now, $227 per share. And I don't have any sell put positions actually because they have expired. So if I go to my history on Apple, let's go and see where I sold the puts. You can see I sold a put for late January. January 28th, I sold a put. I collected $2,555 and it filled, but I didn't get assigned. So the wheel strategy is successful. I wanted Apple, but it didn't go down to 235. So essentially it expired, right? So this $2,555 is mine to keep. This was a Leap covered call. So that one I sold and made like $40,000 on. Here is me running the wheel strategy. I actually did get assigned at 235 here. So let's see if I click into this, if it'll give me more details. I sold 10 contracts. The date was on the 17th. And I got assigned on the 17th. And that's why you'll see my portfolio right now. For example, I got assigned at 235. If we go back to Apple, you'll pretty much notice that I'm doing covered calls right now because I've already successfully gotten to the wheel strategy. So you can see right here that I have 240 call options. I have a 240 here and a 240. So I have 240 for February, traditional expiration, and then 240 for April traditional expiration. And as you just saw, I sold 235 puts and I did get assigned. So my average cost is 190. So my entire position is pretty big, but I'm still running the wheel strategy even though I already have a lot of shares. So even if you have a lot of shares, you have new money entering your portfolio. I don't personally add money to this Robinhood account because I want it to be very obvious on YouTube that I'm organically growing this portfolio. From last year was 2 million, the year before was like 900K. And I'm showing that journey on YouTube because obviously as a coach, I want to show my prospective clients that I'm going to be helping with option trading that I'm organically growing rather than adding money. But But I have another portfolio where I add money, and every time more money hits that portfolio, I'm entering the wheel strategy. This right here, 235 puts that I sold off a different position. So however you personally are, having money in your portfolio, whether you're adding new money to it or you have sold a position that you no longer like and you found a better opportunity, the whole point is that selling a put option means that, you're ready to purchase the shares. Running the wheel strategy means, hey, when I get put the shares, then I'm going to be doing covered call options. So obviously you saw that I got put for the 235 strike, and then, I'm happy selling it for 240. So I immediately sold a 240 covered call here. And, now I'm just kind of, hanging out. I got a $26,000 gain, just waiting. When I enter into the wheel strategy, I just let it run, right? When I sell a put, I'm ready to buy. I don't touch it. 90% of the time, I'm not touching it. Only time I touch it, the 10% of the time, is the more advanced strategies with margin trading and the stuff that I do in the higher level one-on-one coaching that I have. But other than that, for like a regular investor who just wants that passive, consistent income, nothing crazy, you just sell a put option. Then in that case, 100% of the time, you would just wait, get assigned. Once you get assigned, sell covered calls. So you can see Apple is a really good example of that. I have the covered call positions here. So I want to go through some more of the positions in my portfolio. I'll be honest, I run the wheel strategy with the majority of my portfolio. So like every single trade here is a wheel strategy. I have ACHR, which was also a really good trade. Let me actually go over this trade. It's a wheel strategy trade that I didn't really get assigned on yet, and I've been trading it for some time. So let's look at my history. This one I have less history in because I know I just started trading it in late November. So in late November, I sold 7.5 puts. This was all done live. This was a Monday, I remember now. So I sold and the 7.5 put, I made $3,000. And then on the Wednesday coaching session that I had, I said, guys, things are going really well. ACHR is moving in our direction. It's going according to plan, according to the thesis. And I sold 75 more contracts for $6,300. Again, this is good news, I guess. This is really good news, but I've only been selling puts on ACHR. I have not gotten assigned yet since November. So I sold, made 3K, 6,300, 675, 39.44. And then my most recent trade, I collected $1,020. This expires in February 21. So I've sold options, what was that? 5-6 times to run the wheel strategy, and I've yet to be assigned. So I have 2 options here, and this is the beginnings of the wheel strategy. I want to get assigned. As you see, it's almost a little frustrating that I'm not getting assigned. It's almost frustrating because I'm selling $8 puts, and when the stock does not go down to 8 and it goes up, the wheel strategy in a sense can be frustrating because you're like, hey, I want to purchase the stock. This is almost too good of a strategy. It's almost too good because I want to buy it, but it's not going down to my range. So, it's nice collecting income. You saw however much I made there. It was like, maybe it was $10,000 or so. It was like 3-4 grand a few times. But yeah, so ACHR is the wheel strategy. And yeah, as soon as this expires right here, so as soon as I get really close to 221 expiration as I'm recording this, and it's not at $8, I'm just going to open up another sell put. So I'm going to keep going sell puts. A little bit more of an advanced strategy that I'm personally using is before an option expires, I'm already opening another one. So I'm kind of breaking rules in that sense when it comes to like risk management per se, because when a position's really out of the money and it has a very, very low delta, I already open the next position using margin if I have to, and I'm already ready with the next position because obviously this position, if let's say that ACHR is at $9, this option is at an $8 put, and let's say we only got 2 days to expiration. I get it, it's only 2 days, but I want to start making money as soon as possible. And I guess every day counts. So I guess I took that mindset from when I was broke. Now it's just an efficiency equation for me. It's efficiency. So if I know that it's not going to be in the money 2 days, why not sell another put option and continue to run the wheel strategy because I know I'm not going to be assigned on those shares. And I guess you can call it a little bit of frustration with the wheel where it's very successful, but it's almost like you're so successful, you want more, right? You got a taste of the wealth. You're like, I want more of this. I'm excited, right? So I guess I don't have that crazy enthusiasm because I'm at this for 11 years, but my actions say otherwise that, I'm like, hey, I want more of this. So it's kind of interesting in that sense. Kava is another position where I'm running the wheel strategy. So if I actually go into Kava, and again, I don't, for me, I'm not tracking every trade because I am making 5 to 10 trades in Discord. I put everything in Henry Trades where everyone can see essentially every trade I make, but I don't have an Excel sheet because it could get extremely confusing. And I think tracking, it's not going to make your results better. So why waste the time doing it? So for me, it's all about, is my portfolio value going up? Which it is. So then, you know, I see what my realized gains are. For example, on Robinhood, it was 243,000 in 1 month. Great. I want to keep going. So I'm not tracking every trade, but you know, I want to be more efficient. Kava, let's go through my history because I know I just also recently started trading it. Yeah, actually you can see here, I've only been trading Kava in 2025. I sold 100 put, made money, and then I actually closed the wheel strategy here. So the wheel strategy that I was running was I wanted to buy Kava at 100, but I closed it out on the 29th because I had made, you can see, I sold it for $13.35. It like decayed and it was only worth $100. So why would I be waiting here? It didn't make sense for me to wait for $100 for, you know, over 3 weeks. So an over 3 week, you know, waits for $105 here. If you do the math, this is $100, 10 grand is being tied up. So, you know, the return here is 100 divided by 10 grand, which is like 1% return in 3 weeks. I can do better than that. So I decided that I'm gonna close out this trade and, you know, just pocket the difference. So the 1335 and the 105, I pocketed $1,230 here in a difference. So sometimes you can close out the wheel trade if you know you've made a lot of money. So if you made, in this scenario, I guess I made like 90% in a short amount of time in 16 days. I didn't see the point of waiting 3 more weeks when I made 90% in 16 days. Why would I wait 20 days for like the remaining 10%? It didn't make sense, so I closed it. Now you can see that just a few days after that, on February 5th, I ended up selling another Kava 130 put that is expiring on February 21st. So I collected $815. And again, another successful case. So far, it's very successful. I have not been put on Kava. So Kava, new stock I added to my list. I don't cover this on YouTube. These are like more of my, I don't know, my more research plays that I'm doing on the side for the students in my Discord that I don't put out on YouTube. But I have some more famous plays that I do cover on YouTube. You know, I have Nike as well, I don't cover. But let's go over NVIDIA because NVIDIA is something that obviously, as you're watching this course, I make a lot of examples for NVIDIA. It's a popular stock. I do have a lot in it, and I do also run the wheel strategy on NVIDIA. So you can see I have a lot of NVIDIA positions, lots of different options. Let's see if I can explain some of these. So NVIDIA is at 128. I have 127. I have 130. So an in the money sell put here. Nothing wrong with that, okay? I've been running the wheel strategy for a while, so I'm about to get assigned. So both of these options are, well, this one's in the money. This one is barely out of the money. It was in the money literally this week. So NVIDIA popped down below. You can also see my management skills right here. You can actually learn right now. You can actually like literally take note and see how I handled it because I've had the 127 and the 130 open for a long time. And this week, you know, as I'm recording this, NVIDIA was 115. So a lot of the Discord members were writing to me, Henry, do we close out the trade? And you know, for me, it's like my job to say, no, I opened this trade. I'm confident. I'm taking ownership here that right now NVIDIA is below our strike price. It's well below. I understand like the community's concerns, but I'm bullish. I'm bullish, and the concerns that you guys have, it can't change. My viewpoint is NVIDIA is a good stock. So I stuck to my viewpoint, and I didn't think it was gonna happen this fast, but within a week, it's kind of funny, right? You see the emotional roller coaster in a way on managing these strategies. But the real best way to manage the wheel is to truly hang on. If you have a strong viewpoint, which I do for every single one of my plays, you know, I eat my own cooking, I put the money where my mouth is, and I'm investing in everything that I talk about. And for NVIDIA, it was, these two options were significantly below, but I was ready to run the wheel strategy and I'm still running it, but now NVIDIA has risen above the 127 and the 130. It's still in the money, but hey, by 221, we'll see what happens, you know, either it's above 130, these options will expire worthless and I'll collect the premium. I've already collected the premium, but they'll decay to zero and they'll be out of the account and I'll sell more put options. Or if NVIDIA is below, come to Papa, give me some more. Give me some more. I'm ready. I'm ready to buy bicep over tricep. You already know. You already know. I'm ready to buy bicep over tricep. And I have no problem with that. I'll buy it because I like it. So that's the kind of mindset that you have to have. Now, you can see I also have the other side of the wheel strategy. I have several covered call positions that I have sold, several option purchases that I have as well. And I have another strategy that we'll talk about later on in this course. So another strategy that I want to talk about, and this is the wheel strategy, but there's variations of the wheel strategy. You know, do you take assignment? Do you roll? You know, how does that look like? So you saw I've taken profit on the wheel strategy before as well. I want to look through a couple more unique examples because the wheel strategy has some nuances and you can definitely learn a lot from it. This would actually be a covered strangle. I'll cover that later in the course, but it's kind of like a variation of the wheel strategy. Let me wrap up this example with one more example that I have, which is Palantir, because Palantir is a special case of the wheel strategy where I got into Palantir at $22.68. So that's my average cost, and I've been covering Palantir for a number of years. I've made investors millions and millions of dollars with Palantir, just from investing in Palantir early, okay? But it's a little bit of a unique case because you can see I have 60 sell put, 65 sell put. I do have some covered calls right now, but there's only one contract. The majority of the shares that I currently have right now are actually uncovered, all right? So what happened here, let me explain, is with the wheel strategy, I have sold put options, right, to enter the stock. I entered the stock. I did covered calls in the past, but when earnings came, I decided that I am bullish on Palantir. I believe the stock is going to rise. I told all the investors in my community that we're going to be uncovered. We're going to ride the momentum, okay? So there is a point in time where the wheel strategy is great. In theory, it's really a sexy strategy. It's amazing, right? You get sell puts to get in cheaper, covered calls to get out. But reality and theory is a little bit different. So let me give you a quick educational lesson. When you sell a covered call on a stock that's really bullish, and that stock goes up a lot, you will be upset. Even though you'll make money, you'll be upset because you've missed out on some of the gains. So when I'm bullish on a stock and I see a breakout pattern, I won't do a covered call because the income from the covered call isn't worth the upside that I'm leaving on the table. So Palantir is a unique case where, I haven't sold a covered call on all of my shares for a while, and it's been a 34% gain in the past week. And again, this is a trade that I placed in the community and we've made money hand over fist, bicep over tricep, incredible amounts of gains. And it all came down to intuition, charting, a breakthrough pattern that I saw, and not going for the easy way out, which is the wheel strategy is the easy way out. I teach the wheel because it's an easy strategy to profit. You can be an absolute beginner and get crazy returns. But for certain stocks, I want to have some upside. So I believe there was upside, and I left the wheel strategy here alone, and I just let it ride, let the shares ride. All these sell puts and covered calls you see in my portfolio are, for the most part, the wheel strategy. Even if I may have opened some of these positions without necessarily planning to do the wheel strategy, all of them are ready to be basically for me to purchase the stock. You can see here with Chipotle, with Nike, with Nvidia, with Palantir, with Snapchat, with SoFi, with PayPal, Target, Walmart, Apple, ACHR, more Nvidia, more SoFi. All of these strategies I'm ready to purchase. And essentially I'm running the wheel strategy with 80% or more of my portfolio, because the wheel strategy is a system and a process to really collect the passive and consistent income where I don't have to continuously monitor my portfolio. I can look at the portfolio 3 times a week, my Monday and Wednesday session, then Friday I do a recap. And on my Friday recap, if everything is good, it's good. I just write, hey guys, it's all good. So for me, it's a really big deal to have a strong income that is passive, because it's the time and effort that you put in. And if I can make a better decision, like Jeff Bezos says, his job as the CEO of Amazon was to basically make a good decision per day, one good decision per day. And that's why Mark Zuckerberg, he wears the same shirt, the same stuff. He looks kind of goofy, but it's because as a CEO, you want to make less decisions per day, but higher quality decisions. So for me, if I make a high quality decision, or 5 high quality decisions Monday, Wednesday, and that's really it. If I can make 10 high quality decisions per week, I can outperform everyone else, literally all the best investors who are doing it full time, because it's about knowledge, it's about results, it's not about the time that you spend. So I really love the wheel strategy because it's a system and process to automate and create income automatically without having to actually work or really monitor anything, as long as you've done the research up front and you've picked the right strike prices to enter into the stock. I also want to point out that in a sideways market, premium from puts and calls, you can just keep rolling them. They can provide steady income, and you continue to roll them either down or up. Alrighty, now I want to talk about rolling and adjusting the wheel strategy. This is going to be a little bit more advanced. I'm going to go back to all my positions, and I'm going to show you what you can do. Part of the equation will be how to adjust and manipulate the sell put side. Then we'll talk about how to adjust and change the covered call side of the equation. All right, so let's go over a sell put position. And actually, the Nvidia sell put will be a really good example because it's in the money very little bit. So let's say right now that You like Nvidia, but it went a little bit lower than you expected. The stock is at 128, or any stock, right? I'm just making an example, a real example of which you can learn from. The stock is currently at 128. Nvidia, I sold a 130 put option. It's a little bit in the money. So say that happened to you, where the stock went below your sell put. You're thinking to yourself, well, you know, this stock really pulled back. I'm a little bit nervous about this stock. I'm not sure if I want to own 100 shares just yet. You know, I'm feeling a little bit uncertain, okay? So what you can do is you can roll the position down. So you can take down your strike price. You can save money, you can collect income, and you can move out to the future date. So we'll go to roll this position, and now we're gonna move this 221 expiration into the future. So again, if you recall that more time is going to be more money. So even if I go out into the future and say I go for March 21st, you will notice that if I roll the 130 put to a 130 put, literally nothing has changed, right? This is 130, it's still 130. But now it's 30 days away or 28 days away, as you can see on the screen here. But because I am adding time to the equation, time here is worth $11,900. That is the additional premium that I would collect by simply rolling this option, not even up or down, just out by 28 days. So you can see here how lucrative it can be, and you can collect $11,900 on a monthly basis in this example by selling a put option on the same stock, but by just rolling it out 30 days. That's wild, okay? Let me also show you what you can do, because my original example, what I was trying to help you with was, let's say that we wanted to go down, okay? So here, I'm picking a 125. The 125 is $5 lower than 130. The reason why I'm doing this is because, again, Nvidia right now is a little bit under 130. I'm looking at rolling to 125 because I'm trying to bring my sell put position lower. Because a sell put says, I'm ready to buy at 130. Well, I'm trying to help you adjust and say, instead, I'm ready to buy at 125. You know, at 130, I have mixed feelings. Okay, let's say you have mixed feelings. Well, instead of 130, you reduce your risk, you go down to 125. So this position right here, going from 130 down to 125, again, a change of 28 days, you collect a net credit of $3.63 per contract. And because I do have 20 contracts here that I am rolling, this would be a total value of $7,260. So you can see that I'm moving down and I'm getting paid to move down. And that's all because time is money. And I'm adding 28 days here, adds a lot of money. But instead of $11,900 for the same strike price, because I'm moving down, I'm reducing my risk. You know, that also needs compensation, right? Because I'm reducing risk, and risk is return, risk is money. So because I am reducing risk here and I'm opening up a new option that's a little bit lower, it's not going to be as lucrative, right? You know, selling an option at 130 for a put option is going to be worth more than selling a put option at 125 because 130 is higher. It's closer, or, you know, Nvidia here is under 130, but it's more expensive. It's more capital, right? You get the point. So you still collect the credit here. In fact, it's really interesting because you can literally go down to 120. You can go down a whole $10 and you still get a credit in 30 days. That is wild. And you can see here how it is really easy to adjust the wheel strategy and to protect yourself. It's very incredibly easy, especially when you have implied volatility. Let me show you real quick. The 125 put option here has implied volatility of 62. If you recall earlier on in our examples when we used, you know, Apple or another stock, it was a lot lower. But the implied volatility on Nvidia is really high, making it really juicy. Like, you can make a ton of money. You can get very wealthy off of Nvidia options. Now, if I show you something even more interesting, let's go to September 19. All right, so this is going to be, you know, several months out. You can probably tell that if I go down to a 125 option, I can collect $23,000. I can also roll down all the way to, let's say, $100. And I'm still collecting a credit, going from 130 to 100. That's because I've increased time. There's a lot more time on this option now, so I'm getting paid for that time. So options are very valuable, especially when they have more time and more volatility. And this is the extrinsic component that we were talking about earlier in this course. Alrighty, let's talk about the double dividend strategy and how you can make double a dividend. All right, so a double dividend strategy is a term I made up
as far as I'm aware. A double dividend strategy is basically you pick a high dividend paying stock and then you sell covered calls on that stock and you collect the dividend and you collect quarterly covered call income. This is a really good strategy for someone that has a bigger portfolio that's looking to retire. And you can do this on pretty much any stock that pays a dividend. Now let me show you some of the best stocks. So I have pulled up here VYM, which is the Vanguard High Dividend Yield ETF. This is an ETF that has stocks that have, high dividends. So I'm going to go to holdings right here and I'm going to show you the top 10 holdings that it has, which is Broadcom, JP Morgan, ExxonMobil, Procter & Gamble, Walmart, Home Depot, Johnson & Johnson, AbbVie, Bank of America, and Merck. So right here, there is a heavy focus on financial services. You can see how the sector weight here is financial services, then it's technology, then it's consumer defensive, and so on and so forth. For me, I'm very heavy on technology because I was a software analyst on Wall Street, so I understand technology very well, and I like technology the most as a sector because it's very high growth. But if you're looking for a double dividend strategy, then you want to look for stocks that are more on the value side, because value stocks tend to be more mature companies that can easily pay a dividend because they have very strong cash flow. So let's go over an example right now. If I go over a stock like ExxonMobil, which is an energy company, I'll show you what a double dividend can look like. So essentially the price earnings ratio is 13.83, which is a really low price earnings ratio, like super low. And the dividend here is 3.54%. So if I were to buy 100 shares of ExxonMobil and just run a standard covered call, that's good. But what I want to do is I want to show you a quarterly income approach. So let's go to April expiration here. This is basically 3 months out or so. And if I go for right at the money, you can see right here how the percentage of a dividend that ExxonMobil has is over 3%. And I'm also collecting an over 3% less than a quarter return by selling covered calls that are slightly out of the money. So you can really make a very nice return even on safe companies that pay dividends, and use the double dividend strategy by essentially selling at the money covered calls, okay? And at the money covered call is basically selling a covered call where the current stock's price is essentially. So right now ExxonMobil trading for $109.55, and the 110 covered call is going to give you a little bit of upside and a lot of premium collected when you sell the option. Now we talked about advanced single leg strategies. One of the most powerful tools that you can add to your option trading arsenal is now going to be LEAPs, or long-term equity anticipated securities. Now, don't get intimidated by this name. In option trading, we like to give, some strategies, some fancy names, make it sound complicated, or even, like a naked call option. We call it naked. It's kind of like option traders seem to just like to make, fun and have a good time. But don't worry, I'll make everything super simple, step by step to understand, and this stuff is actually not that complicated. So in reality, a LEAP option is literally just a call option, but it's a long-term expiration date, typically a year or more away by definition. They're a fantastic way to take advantage of directional moves in a stock without having to invest the full amount to buy shares outright. Let me break down exactly how LEAPs work and why they're so useful. Let's say that you're bullish on Tesla, which is trading for $320 per share. You believe that Tesla's stock price will rise significantly over the next year. But if you buy 100 shares of Tesla stock, it will cost you $32,000, which is a lot of money to put in one stock. I mean, you could just buy a Tesla with that same money. Instead, you could buy a LEAP option, which gives you the leverage, the same opportunity as basically owning 100 shares. And when I say leverage, I mean that you can use a lot less money to get virtually the same result, and a lot more actually, for a much lower price. So here's how it works. All right, so let's take a look at buying a LEAP call option on something like Amazon, for example. So I'm going to go into Amazon right now, and we're going to take a look at buying a call option versus owning the stock. So I have 1,000 shares of Amazon. I have $228,000 in Amazon, and I have some covered calls. But let's talk about a LEAP option and what a LEAP option can do in terms of return, which is a lot cheaper, same upside, and all of those other benefits I'm about to discuss. So if I pick a LEAP option that goes for March 20, 2026, okay, and I pick an option, let's say I go to the 190, has a 79 delta, so that's a little much. I don't need a 79 delta. Let's go to 210. 71 delta. Okay, so this is good. So check it out. Right here, this call option will give you essentially 100 shares of ownership, or 100 shares of upside potential. And the 210 strike price here is going for a premium of $47. Now, $47 is about 1/4 of the price, even lower than 1/4 of 228, because 228 1/4 is going to be like basically $58 and yeah, $58 and like 14 cents. I did that in my head right there, but around that, right? So this is actually less than 1/4, which means that you get the same 100 shares for 1/4 of the cost. So what's the catch? Well, the catch is that Amazon does have to go up. You can see here that you would start off in the red right here. So your like expected profit or your estimated profit if Amazon does nothing is going to be the option premium that you pay, which is going to be the $4,700. So you can lose $4,700 of what you pay because this is basically just the same example as buying a call option. However, this is a leap option. It goes out far in terms of date, and the goal of a leap option is that you want the stock to go up. And because this leap option expires, you have a lot of time for Amazon to essentially gain value, to increase in value. And this is not, again, this is not about Amazon. This is just me teaching you strategy. You can use it on any stock that you like. I'm just using Amazon as an example. So essentially a leap option gives you that upside, 100 shares, you have to put up some capital, but you get a huge leverage factor. So let's go over a little bit of an example right now. If Amazon were to go up by, $10, this option would go up by $7, okay? That's because, again, the delta here is 0.7. So let's do the math real quick on screen. So $10 more on Amazon is about 5%. You'll see the exact number on the screen right now. 10 divided by $228. That's gonna be about a little bit less than 5%. And now, if we look at the leap option, it's going for 47. And if Amazon went up by $10, then the leap option would go up by 7. So we take $7 and divide that by the amount that you put up, which is 47. The exact number will be on the screen right now. 7 divided by 47. You can see the huge difference between the stock moving up 4.89% or whatever, and then the leap option will move up 17%. So this is literally, again, a 4x leverage factor. It's going up 4 times more, and you control the same Amazon, you get a 4 times better return, and that's because a leap option is way more powerful than owning stock. Now, let me show you something that would be not so good, which is buying an out-of-the-money leap option. If you were to purchase an out-of-the-money leap option, this would not be that good of an investment, because I'll show you why. So let's say we're gonna buy a 270 call option. This one would have a 40 delta, okay? Let's actually go a little bit more out of the money to show you how bad it gets if you go very far out. So if I go for a $300 call option right now, the delta is 0.29. You can see here how the chart has wildly changed. I mean, the chart looks absolutely different. And instead of me buying a 70 delta option, which is what I prefer, and the return there was very good, here in this case you have a lot of room for the stock to have to go up before you reach your break-even price. Your break-even price here on Amazon is going to be $311.60. That's because you're going to add the strike price of $300 plus the premium that you're paying here, which is $11.60. So if Amazon in the next year went up to, basically, let's say the stock went up to $290 per share, which would be a pretty big move for a big company like Amazon that's already trillions of dollars of market cap, definitely over 1 or 2 trillion. And if you take a look at the stock going to 290, the chances are just not super high, right? So as you can see right now, based on the technical analysis, you can see that Amazon has been moving up. And if I go into the chart right here and I go to a 1-year return, the stock has already gained. It looks like it went from about $171 to $229. Looks like the return is about 34/35%. So for Amazon to have another bullish year, I mean, it might be another 30%. 30% of $200 per share is 60. So yes, Amazon would have to have a really, really good year again, and essentially the stock would only be trading for $290, and that's not even enough for us to break even at $311. So even if Amazon had another big year, it wouldn't break even. So essentially buying an out of the money leap option doesn't really make a lot of sense unless you're mega bullish. So you see, it's kind of like buying a lottery ticket. It's not as profitable at all in the long term. In the long term, this is going to be a losing strategy unless you really are fantastic at picking stocks that are going to blow up and increase in value a tremendous amount. But if you can pick a stock that is bullish and is going to go up a good amount, not even a tremendous amount, you would make way more money by buying a 70 delta option, because that 70 delta option, it has a lot more benefit right away versus this option, which has 29/30 delta. Again, even if the stock goes up 35% at expiration of this option in roughly a little bit over a year, you'd still be down on the option. So although it's a lot cheaper at 1160, it's still like not really that good of a situation. Although you get a lot of upside, and I do want to point out though that this option may be good. I'll give you the flip side why this option could be good if you don't hold it until expiration. So let's say that you buy Amazon and the stock, goes up from, the current price of 228 and it goes up to like, $250 per share in a short amount of time. Well, this option would actually gain a lot of value because that would be like a $20 rise. And a $20 rise multiplied by like, the current delta, which is 0.3, 0.3 times 20 is like $6. So it would grow by about $6. And this option's trading for about $12. So this would be an increase of 50%, right? 6 is half of 12. So, if Amazon went up by, $20, which is only, not even 10%, this option would gain a lot of value. However, that would have to happen fast because obviously the theta here is $3.69 per day. As you can see, it's 0.0369 theta. So if it took 2 months, then, in theory, based on this theta, you would lose roughly $4 a day. So, 2 months, 60 days, multiplied by $4 a day, $240 that you would essentially lose here. So, you would make about $600, right? But it would be minus $240. So you would only make about $360 on this option. And I just did the math for you. I broke down the math for you. If this was to happen, basically if Amazon went up in 2 months, this option would be profitable. You would make $360 on essentially, $1,200, which is actually a 30% return, or even a little bit higher than 30%. It's like a 31% return. It's a good return, but obviously it'd be much better to buy an in the money leap option. So instead, I would say you want to buy leaps with a delta of 70 to 80. So here's what strike prices you would want to pick on Amazon if you wanted upside pretty much right away. You would scroll down here and you would pick in the money options. So one of them is 210. I'll be honest with you, you can also pick 215. Like the delta is close enough to 0.7. So 215 isn't better than 210 and 210 isn't really better than 205. This general range would be the best range for buying an option because it has good sensitivity, but it doesn't become too expensive. So if I go down here, like I can buy a $120 call option, but like, this is actually pretty good in some ways, but I think it's a little bit overkill. Like 120 plus like the 119 would be 229. So you actually would barely be paying that much more in premium versus owning the stock. So you would pay very little and you would have like 95% ownership of the stock. Like if the stock moves up $1, your option is going to move up 95 cents. So if Amazon moves up $10, right, the option will also basically move up $10. And here you only have to put up, basically you only have to put up $12,000, and Amazon you have to put up, almost $24,000. So even in this like kind of like dumb scenario where this is like overkill, you still get like a 2x leverage factor. Like it's still like 2 times better return to buy like a super deep in the money option on Amazon versus the first example we made was like 4x leverage factor basically. This is still like a 2x leverage factor. I call it a leverage factor, okay? I don't know what it's actually referred to, but I call leverage factor basically when the stock goes up, 1%, how much does a leap go up? So if a leap goes up 3 times 3%, it would be a 3x leverage factor. That's how I refer to it. So, I mean, even a deep in the money option still like makes more sense than like an out of the money option, in my opinion, because it's just so much better. But I would still stick to like a sweet spot. So I'm just showing you extremes. But yeah, essentially I would go for like somewhere around a 70 delta, and that's the most powerful delta for buying a leap option. I've actually made a lot of money on leap options, and I used leap options on Tesla back in 2021 because I didn't really have that big of a portfolio in 2021. I started the year somewhere in the low 6 figures, maybe like around 100K. Everything is documented on my YouTube channel. You can go back and see yourself. But I started maybe with like 100K, and I had like a month where I made 14,000 and I wanted more, and I was ready to take on more risk. I wouldn't call them like super risky. I mean, a leap option, if you buy a 70 delta leap option, they're not super risky, but I did use a bit of an aggressive approach to basically buying leap options on Tesla stock and then going for 6-month expiration, going for 12-month expiration. And what I did, which was really a little bit more advanced of a strategy, but I think it's interesting for you to do yourself as well is to buy leap options with like multiple different expiration dates. So I can actually do that with Tesla right now, and I'll show you an example of like what I did back in 2021 that has led me to have a 7x return. Tesla's actually had a lot of volatility lately. I'm still up on the position, but it's definitely come down. But let me show you, like, I am taking a directional bet on Tesla right now, but in this video, like, you know, don't like copy this trade unless you want to, but this is just an example. I want to show you if I do a January, let me go for, so if I go to 300, this is 75 delta. So I did something like this. So I went for something heavy delta. So I went for 75 delta, and then, yeah, it would go out pretty far. But then I would also mix it up with like a little bit shorter term options, but this would still be a leap option. Well, I would still consider this a leap option. I consider 9-month options leap options. So September 19 here would also be a leap option that you can do. And essentially this is what I did. I went shorter term options, and then I took it a little bit easier on delta. So I would pick something that's, you know, has a higher delta, like obviously higher than 50. It should be in the money. But then I went for something like a little bit lower, like this. So, and then I purchased different expirations, different strikes, and essentially you can see here how my expected profit and loss here is kind of like sloping. It's a little bit more slopey because some of the options like benefit obviously a little bit faster and they have a little bit more sensitivity to delta. And I'll actually show you something really interesting as well, what else I did. But you can see how the profit can get pretty big. You know, the max loss here would be the premium that I pay for these two options. So like a 112 premium and a, you know, 7100 would be a total cost of like, you know, 18K or so. Robinhood right now is like calculating the max loss as 16,800. I think that's because of some changes in the bid-ask spread and the market's closed as I'm making this. But yeah, so I did a strategy like this with leap options. So I mixed in multiple different leap options, and you can see here how like a 16K investment in a short amount of time, you can actually make some really good returns. And, you know, if the stock were to go from, you know, the current price of like 350 bucks to 450, you can see how you can get like a 50% return in a really short amount of time. All right, I also want to show you what else I did on Tesla because I think it goes really well with this part of the course. But I'm going to cover this in full detail later on this course. It's an entire strategy, but I'll show you what I did. So I also did a little bit of out of the money options. So I did, for example, buy something that would go out to, let's say, September, 6 months out. I bought, you know, something that's slightly out of the money, very slightly out of the money with a 58 delta. Here is actually, there's a bias. This is an out of the money option, but it still actually has a high delta. So you can actually see that the market is overall really bullish on Tesla right now, because an option that's like at the money should be around 50 delta. An option that's out of the money should have less than 50 delta, but this has a higher than 50 delta. So I would buy an option, but because I'm personally, you know, after my experience, I don't really think option buying is like the most profitable way to trade options. So I did buy options, but I would subsidize the cost of buying call options. So I would buy one call option, and then you can see here that I've switched to selling a call option. So I would buy a call option, say for 370, and then I would sell a call option for 380. And the whole purpose of that is that you're buying one call option because you're long. It's like a leap option or regular call option. And then I sold a 380 call option. So I would buy 370, sell 380. The 380 would like really dramatically reduce my cost. So obviously you can see here the 370 is worth $6,200, but the 380 is worth $5,800. So my max total cost here is only $450, and that could potentially be lower depending on the bid-ask spread. Robinhood is calculating it as around $400. So you can see here how the return looks very different, and the break even is like only 373. So if Tesla like goes anywhere, like let's say Tesla went to like 380, which is like not that much of a rise. And you know, in 2021, Tesla did that many times, and I've done it many times during the year. You can essentially, you know, risk $400 and come out with a profit of 600. So you risk 400, you get 600 in total profit, or basically you turn 400 into $1,000. So you can imagine that if you put 40 grand into a position like this, you turn 40 grand into 100 grand, and you do it again, and you turn 100 grand into 250 grand. And then you can see how like the numbers are really, really high. So I did have a little bit more of a percentage of my portfolio in a strategy like this. So again, later on in this course, I don't want to like dive too deep into this right now. I want to stick to leap options and continue to educate you on this part of the course, but just wanted to give you some foreshadowing because I have you really covered in this course. I have some really interesting stuff coming and more facts, more data, and more examples. So yeah, hope you're taking notes and let's continue on. One of my favorite strategies utilizing leap options is called the poor man's covered call, which works just like a traditional covered call, but with far less capital required. My promise was to you that I'm going to teach you everything, all the foundation, and get you to an advanced level with option trading. And the poor man's covered call is a really interesting variation of the covered call strategy. But the poor man's covered call gives you that power, the bicep over tricep, as I say. It gives you power, control, income. It's like the best of all worlds. The poor man's covered call is a way to generate income just like a regular covered call, but with far less capital required, very similar to a leap option. Because a poor man's covered call actually utilizes the leap option. And that's why this course is building on itself. Instead of needing to buy 100 shares of stock outright, which can be extremely expensive for high-priced stocks, this strategy uses leap options as a substitute for stock ownership. This allows for selling covered calls without tying up thousands or even tens of thousands of dollars. A traditional covered call requires owning 100 shares of a stock and then selling a call option against those shares, as we learned earlier in this course. This works great for stocks that are reasonably priced. Maybe a SoFi, maybe American Airlines. HIMS was a company that I was purchasing a lot and doing covered calls on. But how about those more expensive stocks like Tesla, Nvidia, Amazon? These more expensive stocks can use the poor man's covered call strategy, because instead of having to buy, Tesla for $30,000 or $40,000, a poor man's covered call can give you the same amount of shares for maybe $5,000, $6,000. So it's a lot more easy for everyone, even investors that do have more capital. Many of my clients, they like the poor man's covered call because it's fun, it's exciting, it's higher leverage returns. And at the end of the year, many of the people I work with, they want 50% or more returns per year. That's a lot to ask for. If you look at Warren Buffett, he has 24% per year. And I've maintained a 50% per year annualized rate of return, which is astronomically high and difficult. And the poor man's covered call has been a fantastic strategy that has helped me achieve those type of returns. It allows for the same income generation strategy, but at a fraction of the cost. Instead of buying the stock, the strategy starts by buying a deep in the money leap option with that traditional and standard delta that I have explained, the 70 delta. That's my sweet spot. So a leap call option has a long-term expiration. For the poor man's covered call strategy, we're going to be using the same expiration date. So this is going to be typically, 1 year out, maybe even 2 years out. If you have a stock that you really like and you see a long-term perspective on that stock, then it's completely okay to go for a long-term expiration. This long-term call acts as a substitute for stock ownership because it moves almost one-to-one with the stock price. A 70 delta, although it's not one-to-one, it's a very sensitive and it's moving a lot like the stock. And when you buy a call option that's deep in the money, you can then sell a call option against it. So once this long-term call option is owned, short-term covered calls can be sold against it, just like a regular covered call strategy. The reason this works is because the deep in the money leap has a high delta, meaning they have a very similar behavior to the stock itself. If the stock moves $1, the deep in the money leap option will move 70 cents. Let's go over a real example of how this works. Let's say that Nvidia is trading for $104 per share. Normally, buying 100 shares would cost $14,000, which is a big amount of capital commitment upfront. Yes, it's possible, but what if we can get it lower? Well, let's talk about the leap option. A deep in the money leap option that you can buy for $100 per share, right? At the $100 strike. Let's say that it's out 12 months. This leap option you can purchase for $30 per share, meaning that the total cost is $3,000 instead of $14,000. At this point, the long-term call option is acting as a substitute for stock ownership. Since it's deep in the money, it behaves almost exactly like owning 100 shares, but at a much lower cost. Now, just like in a regular covered call strategy, a short-term call option is sold against the leaps. A 150 strike call option with a 30-day to expiration, and it's sold for $2 per share, meaning $200 in premium collected immediately. Well, we have just collected $200 in premium for 30 days. $200 is not that much compared to $14,000, right? If you were to buy this entire stock, 100 shares, $14,000, $200, that's like 1.5% or so. That's about 1.5%, right? But if you collect $200 on the leap option, and the leap option that we purchased for $3,000, well, we collect $200 on $3,000, that's a 6.667% return, or, so it's 6.67% return. That is freaking phenomenal, because on the covered call, you would make like 1.5%. With the poor man's covered call on a monthly basis, you can make 6.67%. And I didn't even tell you about the capital appreciation. That's the premium component, because there's multiple sources of income that you can make from the poor man's covered call, which I'll discuss in just a moment. But I want to talk about the outcomes, okay? What are the outcomes of the poor man's covered call? If NVIDIA stays below 150 by expiration, the call option expires worthless, and the $200 premium is yours kept as profit. Same thing as a covered call. The $200 that you collect, it's yours in your pocket right away, but you actually want it to, expire worthless, and then that $200 is like officially yours, right? $200 in cash is yours, but you still have the position in your account, so you might have to buy it back. So you need the option to expire for you to be able to sell another option. You can't just sell an option and then sell another one of the same shares. You see what I'm saying? So a new call option can be sold after a month and repeating the whole process and generating consistent income in the case that NVIDIA stays below 150, right? So if it stays below 150, the option expires worthless, and then you can run the strategy again and collect another, 6-7% in premium for another 30 days. If NVIDIA rises above 150, this is actually pretty good overall. Not pretty good. This is actually really good, because a short-term call will get exercised, and I'll tell you how to manage the strategy because you actually don't want it to get exercised. I'll go over that in just a moment. But in theory, if it goes above 150, you will basically lose the covered call that you sold, and then the long call will be really deep in the money, so it'll make a lot of money. So what I usually do actually is I usually close out the position entirely for a profit. So if NVIDIA were to hit 150, I personally, this is, Henry, what I do, I would basically close out the position. So the long call option is like made a lot of money. The 150 call option that's sold, the covered call, you'll have to buy it back for some money, right? But the net position will be up a lot because this is a bullish strategy. And I'll show you an example of the poor man's covered call, just a few minutes. We'll go over a live example. But the long call has a lot of delta, so it's really sensitive. So the long delta, and you've made a lot more money because it has participated a lot more in the upside versus the short call option. It has not really participated that much on the downside. So even when it hits like, 150, just close out the entire position and you've literally made money hand over fist, like a lot. This strategy works because a long-term leap call is a cheaper way to gain exposure to the stock while still allowing for the covered call to generate income every single month. So instead of needing like $14,000 to buy like NVIDIA, for example, you can buy 100 shares for like literally, 1/4 of the cost. The key to success with this strategy is choosing the right leap contract, and the best leap contract is again going to have that 70 delta. You obviously want to have some good stock selection because this is a bullish strategy, and the strategy itself won't save you from like a crappy stock. Like you have to have the proper stock that's going up. It has to be like either a 52-week low, the RSI has to be low, so like most likely it'll go up. It might be near a Bollinger Band bottom, or just in general, you're just bullish in the stock. Like you don't have to do the technical analysis side. Fundamentally, it can just be a good company. Like maybe the price to sales ratio is very reasonable. Maybe the price to earnings is really reasonable. Maybe the company in general is just really growing and you're bullish on it. So there could be a lot of reasons to run this strategy. And again, the leap option that I'm buying is always going to be roughly in that 1 year mark. And that's because the theta decay on a long-term leap option is really low. So theta is really affecting the option very slowly. So this is why the strategy works best when it's initiated with at least 1 year, give or take, maybe it's a little bit more. It can even be a 6 to 9 month option expiration as well. That way, it actually have a huge other benefit because the leap option that you buy has very low sensitivity to theta. So you have a long time that you can hold that option and it's not really decaying and it's deep in the money. So like you're cool, you're basically holding stock. Whereas the short call, that option that you sell is losing value quickly, which is a good thing because you have sold that call option, right? So it's decaying and losing value. And essentially, the long call option is not losing value fast. The short call option is losing value fast. So you see how like you're profiting. So even if the stock does like nothing for 2 months, because I'm selling either monthly or every 2 months call options, then I'm just profiting off of theta decay because the theta decay is higher on the short call versus the long call option. So let's go over an example of this and pull up an option chain and show you the poor man's covered call in action. I actually have several covered calls that I have done on Google. So I'll show you like a Google example and I'll demonstrate to you buying the leap option, selling the call option, and how the trade works out, the performance of those trades. So again, let's go over some live examples so you can see. I'm going to open up an example right now that is going to have a roughly 30% return on the poor man's covered call. So let's go through it step by step. First thing I want to do is I want to buy a call option on Tesla. Okay, I'm going to be buying a call option for January. And again, this is an example. You don't have to use Tesla. You can use any other stock that you like. So I'm going to buy call, and the expiration date that I'm going to pick right now is going to be for January 16. I'm going to purchase an in-the-money call option that has a roughly 70 delta, which is my sweet spot delta. Right here, you can see the delta is 0.69, which is close enough. The volume is, it's fairly low actually, but the open interest is good. The implied volatility is 55.95, which is great. And the bid-ask spread is actually really good for an option that's, pretty expensive at $9,600. Now, let me show you how this would work. So if you buy this call option right here, this call leap option, which goes out, pretty much exactly 1 year, I'm now going to sell a call option against this leap option and generate some income. So if I go for a 3-month expiration, this would be basically a quarterly expiration, very low amounts of work. And I want to specifically show you the 330 is a 70 delta, but how do you pick the call, the poor man's covered call that you sell? So I want to bring up Tesla's chart right now and show you, how to actually pick that strike. So you see, as I'm recording this, Tesla has, basically fallen a lot. It's at the bottom of its Bollinger Band at 361, and the moving average is 405. So for me, I think, on average in the past, 50 days, or 60 days of this moving average. This is actually a 50-day moving average. In the last 50 days, it's essentially about $400 on average, okay? So if I look at, what is likely to happen with Tesla, I would say that if it goes up, it'll be between, somewhere around 400, maybe 420. The top of the Bollinger Band here is 437. So what the Bollinger Band means is it's statistics. It means that 95% of the time that Tesla is going to trade between the bottom of the Bollinger Band and the top. So the bottom here is around 365, and we're actually below the bottom of the Bollinger Band. So it's something really unusual at the moment to see Tesla, this low. And, if Tesla were to be, 450 in, February 2025, it would be fairly expensive based on the Bollinger Band. So the Bollinger Band uses statistics to tell you where a stock is likely to trade within. So for me, I have two pieces of data. I have, the moving average 405, and the middle of the Bollinger Band is essentially 400. So I'm going to go with 400. 400 is perfect. So if I go to sell call and I go for the 400, you'll see here how I can essentially collect $2,900 from the call option that I'm selling. If you take essentially, $2,900 and you divide it by, the 96.90 that you're paying, then you're basically getting almost a 30% return or thereabouts. So you can see here how there's a huge profit area. The profit is actually really, really big. And this option right here will, and this option right here, it's already in the money. So even if Tesla doesn't do a whole lot, you're still gonna see, an expected profit. But if Tesla goes up, you will make as much as $4,500. Now, this is really interesting because the way the option behaves is pretty dynamic because you have two different expiration dates. The long call option has a very high delta, so it's going to be benefiting a lot. Whereas the short option, the 400 call, what you ideally want to happen is you want Tesla stock to rise towards $400 per share. Therefore, your 330 call option goes up. And then, if Tesla goes up towards 400, but it doesn't massively jump and just approaches 400 and it rises to say 370, 380, 390, then the short call option is still going to be decaying in value until expiration of, May 16 expiration. So let's say it's April and Tesla is at 375 per share. That's actually really good because the long call option has increased in value and theta has already really kicked in a lot for the 400 short call option. So you're going to be up on the position. The estimation will vary a bit, but if we wanted to manually do that estimation, this chart right here on Robinhood, it's not so good with poor man's covered calls. This gives you a rough idea, but the true calculation, you can either kind of estimate it yourself or you can use some scenario analysis, maybe using some other tools. But the poor man's covered call is a little bit more difficult to really fully analyze in Robinhood because it's a free trading platform. And the way that these two interact with each other is a little bit different from this chart, okay? This chart is not really taking into account, this chart is showing you basically what happens at expiration, right? So let's say at expiration, it's it's $400. Then yeah, essentially you have paid $6,700. This call option right here would be, $70 in the money. So you would have 70, and then this would, expire worthless. So, 70 plus 29 is 9,900. So essentially, you can look at it that way, but there's several ways you can really look at it. At expiration though, you can't even fully do that because this option right here expires in May, whereas this option expires in January. So you see what I'm saying? This option that's being calculated isn't really factoring in time. So that's why, I wouldn't really use Robinhood for the calculation fully, but you can understand here that this is a bullish strategy and more or less this is what it looks like. As time goes on, if your option increases in value, then this leap call option will increase in value and this option will decrease in value. And if a jump happens in the short term to 400, you won't really be up as much as it going to 400 by May 16. So at May 16, if it's exactly 400, then this will basically be zero. But let's say that in a week or 2 weeks, Tesla jumps to 400. Well, let's actually do the math there. I can show you what would happen in 2 weeks and we can go over certain scenarios. So let's go back to the call option that I purchased and just do the math separately. And I'll just break it down for you step by step so you understand what I mean here. It's not as easy on the poor man's covered call to get the expected return of what it's actually gonna be. So let's break it down step by step. For example, if Tesla went to $400 per share, it would see a roughly $40 rise. Let's say this happened in 2 weeks, okay? So in 2 weeks, this would be your profit. This is how your long call option will be affected and your short call option will be affected. Your long call option, right? This 330 long call option, it has a 70 delta. So if Tesla goes up by $40, you'll see this on the screen, $40 times 70 delta is $28. You're gonna make $2,800. Theta is super low here. So in 2 weeks, like you're losing $11 times 7, that's like $77. In 2 weeks, you're gonna lose like $140, okay? So instead of saying $2,800, let's say this option goes up $2,700 because theta kicks in a little bit. So you see what I'm doing there? I'm multiplying delta by the amount that the stock goes up, which is $40 times delta. And then I'm subtracting out, the 2 weeks of theta, right? So it's $2,700, perfect. But we wouldn't be up $2,700 because on a poor man's covered call, the short call option does work against us. It's premium that we collect, but it also does work against us if you get a short-term move. So let's go back to sell call and talk about what happens to the short call option because this is really interesting. The 330 call option will go up in value. We already know we made $2,700, but what happens to the short 400? Well, what would happen is that the short 400 would essentially, it has a 40 delta, right? 40 delta times 40. So it would essentially rise about $16, okay? So you can see here, it would rise $16. And theta here would also eat away at the option, actually a little bit more. So it's actually a good benefit. So 7 times the theta, which is 1 week, it would lose $20 times 7, which is 140. So in 2 weeks, it would be 280, right? So let's call it $300. So $300 it would lose, which actually helps us. It actually works in our favor. So on the short call option, theta works for us. On the long call option, I was saying that if it's 2,800, but we subtract theta, right? We go down to $2,700 in profit. So when we sell this option, if Tesla goes to 400 or increases by $40, then, it's going to be working against our covered call because with a short call option, you want the stock to stay below the call option. So what happens here is that it'll be $1,600 against us, right? Because 40 times the delta is 1,600 roughly, but it actually helps us by 300. So instead of 1,600, it's really 300 less. So it'll be 1,300. There you go. So now I've kind of did the rough math estimation for you because again, Robinhood's not gonna know like in what depends on the time frame, right? This is why delta in Greeks is so important for you to understand more or less how this is gonna work out ahead of time. So again, the first option, the call option will be up 2,700. The second call option will be up 1,300, right? The 1,600 minus the 300 of theta loss. So 2,700, we're up, 1,300 will be down. The difference, $1,400, okay? So that's the estimated difference. So yeah, if the total cost here is 6,800 and we end up making 1,400, that's like, almost 1/4. That's almost like a 1/4 return. So yeah, you'll be up like say 23%. I'll put up on the screen, which is the 1,400 divided by 6,790. It's going to be about 23%, whatever that number is on the screen right now, which is like a really good return in 90 days. Voila, 20-something% in 90 days. And keep in mind that if Tesla goes up by $40, keep in mind that the stock that would only be like, like a 12% rise. So the stock would go up 12%, but the poor man's covered call would go up by 22%. So this is obviously like amazing and really good. Now, the true benefit with the poor man's covered call, let's actually do the second example of Tesla going to 400 at expiration. This one would be a lot easier to do. So at expiration of the short call, because we have two different expirations, right? At the expiration of the short call, which is May 16, essentially the May 16 option would be worthless, right? Because if Tesla goes to like 400, but it's May 16 already, the option expires. So it'll be like in positive 2,900 for us. And that means that we just basically only have this call option, which, will go up by, let's go back to the call option. So if it's $40, well, actually, no, we can pretty much do the math. So it was around a 70 delta. So 70 times 40 will be 2,800. So we made roughly 2,800. Yeah, theta will be more of a problem by May. So let's just estimate and say we make $2,000. The short 400 call will for sure lose 2,900. So we made like $5,000 on this position, which is like some pretty good numbers. That's like 75% or so, or even more. So we'll make a lot of money on Tesla. I hope this example was really interesting to you. I'm gonna go over another example where I can show you more numbers. This was me doing a lot of estimations in my head. Comment down below if you found this valuable. I hope I didn't lose your attention with that. But let's go over another example where I can actually show you everything. Some of this stuff on Tesla was a little bit theory-based because the poor man's covered call, again, it's a little bit more not theory, but it's hard to calculate because there's two different expirations. So you kind of have to understand options on a deeper level. Let's go over this NVIDIA example right now, because this is actually a poor man's call that I currently have open, and you'll be able to see the profit loss that I have on this NVIDIA option strategy. So I opened up this option strategy in my Discord end of January. So this was like last month. And you can see here how I entered a 2 option order and it got filled. And basically what happened was I sold, first of all, I bought NVIDIA 110 call, then I sold NVIDIA 128 call, right? This is a poor man's covered call, and here's the option positions in my portfolio right now. So here's the breakdown. Essentially the 110 call is like that call option, the leap option that had, a decent delta. I don't know what the delta is right now. Let's actually take a look and see what the delta is. This position has obviously changed. NVIDIA has fallen down a bit, but my delta is actually pretty good. It's at 74. So not a whole lot has changed. So I have a 110 call, and then I have a 128 covered call. And NVIDIA just hit in the money. So we're about to hit some really interesting conversations because this is like a good opportunity to roll. This is like right at the money. So what am I doing right now and how am I managing it? So the 110 call, like things are obviously going well there. And the 128 covered call, NVIDIA just hit in the money. So it's time for me to potentially like roll this option. It's also really interesting because today, as like I'm recording this, it's like February 9th, 2025. And NVIDIA, this covered call is expiring on February 21st. So I'm really only about 12-ish days away. So I have the ability to pretty much this week, when the market opens up, to roll this higher. So I'll show you rolling higher, but first I want to talk about how much I'm up and potentially just closing out the trade for a profit. Because the simplest thing to do would just be to close the trade out for a profit. I'm up $1,650, as you can see here. So I don't really need to roll. I can either close this position out fully for a profit, or I can roll. The reason why I can also roll is because this leap option still has time. It's expiring in September. So, it's still a leap option. If this was like May, I would definitely say 100% I'm taking profit, I'm closing out this trade because the leap option is about to hit some faster time decay. Right now, it's not really in that fast time decay space, right? Like there's still some more time and time decay is currently low. So I have 2 choices. I kind of have 3 choices. So the first choice is I can cut this position when the market opens. I'm recording this right now on a Sunday. So when the market opens up Monday morning, I can just take profit and walk away $1,650, which is like 10% return in like less than 2 weeks, like making stupid amounts of money right now. So I can do that. I can also roll this position higher. So I can roll the 128 to, 135 or something like that. And the third thing is I could just wait, and I can wait until closer to 221 because it just hit in the money, but it's not like massively in the money. So this option will actually experience a lot of time decay. And number 3 is what I'm going to do actually, because you're part of my Discord, I like to do my rolling and trading on Wednesdays. Mondays are like I'm opening new positions. Wednesdays I'm doing a lot more like rolling and adjusting positions. So I probably won't do anything until Wednesday. But yeah, honestly, you can't really go wrong. So there's no better choice. The first choice of taking profit now is cool, right? Like you take your profit, your capital's freed up, you could do something else. Choice number 2, you can roll up, and I'll show you what that looks like right now, is actually also a good choice. And then choice number 3, which is just waiting a little bit more, is also phenomenal, because waiting a little bit more means that this option is going to gain value. So I'm basically giving you 3 ways to win. This is all 3 ways winning, but I would probably prefer waiting and rolling a little bit more than taking profit right away. Taking profit would be for the people that are like, I'm happy, I'm really scared to lose my money, I want to get out of this position. That's fine. But typically when you have a lot of experience, you are probably going to say, I want to make more money, I feel confident, so I know what I'm doing. So this option is actually down, which makes sense because it's now in the money, but it's not actually down that much because there's not that much time, so there's not that much extrinsic value here. There's extrinsic value for sure. I mean, the extrinsic value right here is like exactly $5. This option's in the money by 70 cents and the option's worth $5.70. So its extrinsic value is $5 and its intrinsic value is 70 cents. So yes, there is a decent amount of extrinsic value, but that's all gonna like go away like really, really fast. It's like a car that's depreciating. Like you buy a brand new Lambo out of the, you know, the place where they sell the Lambos at. I don't have one, so I never even like bought a car. I always just rent them. Like when you buy a car and you drive it off the lot, I know you guys have heard like it loses like a lot of its value, right? It's 20% or something like that. Well, the same thing with this option. It's about to hit some big depreciation. This option is about to depreciate faster than a Lambo that you just bought and you put 3,000 miles on it, because in 10 days, 12 days, it's going to lose. If the option stands still, if the stock stands still at 128.73, this option is going to lose all of its extrinsic value, which is $5. It's going to lose all $5, which is a lot. AKA why I would personally lean on waiting and not touching this option. That's what I will do. So this option will basically make $2,850, which will be like a load of money because we put up 11,900 on this trade, right? If you recall, this trade is 11,900. So making like 3 grand in 11 days is exactly like why we got into this position to kind of like begin with. So taking profit would be like a little early in my opinion, because you got 10% when you can get like 3 grand more. 3 grand more to the already 10% that we have. That's going to be like an extra like 20% or so. I'll put on the screen. What is 2850 divided by 11,900? That is what you will be leaving on the table if you were to essentially close this option out for a profit. So choice number 1, closing it out for a profit. Viable, winning, it is leaving money on the table. 2, waiting would be my preferred choice, to wait and not to manage this position. I actually love waiting and doing nothing. It makes my life so much easier because I am working with like, I think like 30 one-on-one students right now, and I text them back and forth, right? It's texting, it's images, it's voice notes, and I go back and forth, and I love being able to honestly say like, it's better to wait and actually mean it. Like, hey, I'm not being lazy. It's actually better to wait. Like doing less is actually more, and I feel like good about that. I'm not like saying to do something more because it's like profitable to do more for me. It's like, this is the honest to God truth. It's better to wait. Now, number 3, which is rolling, I would say that this is also viable, but probably not optimal, just like taking profit isn't optimal. And again, I don't know how this is gonna turn out. So you're watching this in the future, right? It's gonna take me a lot of time to edit this video, a lot of time, weeks. So by the time it comes out, like you'll see how this played out. You'll see, oh, was I right? Was I wrong? But you can't even judge someone based on a short time frame anyways. It's all about long-term investing, because I had plenty of periods where I wasn't right on a single trade, but I've been right on many trades, and then I've grown my wealth to like millions and millions, and it had bumps along the road. Like I didn't like, it's not a straight line. Like obviously it's not. So I've had my fair share of mistakes, and I still make mistakes. I'm still like, I would say learning, 11 years in learning, but you know, sometimes I look back, I'm like, I could have done something a little bit better. I should have seen that. You know, I'm still always improving a little bit. Let's go over like the rolling scenario. So rolling, from what I understand, you cannot roll a piece of the poor man's covered call in the Robinhood platform. So what you do instead is you close out the call option, you close it out, and then you open up a different option in 2 transactions. So for a covered call, you can roll it. For a spread or a poor man's covered call, you can't do that in 1 transaction, from my understanding. And I've been using this platform for a long time. There's really no loopholes. You just close out and open up. It's really not that hard. I just want you to be aware of that you're not gonna see the roll button. So that's why you don't see a roll button right here on the screen. So instead what you will do is you will close out, so buy to close, you'll close this out for 580, right? So let's actually put both options on the screen as if I was buying them so you can visualize both. So let me go to February 21st, and then this option was a sell. Well, I would have to be buying it back to close it, right? So I'll go to buy. So buy, and then 128 right here. So you can see here, I can buy it back for $580, and I can essentially sell a new like covered call leap option like next month, which would be 40 days out from the expiration here. And I can essentially move from 128 to say like 135, as I mentioned before. So check this out right here. This is actually, I did a mistake. It shouldn't be buy, it should be sell, right? So we're trying to sell a call option because we're trying to collect premium on the 135. So if I like collect the 135 here, you'll see that the 128 I can buy back for 580, and then the 135 I can sell for 870, and I can essentially collect $290 of premium. I still, the $3,000 I was talking about, I still will make that because this is $300 on top of what that option was worth, right? The 128 call option was worth $2,850, and now the 135 call option that I'm selling here, it's still $2,850, but it's $290 on top of that. Okay, so yeah, so this would be amazing, right? This is like awesome stuff. And by the way, this is per contract, so the total credit would be $290 per contract that you basically close and then roll and have an open new position. So for every single contract, I would collect $290 more per contract by rolling higher. So obviously this roll higher allows me to now, benefit off of NVIDIA going to 135 rather than NVIDIA going to just 128. And then I just wanted to go back here real fast because I just realized in my head, I'm like, well, the position is 2850, right, for the call option, but how many shares would we be rolling? We'd be rolling 5 contracts here. So I have 5 contracts of this 128. So 5 contract roll, you saw was 290, right? So let's call it $300. So if I would roll 5 contracts for $300, it'd be $1,500, which is essentially like a 50% bonus. So yeah, if you need to watch this example again, make sure that you can like rewind and rewatch it. There's 3 ways to manage the poor man's covered call, at least this example. There is the first one, which is taking profit and just being happy with what you've made, which is $1,650 right here. And then just saying, hey, I made 10% in like 10 days. I'm happy, I'm good. Number 2 would be waiting more because this option right here will decay like pretty quickly and really fast. So that is a really huge component to your income. And this option won't decay that fast. So in like 11, 12 days, as this option approaches expiration, it's going to decay and you're going to make a lot of money. And the third way is to roll this position. And to be honest, like rolling is like chess. Like I've been playing chess recently. I played poker. I've been very successful at poker. I'm not as good at chess as I am poker, but there's like lots of moves in chess. Like there's tons and tons of possibilities. So the same thing is like with rolling. That's why it's a case by case basis. Like you can roll NVIDIA to 129, 130, 131, 135 to this expiration date and that expiration date. You can roll it up, down. You can roll it for the same strike price, but further in terms of date. And there's just various benefits to that. So I encourage you to play around, and I'll definitely have more examples in this course. And of course, like in my coaching, more than happy to help you as well. You can always check out the first link in the description. Now, let's continue on with this course and continue to learn. Now that you understand covered calls, cash secured puts, and single leg strategies, you're officially ready to start learning multi-leg strategies. And watching this section of the course is extremely important because it's going to make you a much more versatile option trader who can profit in any single market condition. You're gonna have all the tools to make consistent weekly and monthly income. So let's begin with the most basic form of a multi-leg option strategy, which is called a spread. A spread is simply when you trade either 2 calls or 2 puts at the same time in the same underlying asset. Spreads are absolutely awesome and they're really good for scaling a small portfolio. They allow you to take a limited amount of risk with a small amount of capital and to get a lot of money back with a high probability of winning each trade. And they also allow you to actually make super consistent income. It's a little higher risk, but it's a lot higher income. So the trade-off is well worth it. And we have many examples coming. I just want to first explain to you how they work and give you the foundation of spreads. For me, spreads are a huge reason why I was able to scale my portfolio from 100K into 700K in 2021, and even now in 2025, where I'm organically scaling my portfolio to multiple 7 figures. And this is being done in 2 different portfolios, and spreads have been a really good component. Although I'll be honest, they have become less of a component as I've scaled to 7 figures. Spreads are fantastic for small, medium, and large portfolios, but they're specifically great for growing accounts and producing heavy returns, big returns. Now, there are multiple types of spreads. The first one that you should know is called a vertical spread. It involves buying and selling options with the same expiration date, but different strike prices. Vertical spreads can be used for both bullish and bearish trades, and they come in two main types: debit spreads and credit spreads. A debit spread is when the trade requires paying for the position up front, and it's usually used when there's a directional outlook, either a bullish outlook or a bearish outlook. These spreads limit the maximum risk while reducing the costs compared to buying a single option. For example, let's say you have a stock trading at $320 per share and a bullish position is needed. You see a bullish growth. Well, instead of just buying a call option, a bull call spread can be used. This involves buying a 320 call option and simultaneously at the same time selling a 330 call option with the same expiration. The 320 call might cost you $10 per share, and the 330 call might be sold for $5 per share, meaning the total cost of the spread is $5 total, or $500 for the contract. This is much cheaper than buying a single call outright, because a single call outright would cost you $1,000. Now that you're selling another call option, you're reducing your cost. Instead of paying $1,000, you're only paying $500 in total now. This creates a risk to reward ratio of 1-to-1. This makes it a lower risk way to buy the stock, and if it goes up, you're going to profit with a lot cheaper upfront capital. If the stock stays below 320, the entire premium that you pay will be lost, because a bull call spread or a debit call spread, these are two of the same things, they just call it differently on Wall Street. They're the same thing, two different terms, but same strategy. This buying strategy is still a bullish strategy, so if the stock does not go in the direction that you assume, then you will lose money. If the stock that you buy the strategy on lands between 320 and 330 at expiration, the profit will be somewhere between $0 and $500 of profit. This depends where the stock finishes. A bull call spread works well because they reduce the cost of being bullish while keeping risk limited. Instead of paying for a single call option, the short call option reduces the total cost, making it a more efficient way to trade. But let's look at a few different scenarios to really understand how a bull call spread behaves under different conditions. Let's go over the first scenario. So the stock, we'll call XYZ, skyrockets past $350 before expiration. The most common beginner mistake is assuming that the stock is going well beyond the short call strike price means that they're going to profit more. But that's not how a spread actually works. No matter how high XYZ stock goes, the maximum profit that you're going to make is still going to be limited to the $500. That's because the short call of 330 call option caps your gains. The good news, the trade still made the full profit at a fraction of the cost compared to buying a single call option. But the downside is that XYZ stock has been expected to make a massive move. A bull call spread will limit you to how much money that you can make. You're only going to make the amount of money between the 320 call option that you buy and the 330 call option that you sell. That's going to be a $10 gap. During that $10 gap, you can make money up until that $10 gap. So if you paid $5 for that $10 gap, you could turn $5 into $10. If you paid $2, well, $2 can turn into $10. Let's talk about the second scenario that can happen for XYZ stock. Let's say that it moves up slowly and it finishes at $325. In this case, the 320 call has an intrinsic value because the stock is above 320, but the 330 call is still out of the money, meaning that it expires worthless. This spread is worth $5 per share at expiration, the same amount it was paid for, meaning this trade is at break even. Scenario 3, XYZ stock drops to $310 instead of moving higher. If the stock declines instead of going up, both options expire worthless and the entire $500 is lost. This is why spreads still require strong trading selection, strong stock selection, and you want to risk low amounts of capital here. You don't want to risk huge amounts of capital in a bull call spread because you can lose the money that you put up. However, the amount of money that you can make is truly ridiculous if you're right. Alrighty, we're going to go through a real life example. We're going to be using a call debit spread, and I'm going to be doing a call debit spread on NVIDIA. I'm going to show you the technical analysis and go through why I'm doing the call debit spread, and we're actually going to see how this limited risk strategy can have a really huge return. And I'm telling you, you can make big money, and the return is big for the amount of capital that you put up. So first of all, Nvidia is currently, trading at 129. You can actually see how Nvidia has had a huge rise in the stock. The bottom here was actually at under $120 per share. Like the stock was at 117, and it like quickly shot up to 129, which is actually a really good opportunity to use the call debit spread strategy. So if you recall, a call debit spread is essentially buying a call option because you think the stock will go up, and then subsidizing that call option by selling another call option. So I'm gonna jump into my portfolio right now, and I'm going to go to trade Nvidia options. I'm going to show you step by step how you buy a call option, how you choose a strike price, how you manage that position all the way from beginning to end. So check it out. The thing that I'm looking at right now is that Nvidia has risen a lot, and the moving average is at 134, and the middle of the Bollinger Band looks like it's around 131. The top of the Bollinger Band is well over 140. You can see it's 149. So that means that there's a lot of upside for Nvidia if the stock continues to run. My view is that you saw a double bottom pattern here, and I do look at technical analysis. I think technical analysis tells you a piece of the story, right? You want to put all the pieces together. So something that I noticed here is that there was a double bottom pattern essentially at around 131 or so. And again, there was a bottom at around 132. So right now, what I think is going to happen is that Nvidia can easily go to 134 per share. However, if the Nvidia momentum continues, I can see the stock at 140. So, again, this isn't about predicting the stock. What this is about is, given that, let's say I think that the stock can be 140, what kind of strategy can I use? Call debit strategy. What strike prices? So let's go into detail on what strike prices and pick that. And I love taking a limited amount of risk that, nobody really wants to risk a lot, right? You don't want to risk a lot on one position. You want to risk as little as possible and get as much as possible in return. So really like putting the odds in your favor. Like if you can risk a couple of hundred and make a couple of thousand, then obviously that's the way to go. And that's the best way to scale, from 5 figures to 6 figures and 6 figures to 7 figures. So it's really excited because you can profit from the market, going up just a couple of percentage points, or like the stock goes up, a few percent, but you can end up making huge money. So let's go over that buy call option. So if I go back here, this went from late January to basically mid-February in like a little over a week. So to be honest, even if I went for, let's say I went for and look, I'm being conservative here. I can give this way more time than I even need to. Let's say I give this a full 40 days. I don't need to do 40 days at all. So what I'm going to do right now is I'm going to buy a call option, and I want to expand this call option and show you a little bit about it. So the delta here is 0.54. This is a slightly out of the money option, which is actually what we want for a call debit spread, because a call debit spread is a bullish strategy where we want to put up a little bit of capital and we want a huge return. So you don't need an in the money option. You can actually buy slightly out of the money because we expect to move here to 140, right? In this example. So let's go for 130. So we buy the call at 130, and this is essentially going to function as our upside, because buying a call is a very bullish strategy. However, this strategy right here costs $11 or $1,100. Now to reduce the cost here, which is what a call debit spread is, right? It's a spread because it includes two options where you buy one option and sell another option. So we did step number 1, which is buying the 130 call option. Now step number 2 will be selling a call option. And again, 140 would be the target that we want to go for. We don't really want to go for less than that because, again, a call debit spread is betting on momentum. So when momentum is high, you want to jump into a stock and really ride that momentum and profit off of that, essential swing. So big swings are actually a really good thing. Remember I was telling you in the beginning of the course, option volatility is a good thing. Market volatility is a great thing for a trader. And this is a strategy where you want volatility. You're excited about volatility. So you can see here how I bought the 130 call option. They're the same expiration date. So you'll notice that one is a buy and the other one is a sell. And the sell here is going to collect $680 for us. So because we're collecting $680, our true cost is only $420. So here we're going to risk $420, and our maximum gain, if Nvidia were to go up to 140, would be $10. So essentially you're putting up 420, and then you can make 1,000. So from 400 to 1,000, it's essentially like a 2.5x return. So if Nvidia goes up to 140, which is honestly just less than 10%, if the stock goes up less than 10%, because 10% of 128 is a little bit over $12. It's like $12.87. 12 plus 128 here would be over 140. So again, the stock doesn't even have to move 10%. It can move 9%, 9-ish%, and your option basically experienced a 250% return. You turn $400 into $1,000 or $4,000 into $10,000. So this is obviously a very lucrative strategy. It does involve some timing because it's an option buying strategy. And when you're buying an option, you need it to move within that specific time frame, which is actually why I decided to pick the March 21st, because I want you to be in the habit of being conservative. Because like a lot of my students, they come in and they want to get aggressive from like day one. But if you start off conservative and you understand how to make, $1,000 a week, $2,000 a week, it's easy to scale up, right? But if you lose your capital and you're too aggressive from day one, then like you don't have anything to scale up, right? So it's a step-by-step process, and I always like recommend that even if you're trading a small portfolio, you want to treat small amounts of money the same way that you would treat large amounts of money, right? So you need to understand how to treat a $10 bill before you can treat a $100 bill, and then thousands, and then tens of thousands of dollars. So even if you have a small portfolio, you still need to try to manage your risk by not putting in more than 5 or 10% into a call debit spread position. And it's best to have like multiple different positions open. You don't want to have like one call debit spread that makes up 25% of your portfolio, because what if that position doesn't really go in your favor? Then you end up losing money, right? And then you don't really get that money back when you're buying an option. It's not like selling puts where you get a sign, then you can wait. No, like you lost money because you purchased an option. So now I have a big portfolio, but I still do like, 1% per position, maybe even less than 1% because I have a bigger portfolio. So I'm paying very close attention to managing risk. So if you have a small portfolio, you still have to not have more than 5% per position. And then in terms of your overall portfolio, it's called asset allocation. This is something that I focused on very heavily when I was working at Goldman Sachs, and I was working with financial advisors who were meeting with their clients and trying to understand how do we manage risk and how do we preserve wealth. Okay, this is a very big topic. We were looking at essentially how much is it okay to put into one position, and how much is it okay to put into a sector, and how much is it okay or optimal to put into a strategy. And when looking at the call debit spread strategy, you should essentially have honestly 10%. It depends on your portfolio size, and there are other factors which are individual to you. That's why I do my one-on-one coaching, because it varies. If you have a longer time horizon, then you can definitely dial in the risk. You can go heavier on the risk. But if you really have to scale your portfolio, but you can't afford to lose the money, which I get it, nobody can afford to lose the money. But I'm saying you're really tight and you need this to work. You want to go lower on the risk, then you would only have 5, 6, 7% in the call debit strategy. Or let's say that you have a bigger portfolio, but you're older, or you're really close to retirement. You also might want to go lower on the risk and aim for more consistent returns. Because what I see is when you're younger and you're earlier in your career, you can be a lot more aggressive. When you're younger and earlier, you can just take on more risk, right? And you can afford to potentially learn from mistakes at the trade-off of you might get rich really fast. And that trade-off makes sense when you're younger or you have a high income. So you really need to decide for yourself, but I would say definitely understand position sizing. And I think it's really imperative to understand how to manage the strategy. And I'm going to talk more about that. So let's say that you open up this position. Let's talk about some scenarios of what might happen, right? There's a few things that could happen. First of all, Nvidia could not go in that direction, right? It could decide to pull a 180 move and just continue to go down. It could recover here and then down. And that could happen for a number of reasons. Could be simple, like some bad news, or the whole market comes down and then the single stock goes down, right? Single stocks will move with the market. There is a deep correlation there, right? When one stock moves, the other stock moves as well, in the same sector for sure. So when you notice a tech company reports earnings, Apple reports bad earnings, it goes down, so will some other tech companies as well. Google will come down, Amazon will come down. And the same thing can happen for any single stock. So, maybe, something in the AI space reports bad earnings, or DeepSeek comes out, which it did, right? Not that long ago. It can take the market down. So if that scenario happens, essentially, you need to just cut your losses. For me, when a call debit spread goes down 50%, I don't have a stop loss order in place. You can have stop loss orders in place. From my experience, they can get you in more trouble than not. So I personally don't even teach stop loss orders or limit anything like this, because options are volatile and sometimes it'll hit your limit and then you'll get sold out of a position, then that position recovers in that same exact day. And it's the most frustrating thing. So, I'm trying to teach you guys how to have that consistency, right? It's all about consistency and safety. if I was a father and I had a son and like I was living in like, I was really, really poor, and I would probably, like my parents from Eastern Europe, like they lean on doctor, engineer, lawyer, like those type of professions are safe. So that's what I'm gonna recommend for you as well, to go like the safe route and cut your position at a 50% loss, okay? So 50% loss just means that your total cost here is $420, right? As you can see, if this option is now worth $210, then you should probably take a loss and just cut the position so you protect yourself from losing 100% of what you pay. That is a really good like risk management that you can have in place and protect yourself. Now, the other scenario is kind of like that middle of the ground scenario. And let's say that NVIDIA goes up and your break even here is $134.08. Let's say that like the stock goes up and it's like 135 or so. You still need to manage this position properly because you did pay a total cost of $420. So if you were to wait up until expiration, the last day, and NVIDIA ends at like 135, right? Then yes, this call debit spread is essentially $5 in the money, but you paid $4.20 to buy it. So your actual return isn't really that much. You paid 20 and then you're getting $5. So you have a profit of like 80 cents, which granted is a good return. Like 80 divided by like 420 is like a little bit less than 1/5. So it's like a 19% return. All right, I'll put up on the screen whatever that return is, but it's probably like 18.7% return or something. That is a good return. However, with call debit spreads, when I do them, they're a smaller portion of my portfolio because they're meant to be like higher risk. So for me, like I'm looking to really create a big return. Like I really want to scale fast and I want to get those aggressive returns, because essentially the buying strategy isn't as like stable as a selling strategy. So when I'm looking at buying options, I'm trying to like multiply my money. I'm trying to like have like a 2x, a 3x return, right? So here, like the ideal scenario would be for NVIDIA to go to like 140 and above. So the way you would manage it, if it's around 135 and like time is running out, thing is your return is going to actually be higher if you end up closing the position before expiration. So let's say that this position expires on March 21st, and right now it's like almost mid-February, right? So in early March, again, I open this option up a little bit more in time. It has 48 days until expiration. You can go for like 2-3 weeks. So let's say it's early March and NVIDIA goes up to like $135 per share. What I would personally do is I would close out the position for a gain. So that's because if it's March 1st, the position is probably worth a lot more, because the long option, this 130 call option, is going to have a higher delta and less sensitivity to time, whereas the 140 is going to have a lower delta and it's going to be decaying a bit quicker. And for that reason, when you have like a short-term like gain, you may already be up like, if it went to 135, you would be up more than, it would be more than $5 for sure, because there's still time value left, right? Going back to intrinsic value versus extrinsic value, this option would probably be worth a good amount more than $5. Let's say that it's worth like $6.20. Well, I would prefer to take $6.20 than, wait an extra week or two and that option to potentially go down to just the $5 mark. Because at $6.20, well, you get pretty much a 50% return, which is more than double waiting until expiration. This is a case-by-case basis. I'm trying to lay down the framework and the rules that I follow. Sometimes in the third scenario I want to go over, it does make sense to hold on to the call debit spread until expiration when a stock has good momentum, right? So going back to NVIDIA, the RSI here is really good. So me personally, if I had to guess which scenario I would go for, like NVIDIA going down, I don't think so, because the bullishness is really real here. The RSI is 48 and that's not high and it's increasing, okay? So that's one, stock's increasing. And then also obviously I was an analyst in software, so I researched the stock a lot. I've been talking about Palantir and NVIDIA and Tesla for a long time, and they contributed to millions of dollars in gains for me. So in scenario 3, which is the scenario that I believe in, I would hold the call debit spread up until most likely expiration. I may make a judgment call in the last 3 days, okay? So in scenario 2, I said in early March. Scenario 3, if the momentum is good, then I won't take profit early because the momentum is still continuing. So if the momentum looks good and I don't see any pullback or any signs of a momentum shift, then it's going to be a continual hold, maybe even through like expiration, where I only close the option out for a profit on the Friday of expiration, the Friday morning. Another thing that could happen, actually this would be the fourth scenario, is that Nvidia just simply have a good time and Nvidia goes past 140 like this, and the stock just blows past your top end call option. So if it's above 140, you won't make any more money, but I guess you don't do anything. You literally just chill out, relax, and don't do anything, because if it's above 140 and it's a good amount above 140, then at expiration you've essentially collected the full $10, which is pretty much the ideal scenario, because you would turn $4 into $10 if Nvidia goes up to 140 or above at expiration. So that's like your ideal scenario, and in that case you would have a 2.5x return. I've seen a lot of students like scale their portfolios fast, because obviously a lot of folks are inspired by my story from going 100k to 700k and then start traveling the world and having a lot more freedom, time, and I don't have a boss. I do these videos because I want to. I love what I do. I definitely have enough money to just chill, but a lot of my students were, really seeing the opportunity with call debit spreads. And I had to actually kind of like help them understand the risk management side of things, because yes, it's very exciting. Like, can you freaking imagine if you went from like a 50k portfolio off of one trade in 40 days, you went from 50k and you 2.5x. A 2.5x means a 50k portfolio would be 125k, okay? That's literally like a whole entire year's, more than a year of savings for a majority of people, right? $75,000 in like growth in 1 year on a 50k portfolio is like some serious celebration, right? I mean, that's some serious, amazing results. I had a student that went from 220k, he was out in Europe, 220k euros to 360k euros, and that in 1 year is also like a really good return, like over 50%, amazing. So yes, it's amazing, but also you need to have a small amount of your portfolio in this position, because in a bear market, call debit spread can absolutely lose 100% of its value. Or, again, if you follow my risk management principles, then you would monitor the position and close it at 50% loss. But still, 50% losses are not too fun. Overall, I'm going to say the call debit spread strategies is one of the best strategies, which is why I decided to spend some extra time on this strategy. And I want to show you one more example. So we went over an example on Nvidia, but I want to go over another example on Tesla specifically, because Tesla is actually one of those stocks where I was using the leap strategy and the call debit spread strategy to get these, big results and get my portfolio to a really big level. So I want to go to trade Tesla options. And again, we're going to go to the technical analysis here and show you the difference of, just looking at a different opportunity here, which is Tesla. So if we look at Tesla here, it's going to look a lot different than Nvidia. So Nvidia is coming up from a bottom and it's spiking right now. Whereas this is like a little bit different of a pattern at the moment. And again, it doesn't matter what stock you look at. I'm just trying to give you more repetition, more reps under your belt. So then you're more inclined and more experienced to spot opportunities for yourself. I'm trying to teach you how to fish. So I'm just using Tesla as an example, but this is a stock that I have traded a lot, like a tremendous amount. And this pattern right here is like generally not really a good pattern when you have multiple days of selling. However, it is a really interesting pattern because this is kind of like a falling knife pattern. So the stock was well over 400, now it's at 51. And what I want to point out is that it's at the bottom of its Bollinger Band. Statistically, it's fairly cheap, and this is like unusual behavior, okay? So it doesn't mean that the stock's gonna stop immediately, right? It's not gonna stop like right now, but it is like a good opportunity to jump into a stock when you see it at the bottom of its Bollinger Band. You can also see the RSI here is pretty low at 37, and oversold, like super oversold territory is like 20. Kind of oversold is like 30. So this stock is like somewhere around a really good value. So for me, like I would have absolutely no problem if I didn't already own a ton of this stock. And again, this is just it's an example. So I want to show you what I would do. So I would go buy call. And again, let me show you like a little bit of a variation, because I want you to really get a grip on something different. So I'm gonna go to something a little bit shorter term. So let's say that we're gonna bet on a short-term reversal. This is not super safe. It's not mega risky either if you're using 1% of your portfolio. The reward can be so juicy that you can retire a lot faster. Basically how I retired really young in my 20s, calculated risk. Like I've understood where to take proper risk and where the opportunity was. One opportunity that I like to use with the debit call spread strategy is a reversal in a stock. Right now, this is a perfect setup to make a bet on a call debit spread reversal. A reversal is when a stock has had many multiple days of downward movement. Stocks can't just go up to the moon, but also can't really crash unless it's a bad company. A company that's making money, sells a real product or a service, has a good brand, probably can't have 15 days straight of bearish movement, right? It's just not really gonna happen. So you can bet on a reversal. And actually I can show you a reversal, like a much shorter term reversal, like a 12-day call debit spread of how much money you can actually make on this. So let's say that you want to get into like a heavy reversal, which just means like you're going to buy like slightly in the money option. Okay. So this is like probably a little bit more advanced of a strategy, but again, I did tell you that we're going to go from beginner to advanced, and I believe in you. And I know that you're capable of doing it. If you've made it this far in the video, that means you have the attention span to like listen to my video, which tells me that you're like above average IQ. I already know that for a fact. All my successful students, like they finish a lot of the free courses I have, which obviously means like they're capable of more. So congrats on that. So like, let's talk about this advanced strategy right now. On Tesla specifically, like you can buy an in the money call option and bet on a reversal. And this delta right here is basically 0.6. So this is kind of like a variation, a little bit of you can start to put the pieces together. This is like a variation of a leap. Like when you buy like a deep in the money leap call option, right, at a 70 delta, this would be like a little bit of a cousin, right? So we're gonna go a little bit in the money, 60 delta, and then we're just gonna do like the same thing, right? Like we're just buying one call option and selling another call option. But you can bet on like a bigger reversal. And I'll show you two examples real fast. So let's go for buy call and let's sell a 365. So I want to do a $10 gap. I'll be honest with you, sometimes I do $5 gaps and sometimes I do $10 gaps. It just depends on like a lot of factors. Well, one of the factors is like how much do I think the stock is going to go up? How much do I want to risk in the trade? How much capital do I want to outlay? So it depends, but the two standards that I use like on my coaching calls is like $5 gap and $10 gap. $10 gap, probably the most popular for me. Number one is going to be the $10 gap. Later on, when we talk about like credit spreads, I prefer $5 gaps more than $10 gaps. But for upside strategies and bullish strategies and call debit spreads or put debit spreads, all the debits are $10 strategies. So check this out. This strategy right here is also going to get you roughly a double. But the craziest thing is you have to notice that Tesla is already slightly in the money right now. So the stock right now is at 357 and this option right here is at 355. I'm getting a double on my money and it's already in the money. So there's even bigger odds that this stock will end in the money because it's already in the money. So this would be like a really strong reversal trade where you can like double your money and go from like, you know, the maximum loss here is around $513. It says 540 here. Obviously it depends a little bit on the bid ask spread. So something that you have to be aware of is, again, the bid-ask spread. You have to look out that you're not losing too much money in the bid-ask. So here it's 17.15 and then 17.6. This is why like later on when we talk about iron condors and like more than two leg options, it gets very important to look at the bid-ask because every time you trade, you're essentially losing money to the bid-ask spread. So the tighter it is, the better. However, right now I'm in pre-market, so you know, the bid ask is going to be probably much better for Tesla, especially because the volume is pretty good. So again, when the market opens up, you want to look like what I would look for is I would look for a bid ask spread that is at least 30 cents apart, 40 cents apart. But you know, this right here is like a 45-cent apart. It's still okay because this would be a really profitable trade, but it's just something to be aware of. Essentially, you can double your money. I'm going to show you another like slight variation here of understanding like what strikes to pick because you know there's a lot of options here. There's as many options that you can choose from as there are chess moves on a chessboard. So what I'm going to show you right now is a slightly out of the money option, then we'll compare the risk and return to the other one. So the first example I just did was like 355, it's already in the money. Now 360 would be slightly out of the money, right? And then I just want to point out that we can also go up for like a $20 gap. So let's say that we think there's going to be a monster move. So I can go for a buy 360 and then sell 380. And now this would give you like a monster move potential. So the potential here is huge. For example, like the total cost here is like $800, but the total return here is $2,000. So if Tesla were to move to 380, then you would make essentially $2,000. So this would be like, again, like this would be 2.5 times return, which is very similar to the NVIDIA example. funny enough. So this would also be a 2.5x return. And I would probably not prefer this play versus the first one, because the first one is like you're already in the money. And yes, it's only like a 2x, but you're already in the money. Whereas this is like a 2.5x return. However, like the stock actually has to significantly move up for you to get a gain. So this would be like a mega bullish strategy where you would want to pick a stock that's about to like skyrocket and explode upward. So this is just preference, right? Like the first one is much safer, but slightly like lower return. Whereas the second one is like higher return. Now I do want to point out that you can also go like even more bullish, and you can like take a longer term view. So call debit spread. And the reason why I want to also go over this strategy a lot is because if you understand this strategy, like you've kind of, to be honest, like mastered the basics of options. Like if you understand what I'm talking about right now, it doesn't really get that much more complicated. Like you get it. So yeah, that's why this buying strategy is like, I think, a really good example. So let's go for something like, let's pick an expiration that's like 6 months out. And I'm going to show you how much money you can make like on a longer term option that's out of the money. So say for example, like, you know, you got 6 months of time. Let's say that you buy the 400 call option here, which is a 50 delta. It's actually pretty wild because a 50 delta is usually at the money. The 400 call option here is like very out of the money, but it's still 50 delta, which just means there's a big skew for the call option. There's a lot of demand for it. So if I buy this call option and then go to sell, I can go up as much as I want, really. You can actually go up to 500, for example. I'll show you what that would look like. So if I went up to 500, you'll see I have huge difference in my strikes. So 400 to 500 is a whole $100, right? That's like a whole $10,000. And the total cost here would be like $23 or $2,300. In this example, you can turn $2,300 into $10,000. You can more than 4x your money. You want to use technical analysis and you pick stocks where you think there's a lot of upside for this strategy. One more thing about managing, and then we'll wrap up and go to our next example. One thing about managing this is you do not need to hold until expiration. Oftentimes when I have a call debit spread, treat it like a leap option or a poor man's covered call, where if I'm happy with the return, I will take the return. There's no need to hold the option up until expiration. For selling strategies, I am holding more so till expiration, but for buying strategies, it's all about managing and taking profit at the right time, which is case by case, but my general rule is if you're up 50% on the position and it's only been like 30 days, that's obvious. Like take profit if you get that big of a return. Now this option expires in 6 months, so I would probably reassess this option every single month. So in the first month, if I didn't get 50%, cool, I'm gonna still hold it. Second month, I'm going to see, hey, let's say that, you know, the stock went up to like $439, right? And I'm up $1,600. Well, to be honest with you, $1,600 on an investment of $2,300 is like a 75% return. So I would take profit after 2 months if I have a 75% return. So anyways, we'll go over more examples as we continue on with more strategies. All right, I hope that example is really interesting for you about a bull call spread. I know you probably are wondering to yourself, wow, this is amazing. What else can I learn about spreads? Well, the next thing that you can learn in the spreads foundation is a bear put spread and how that works. And it works in the same exact way as a bull call spread, but a bear put spread is betting that the stock will go down. Instead of buying a call spread, a put spread is used to profit when a stock declines. For example, let's say we have XYZ stock and it's trading at $180 and a bearish position is needed. A bear put spread could be placed by buying a 180 put option and selling a 170 put option. A bear put option is also the same thing as a put debit spread. Again, two terms, they just mean the same thing. So I'm going to actually refer to it as the put debit spread. For me, that's what I was using when I was working on Wall Street. So if the 180 put costs $8 per share, and the 170 put is sold for $4 per share, the total cost of the spread is $4 or $400 per contract. If XYZ stock stays above 180, the entire 400 is lost because again, a put debit spread is that we want the stock to go down. We're buying put options and then we're subsidizing the put option that we purchased by selling another put option. If XYZ stock drops below 170, the spread will reach its maximum profit of $600 because it's a $10 gap We paid 400, so our profit is $600 potential. If XYZ stock lands between 180 and 170 at expiration, the profit will be somewhere between negative $400 to $600 of profit. You see, if it's at 180 exactly, it'll be at a loss of negative 400. If it's at 179, it'll be a loss of 300. If it's at 176, you will break even. If it's at 175, now you're in the money. Now you're $100 in the profit. If it's at 171, well, you have a profit of $9, but you paid 400, so you'd have a profit of $500 in this example. If it went down to 170, that would be your maximum profit of 600. If it went down to 160, you would still only have $600 of profit. No matter how low it goes, your maximum profit can only be 600. Just like the bull call spread, a bear put spread or the put debit spread has a limited risk. You can only lose what you put up and has a limited profit potential. You know exactly how much profit you can make. In other words, you know your risk and you know your return. Instead of buying a single put, the short leg offsets the cost, making the trade more affordable, but also capping the upside that you can make in terms of profit. So let's go over some examples of put debit spreads. I don't use them a lot in my trading strategy, but they are a great way to hedge, especially if you see some bearish movement in a stock. So let's go over an example right now. All right, now I want to talk about put debit spreads. This is buying put options essentially, but subsidizing the cost of buying put options and selling another put option to lower the cost. I haven't used this strategy for a long time, but I'm going to briefly go over it. So say we have a stock. Maybe I'll use a stock that I think is fairly expensive. So, we can look at my stock list. I have a lot of things open right now. We can look at a stock that, we can use Meta, for example, here, because Meta is, fairly expensive. Again, I'm not making a directional claim or move here. I just want to show you a stock that is probably near an all-time high. So here's Meta. It's trading for a very high amount. It's at $721. You can see how the stock basically went from $612 to $721. So it gained over $100 per share. And I think that all happened in, essentially 1 month. So let's just say for whatever reason, doesn't have to be Meta, any stock has gone up a lot and now you predict that it'll go down. So let's say that we have the stock retrace back to the mean. Here's a chart of Meta, by the way, because I wanted to use some technical analysis. You can see here how the Bollinger Band expanded significantly and the stock has shot up a lot. But the moving average, it has gone from like 609 to 646. So the moving average is basically smoothed out because it's an average. A moving average over 50 days will be, how much the stock has traded at for the last 50 days. Average. So it's going up because obviously Meta is going up, but let's say that we think the stock will retrace back down to, let's say 650, not even the moving average, still above the moving average. So if it retraces back to 650, a put debit spread would literally print a ton of money. So let's say that your view is 650, then you would go to buy put options. And we need to basically take a 30-day look here. So I'll go for March 14 expiration as I'm making this video. Because like the Bollinger Band here is a 20-day Bollinger Band. So 20 trading days is essentially like 1 month. So I'm gonna go for 1 month, buy put option, and we wanna buy an out of the money put. The 700 put right here is a 32 delta, so that's perfectly fine. I'll show you a couple of variations here. So if I buy the 700, and then again, we think that Meta is gonna go to 650 in this example. So we're going to sell the 650 put. And this is essentially the strategy that we're using for buying puts and making it a put debit spread is that you buy a put option and then you sell a put option at the lowest point you think the stock will go. So, we think it'll go 650 at the lowest. So here you would pay $10. And if Meta went down to 650 at expiration, you would turn a $4,000 profit. You would turn $1,000 into $5,000. Obviously a really huge gain. And the reason why this is such a huge gain is because the risk on this trade is definitely high. And this is not even a trade that I utilize in my coaching. But if someone has a really strong view or you have a strong view, you can go for this trade. This is not something I use. All right, so those were 2 debit spread trades. We talked about bull call spreads, or call debit spreads, right? Same thing. And bear put spreads or a put debit spread. Okay, those are the 2 buying strategies for spreads. The calls bet on the stock going up, the puts bet on the stock going down. But there's something really interesting, and the spreads that I actually prefer are credit spreads, okay? So we're about to talk about put credit spreads and call credit spreads. These two spreads actually collect income, they bring premium in, and they benefit in a similar way to selling puts benefits, and they benefit in a similar way to covered calls. Let's go over a put credit spread, or a bull put spread as they call it. And those profit when the stock stays above the top strike price that you sell. This is the safer alternative to selling naked puts because it has a limited risk and a defined maximum loss. For example, if Nvidia is trading at $104 per share, a bull put spread can be placed by selling a 135 put option and buying a 130 put option. So you sell the 135, you buy the 130. The 135 might be sold for $4, while the 130 might be bought for $2, meaning the total credit collected here is $2 per share or $200 per contract. If Nvidia stock stays above 135 by expiration, both options expire worthless, and the entire 200 credit is kept as profit because you've sold the more expensive option and you purchased the less expensive option. So if things expire, you have collected more premium than you have spent. If Nvidia drops below 130 though, you will see a maximum loss of $300. The 5 difference between the strikes minus the $200 in credit that you received. So you can lose $300 here. So why would you collect $200 when your maximum loss is $300? Well, let's say that Nvidia has support at $140 per share, for example, and that the put option that you sell is very far out of the money. So you see, let's say the chances of this position actually going into the money, or the delta, is super low. It's really small. So yes, you're risking $300, you're collecting $200. But let's say you have a 10% chance of losing $300. 10% chance of $300 is 30. So 180 is how much you can win, and 30 is how much you can lose. So your expected winning amount is going to be 150. So whenever you place a trade, you should say, hey, I'm expected to win here. And if I don't, that's okay too, because on a grand scheme of things, I have an edge. I'm profitable. Same way the casino works, right? If you go to the casino and make one bet, they may lose. But if you make 1,000 bets on blackjack, they're going to win about 51% of the time, and you're going to lose about 51%. Bull put spreads are a lower risk way to sell options while still benefiting from time decay. Instead of taking unlimited risk with a naked put, the strategy capitalizes on being able to put up much less capital up front and still be, fairly bullish. Actually, the put credit spread strategy is really interesting because if a stock goes up, you'll still make money. If the stock goes sideways, you'll make money. And even if the stock goes down, as long as it's above your strike price, you'll still make money. Let's go over an example of a put credit spread and show you guys my portfolio and go through some examples live. Alrighty, now let's use my portfolio and talk about a put credit spread. This is a strategy that I absolutely love. So put credit spreads are great because they bet that a stock won't go too much lower, meaning that the stock can go higher, you'd make money. If the stock goes sideways, you'd make money. And if a stock went a little bit lower, you wouldn't lose as long as it stays above your strike price. I don't know if I have any put credit spreads in my portfolio right now, but I'm happy to open some for you guys watching right now. So let me try to pick a stock that I think has a good setup. I think Tesla actually has a good setup right now since Tesla has fallen down a lot. And specifically today, Tesla's down like almost 5%. So I am going to open up a put credit spread here. Over the last 3 months, Tesla has actually had a negative return, slightly negative. It peaked at $479 per share, and now it's down to like $333. So I'm going to go to trade Tesla options. I'm going to go sell put. I'm going to look for an option that's out of the money just to be on the safe side. If I look at the 300 strike, it has a 24 delta. The bid ask is really good. The volume is like build. The volume is 14,000 today. So I'll go for this. I'll sell this put option. Now for me, a put credit spread, I typically do a $5 width. So 300, $5 down would be 295. So I'm going to buy the 295 here. And this is actually going to be a really nice return. So to explain, as long as Tesla stays above 300, then I'm good. If it goes below 300, the way I would have to manage this position is by immediately closing out the trade as soon as it hits 300. If Tesla hits the top strike price, I would not roll the spread, because rolling spreads is very challenging. I would just close out this position. I would take a loss and I would protect from having a full loss. So yeah, this trade right here, 300 put, sell, and 295 buy. I'm going to hit continue, and I am going to go for 15 contracts here. So if I go for 15 contracts and I go for the 1.2, you'll see that I can collect $1,800, And this $5,700 you can lose. Unlike a sell put position, here you can actually lose the entire amount if Tesla were to close on March 21st under 295, which is exactly why if the stock were to hit 300, I would try to basically not lose anywhere near the 5,700. I would close out this position early, therefore saving myself like thousands of dollars, right? So at most, I would probably lose $2,000, but here you can see that the delta is 0.24. So 3/4 of the time, I'm good. 1/4 of the time, I'm going to lose about like something like $2,000. So if you actually do the math, 3 out of 4 times I make 1,800. So, that's 0.75. 3/4 of 1,800 is going to be 1,350. So my expected win here, I'm just doing some math, is 1,350, right? 3/4 of the gain here is 1,350. And then 1/4 of the time, I will lose $2,000. Just being honest, like this is a riskier trade. Spreads are riskier than selling puts and covered calls. So if I lose 1/4 of the time, that's an expected loss of $500. So my expected gain is 1,350. My expected loss is -500. So that means that when you add those two up, I get an expected gain, overall net expected gain of $850 for this position, which is, pretty good. Obviously that's like a high return, and long-term it's profitable. So that's the most important thing. So I'll review this trade and I will submit this trade. So again, I just collected $1,800. This position will most likely work out. Tesla has good support at $300. It's unlikely to go there, but there's a 25% chance. And as soon as it hits 300, I'm going to manage this position by basically looking at my risk management and saying, hey, like I don't want to be under 300. Obviously, I'm going to lose more money and I want to cut this position because the longer you wait and it's in the money, your option here that you purchased is going to go, this option position will end up losing you the difference in the strike prices, the $5 minus what you have collected. So I've collected $1.20, but what I can lose is going to be $3.80. Again, you only lose the full amount if you wait up until expiration, and at expiration it's below 295. So if it just hits 300, it's probably only going to be down a little bit. It's hard for me to calculate that right now because it depends on many factors and it depends on future volatility. It depends on the Greeks, as you already learned in this course. So it depends on delta, on theta, on gamma, on vega, rho, and all the Greeks that we covered earlier on in this course. So the best way to go about this is to manage the position by closing it if it hits 300. And if it stays above 300, then you're good. I know it can be intimidating sometimes if the stock continues to pull back. However, if it's out of the money, it's out of the money. You shouldn't touch it. All right, let's talk about the fourth spread, which is a call credit spread. It's selling one call option and then buying another call option. A call credit spread profits when a stock stays below a certain price. For example, if Apple is trading at $200 per share, a bear call spread can be placed by selling a 205 call option and then buying a 210 call option. If the 205 call is sold for $4 and the 210 call is bought for $2, the total credit here collected would be $2 per share or $200 per contract. If Apple stays below 205 by expiration, both options expire worthless. And again, because the option that you sold was the more expensive option for $4, and the option that you bought was the less expensive one for $2, you have a net credit of $2. So this is why it's called a call credit spread. This is the way I refer to it, call credit spread. It's a call credit spread because the difference within the strike is gonna give you a credit. The difference is 5, and the credit in this example is a $2 credit. So a credit spread is perfect for situations where you don't really think the stock is gonna go up that much. So say that, Apple, for whatever reason, has been going sideways, it's hit a 52-week high, and $200 just seems to be a resistance point. Well, if it's a resistance point, it's a 52-week high, and the stock is going sideways, and there's no catalyst, there's no earnings, there's no events, then, if you saw a 205 call credit spread, for example, then the stock is unlikely to go to 205. So, if it stays below 205, then you collect a $2 credit. And again, in this example, you'd be risking $300. So if you collect $2 and you risk $3, or you make $200 by risking $300, then this is a 67% return. So in a single month, you can make 67% returns by doing spreads. Like 67%, it's like pretty wild actually. So you can collect $2,000 worth of income and risk $3,000. And you can also put the odds in your favor and say, based on technical analysis, fundamental analysis, etc. If you don't think that's going to happen and the chances are low, then of course, why wouldn't you make 7% per month? That is such a huge return. And you can just imagine how that scales, right? If you have a bigger portfolio and use a portion of it for spreads, let's say you use 30K of your portfolio to make 20K a month. pretty big results, right? So you can make 20K a month by like risking 30K. So call credit spreads are used in situations where you just don't see the stock really going that much higher, where it has resistance. And then when you sell the call credit spread, you're using theta and time decay in your advantage, right? So again, I'm an option seller mainly, and I love option selling because if nothing happens, the stock continues to go sideways, every single day that option is decaying. As that option is decaying, you're basically profiting daily income. Like it's not entering your account, but every single day this call credit spread is losing value. And because you've already sold the call credit spread, it's a selling strategy. Every single day that it loses value, you're able to buy back for, a profit at any time you want, or just hold it until expiration and then realize that full profit of, $200 for the $300 worth of risk. This is a super versatile strategy. It's fantastic for hedging. It's also fantastic for taking some profit off the table. And there's just many ways to use call credit spreads for income. Let's go over some examples using my portfolio. Alrighty, now I want to talk about call credit spreads. Here's my portfolio, and I'm going to look at a call credit spread position that I recently opened up in my Discord community. And I want to show you why I opened it up and more details about how a call credit spread works. So I'm also up $250,000, and despite some of the market turmoils and volatility, I've had a fantastic all-time high in February. So let's go to a call credit spread. Honestly, I have not used call credit spreads for a long time, and that's just because you don't want to use this strategy when the market is bullish. So the market has been bullish for last year, 2024, and 2025 so far has been pretty bullish as well. A call credit spread is a good strategy for when a stock is like near an all-time high, or if a stock has like already peaked. And the only credit spread that I recently opened up is a Palantir call credit spread. So I'll explain to you what this means. Although a call credit spread is pretty much a bearish strategy, you do need to understand that you can make money on a call credit spread even if the stock goes up, sideways, or down. So Palantir is currently trading for like $113 per share. I don't think it's gonna hit by April of 2025. So I opened up this position. This position was essentially to hedge some of the Palantir gains that I've had. So a credit spread is good for betting that a stock won't rise too much. This position right here will benefit as long as the stock does not go to per share, which is a lot, right? It's very, very far away, meaning this is a very safe trade. So the spread is a super safe trade here because I'm going very out of the money with a very small delta. And as long as the stock doesn't hit 60, this call credit spread will be out of the money. So I ended up going as far out as possible, selling a 160 call and then buying a 170 call. And you can see here I had two transactions. I opened up this trade February 10th, and then an hour ago I opened up and double down on the position and basically collected $1,500 more. So you can see here how I have 50 contracts to sell, which is the closer to the money one. So 160 is closer to 113 than 170. As stock's at 113, as long as it stays below 160, we're good, right? So it's really far out of the money, and a call credit spread is a good way to collect income, and it's a good way to protect your gains. So say a stock goes up a lot, you don't want to sell it, right? Well, one good thing that you can do is you can bet against it going up further. And that doesn't mean right away further. I could have sold the Palantir 120, 130, but I don't know. It's a very volatile stock. So I went very high and I sold 160, 170, which is significantly higher than the current stock price. So this is a call credit spread example. We're not gonna spend too much time on it like we did with the call debit spread because I don't use the strategy as much. All right, congratulations. If you watched the whole course up until now, you're seriously ahead of at least 95% of people who clicked on this video. This part of the free beginners course is going to be all about rolling, adjusting your positions, and getting out of tricky situations when option positions are not going in your favor. Essentially, we'll be talking about managing strategies and understanding how to navigate and manage a position that might be making money, maybe it's not making money, or maybe it's losing money. So we'll be going over many different scenarios. It's impossible to win on every single trade. I've never seen that before. I definitely have losing trades all the time. Maybe 1 out of 10 times I'm losing on a trade, and it just depends on how much risk I'm taking. I've seen win rates as high as 95%. I've had many streaks of months in a row where I was winning all the time, but market sometimes does pull back. It's important to understand how to navigate those type of situations. So I want this part of the course to show you every single thing that you need to know in order to manage a losing position, adjusting and rolling a losing position, preventing a losing position, and even how to make sure that your winning positions can make more money, how to make them run further and stop them from becoming losing positions. So first of all, let's get into position management, which is one of the most important skills for option traders. Knowing how to manage trades, adjusting positions, and rolling contracts effectively can be the difference between a winning trader and a losing one. The first thing to understand is that options aren't a set it and forget it type of trade. Some positions are, like when we talked about selling put options, I set a position and I pretty much set it and forget it because I'm looking to get assigned. However, with other positions like a covered call, you might not want to lose your shares. With other positions like spreads, you might not want the stock to go, into the money. And if it ends up in between the strike prices of those spreads, that can also be a dangerous situation because you could get assigned on one part of the leg and not the other leg. That's why the best thing to do when a spread goes into the money and there's only a couple of days left, it's best to close out that position without having to really risk it by going into the last day of trading and potentially having part of it assigned and the other part not assigned. So a spread can be more dangerous when it's expiration day and the stock is between the strike prices of the spread. Every position that you have should be monitored, but I wouldn't say that you need to monitor it every single day. For me, it's Monday, Wednesday, and Friday. I take a look and I have coaching sessions, 45 minutes, and on Fridays, if everything's good, then it only takes 15 minutes. But if things are not going according to plan, then I will, roll, adjust, and that could take me a little bit longer. So again, it could be 45 minutes. There are three main types of position management, and I've actually never covered this anywhere on my channel, but this is gonna be really important stuff, so take some notes. First one is profit taking, the second one is risk management and mitigation, and the third one is trade adjustments. So let's talk about the first one, which is profit taking. This is about locking in gains before the trade reverses. A common mistake beginners make is they hold the position for too long, waiting for every single last dollar of profit. And the reality is that options can lose value just as quickly as they gain value, and it's important to take profits at the right time. A good rule of thumb is I typically follow to close a trade when it is like 50 to 80% of the maximum profit when it's reached. Again, I do have a formula that's actually like a mathematical formula that I follow in the Discord community, and it essentially has to do with the annual return that I have left. By simply explaining it, I would say that if you've made a majority of your money in a quick amount of time, it's time to take profit. If the option seems to be like making money in a linear fashion, say like, the option is like 30 days to expiration, 15 days has passed and has decayed 50%, well, it should intuitively tell you that you're making, proportionate money to time here. So like half the option's expired roughly, and then half the time is left. But let's say that there's a 30-day option and 15 days has passed and you've made 99%. Obviously, like you would close that trade. And then on the flip side, let's say that 15 days has passed on a 30-day option and you've only made like 10%. Well, that's good because then you have 90% more of the option premium to like realize over the next 15 days. So depending on where that option is and how much it's made and how much time is left, that's how you make a decision. So if there's a lot of time left and there's a lot of money left, good. If there's a lot of time left and not a lot of money left, well, it's time to take profit and close out that trade. So let's go over some examples. So let's say that a covered call was sold for $3 per share and now it's worth 60 cents, meaning that 80% of the profit has already been captured. It's usually a good idea to close that position instead of waiting for the last 60 cents. Holding on to a trade for too long exposes you to unnecessary risk, like I said in stock rally that wipes out your gains, or a stock going down in case of a selling put strategy. So risk mitigation is about limiting losses when a trade goes the wrong way. A trade that starts off well can suddenly become unprofitable. So what you want to do is, again, if you make fast money, take the fast money and run. And if you're making slow money, well, that's fine as well, because if the option has a low delta and you're still out of money, there's not that much risk. So again, you're just trying to calculate risk and return, and it can vary significantly, which is why like some of the best option traders have the most experience under their belt, because just like anything else, it's all about experience and seeing many different situations. And the more time you put in, well, you have more experience and then you understand how to manage your positions better. And I'm trying to give you that foundation, but it still has to come down to experience. But here's some more like rules that you need to understand. The key to avoiding big losses is by setting predefined exit points. So you need to come in with the plan ahead of time and say like, okay, if like, let's say that NVIDIA is trading at $120 per share, and then you sell a 130 covered call option that is 30 days to expiration, 30 DT, days to expiration, right? So let's say that NVIDIA goes from like 120 to 130 within 2 or 3 days, right? That's possible. So a covered call is a bullish strategy. So you are benefiting from Nvidia going up in value, but maybe you want to make some more money and you decide for yourself that, hey, the stock actually has a lot of momentum upwards, and I think the stock is going to continue running because it's in a very strong bull trend. And obviously on a covered call, if Nvidia goes from 120 to 130, well, you can't make any more money. So as soon as it hits the strike price, you should already be prepared to make another decision. The decision is, do I hold on to this position and not make any more money? Am I happy with the original return that I made? In most cases, that's a yes. But actually for me, for covered calls, I will always like roll that covered call higher, and I will move it from like a 130 covered call up to 140 covered call, okay? If there's 30 days to expiration, I will close that expiration and then I'll open up another one that's an extra 30 days. So say like I have a 30-day option that's expiring in June, and I will end up closing the June option and I'll open up a July option. So I'll go out by 30 days and then I'll try to move from 130 to either 135 or 140. It's gonna depend, and I'm gonna show you some examples. So this leads me to the third and most important part of position management, which is trade adjustments. Adjusting a trade allows for repairing a losing position, extending the trade to give it more time, or moving a trade to a more favorable risk-reward setup. We went over that, but there are still more details for you to know. One of the most common adjustments in option trading is called rolling an option position. We went over that, but there's specific processes to rolling an option. There's a little bit different of a formula if you're trying to roll a put option versus rolling a covered call. There's actually two different mindsets that you can have when you're rolling a position that is a bullish position and a bearish position. Rolling, I want to explain a bit more, is a process of closing an existing trade and opening a new one for a different strike price or an expiration date. Typically, you want to roll so that strike price is more favorable for you. So on a sell put, you would be rolling down. On a covered call, you would be rolling up, okay? And that is most of the time. You can still roll in the opposite way. That is a more advanced strategy that I won't cover just yet in this beginner to intermediate advanced course, because rolling in the opposite direction is like a very advanced strategy. But you absolutely don't need to do that to understand how to make consistent income. So for like 99% of cases, you can roll a sell put position lower, because if a sell put position goes into the money, right? So the stock goes from 120 down to your sell put strike of 100, and you don't want to take ownership of the stock at 100, you simply roll down from 100 to 97, 96, 93. And again, you're going to have to do some analysis on what makes more sense. And I'll go over some examples of sell puts in just a moment. Option trading platforms allow you to do the same one transaction in basically one click. So rolling is just done to avoid assignment, reduce risk, or collect more premium. It can be done in several ways. So rolling up to a higher strike price, rolling down to move a strike price lower, or you can also just simply roll out. You don't even have to change the strike price. So oftentimes I have a student that has sold like a 105 put option, right? And it expires in July. And they like the stock, they like it at 105, but they took money out of their portfolio and they bought a new house or something, right? They don't have the cash. So what they do instead is they like the stock, they like it at that price, so they don't roll down, they just roll out. So they roll from like July expiration all the way to December. So they're like, I'm gonna roll it to December, I'm gonna give it like, 5 or 6 months out, and that's perfectly okay. You'll get paid for time and you don't have to take assignment. So there's a lot of advantages to that. Rolling up and out increases the strike price while extending the expiration. So that's what you just saw me do with the covered call. I rolled up and out. So I went higher on the strike price and out in terms of pushing the expiration date more out. You can also roll down and out. So for a sell put, you can roll it lower and you can roll it further in terms of date. So let's go over a example so you can like visualize this more versus me just talking. So I want to show you a chart on the screen right now. Let's say that you have a cash secured put on Nike at $70 strike, and you sold a 70 strike price on Nike, and the stock drops to $65. And let's say that, this is before expiration, this is 5 days before expiration. If nothing is done, the shares are going to be assigned at $70, resulting in a loss because the stock is at $65. Instead of accepting assignment, the put can be rolled down and out, closing the $70 put, and you can sell a new put option at $65. This is advantageous because then you don't have to buy the stock right now, you push that date out further, and you don't have to buy the stock at 70, you now get to buy the stock at 65. Let's say you move that expiration by 30 days. This is really beneficial. This accomplishes two things. It lowers the potential purchase price and it allows for more premium collection, reducing the overall cost basis. Rolling covered calls works the same way. If a covered call was sold at an 80 strike price, but the stock is now trading at 85, the call option is in the money and at risk of being assigned. To avoid selling the stock, the call can be rolled up and out. So you can move from an 80 call strike to 85 or even 90. Now, I just want to tell you in advance that you probably can't move a strike price from 80 to 90 and only add 30 days and expect it to be a credit, okay? If you make a drastic roll, the more drastic the roll, the higher the roll is, the bigger the difference. If you roll from 80 to 100, that's a big change. So in a 30-day period, if you only put out 30 more days, you are definitely going to be paying a debit, which is still, it can be okay. And we'll talk about if that works and what the trade-offs are when I go over more examples. The key to rolling is to balance risk and reward. Rolling too aggressively can lead to bad trading positioning, while not rolling at all can result in losses. It's important to consider whether rolling will improve the trade, if it makes your position better, and if it gives you more peace of mind. So if you don't have to get assigned on the shares, if it saves you time, if it saves you capital, all of that is a really big benefit. So with that being said, I want to go back to my screen and I want to show you now two different examples. We'll talk about selling puts and how to roll selling puts, and then we'll talk about debit rolling. All right, so I want to talk about selling put options and how to roll them. So I'll actually click into Tesla 340 put right here. You can see that it's slightly down. So just being honest with you, like this position right here is a really new position. I sold it on February 10th and it expires on March 21st. There's absolutely no need to roll this position. This would be an example of like rolling too early. There's nothing to roll. I'm down 250, but to be honest, being down 250 on an option that's worth like $1,700 right now is essentially flat. Like that's not even a movement at all. So this position would be just too early to do anything with. But I do have other positions, which let me see if I have another put. I actually don't have another put, which is down right now. So I guess that's a good thing for me, but I need to show you guys an example. So I can show you an example of a sell put, which I am making money on, where I can make more money on it. So let's go to something like Kava. I have a 130 sell put, and this sell put right here, it expires very soon, and it only has like a week until expiration. I'm actually up 33% on this option, and this is pretty significant because, well, there's not that much time left and I've made 33% of the option premium. I would probably hold this option till expiration, but there are some ways that you can make like potentially more money, or at least show you an example of what rolling a sell put would look like. So let's go to select a new position. And this option expires like really short term, but let's say that I want to go out till July. Okay, so this is going to be a big time change and it's going to be a lot of like profits here. So I can simply go for the same strike price. So I don't have to even move the strike price. So I can go from like a 130 put to another 130 put. I can go from February to July. And you can see here, because I added a lot of time, the strike price hasn't changed, but I'm literally getting paid $5,920. So I'm getting paid a lot of money, and that's all time value. That's literally all time value. And the option isn't intrinsically in the money at all. So this is all extrinsic value. And that's just an example of how you can make more by rolling. I'm gonna show you one more example on rolling a put option. So I'll actually show you a really interesting example of rolling up. This is a little bit more advanced, but I think you can handle it at this point. It's not even gonna be that hard. So let's actually show you this NVIDIA sell put option. So NVIDIA is going up, and let's say that you think NVIDIA has now found really good support and the stock's going up, which I do believe. Okay, so this 127 put, it has made 50%. Now again, I would hold this option until expiration because there's only a week left and I'm gonna get another 50% on this option. And options, if you recall, decay really fast as they approach expiration. But what I can do, let's say I actually wanna be like a lot more risky and I'm bullish, I'm like really, really bullish. what I can do is I can actually roll this position higher. So I can go from the 127 strike up to 130. And now you can see like this is like a load of money. This is like absolutely printing money here. I can move from 127 up, okay, on a sell put. Typically you would want to roll down to reduce risk, but you can also roll up. So I'm going to roll from 127 up to 130. And you can see here how this is a total credit of $12,920 in a month. Okay, so I'm adding a month. Mind you, this is still an out of the money option. This just proves how lucrative options are, especially on higher implied volatility stocks like Nvidia. So the return here is absolutely wild. So that's what rolling up would look like, but you can also roll down. So let's say that you have the opposite view and that you're a bit concerned and you don't want to get assigned. You can just roll the option down. So I can roll from 127 down to 120. And because the option premium here is more on 120 because of the volatility, this would still be a very, very good trade. Like this is still a fantastic trade. So you see, this is how you manage and adjust options. You can manage them in a way that suits your needs. And again, you need to understand what your needs are. You need to have a financial plan. You need to understand what are your goals and how much risk you're willing to take on those goals. That happens through experience. That can be through coaching with me. But yeah, it's mainly a combination of those things: time, experience, mentorship, coaching. Rolling is individual based, and it's okay to roll to 122. It would be okay to roll to 125. You want to just understand what the trade-offs are. So yeah, if you're finding value in this course, you can check out the first link in the description. I'd be more than happy to give you more information and tell you more about my Discord community and how coaching can benefit you. But there's a lot of examples. I hope that these were helpful. I want to move over into the next section of this course. Actually, let me go over an example right now because I have a feeling that you will appreciate me going over more real examples, and I'll try to mix up theory and real life examples. So Apple is doing actually really well, by the way. And as I'm recording this, a lot of the stock market is down and Tesla has fallen down and many stocks have fallen down. But you can see here, I'm up 6.5% or $263,000 over the past month. And I'm actually trading safely for consistent income. So it's not that I'm taking on huge risk. I'm not. And I'm outperforming the market by a lot. So if you're interested in one-on-one coaching, I'd love to help you. We're absolutely crushing it. So let me just go through some examples right now, but I'm going to look for an option where it's losing and show you how I can roll this option higher. So obviously all these options are at a gain. You can see these are all at a gain. Now these options are at a loss. Yeah, here, actually Palantir would be great. Palantir is a great example. So I actually made a slight mistake with Palantir. So Palantir, I have like 2,800 shares. I'm up $259,000 and it makes up 8% of my portfolio with an average cost of $22.68. Now, I have a lot of Palantir shares, but I don't have a lot of covered calls. You'll see here and you'll notice from my positions that I have 105 call, 100 call. The rest are like puts, right? And it looks like I have some call credit spreads as well that I just recently opened up. But I want to focus on a covered call roll, okay? Because this is very similar to what I was talking about with an Nvidia just now. So Palantir went above my 105 call option. So right here, you'll see that this call option's in the money, which is not really good for me because I don't want to lose the shares. If I lose the shares, this is only one contract, but still this one contract that I lose, it means that I have realized some gains in the stock because I'm up a lot of money in the stock. So I don't want to sell the stock because I have to pay a lot of taxes. And why would I want to lose money to the government for no reason at all? So this option does have time to expiration. This option expires on February 21st, which is like about a week from when I'm recording this. So I have about 7 days. And here's a lesson to be learned. I'm going to roll this option essentially today when the market opens up. I'm recording this before the market opened. So what I'm going to do is that you can see I'm down $1,000. That's not that much, but I don't want to lose Palantir. It's above 105, so I'm going to go roll this position, okay? And you can see here I can select a new position. So Robinhood lets you do this, but other brokerages you can also like right-click and then click roll option, right? So if I select a new option, I can move it from like February 21st to something like March 21st, right? So I can go out exactly like 30 days. It doesn't have to be exactly 30 days. I can even go to March 28th and go out like 37 days, right? And what I can do is I can roll the option higher since obviously I don't want to lose it. And I do want more upside. So part of the reason and what I said about like managing your position, you can make more money. The way you can make more money is by moving up your strike price. So on a covered call, if you move up in your strike price, you have more intrinsic value, right? So to gain more intrinsic value, I don't even have to move up a lot. I can just move from like 105 to say 108. You can actually see here how this is a really good trade because what's happening is I'm going from 105 to 108. So I'm increasing by $3 in terms of like my strike price. That means I make essentially $300 more for this option. So I gain 300, but also the 108 call option here, it's worth more than the 105 call option. There's more time. There's, that time, it has to be compensated. So basically, due to time, that time is so good, it not only lets me move up by $3 from 105 to 108, it also gives me a total credit of $2.53 or a total credit of $253. So as you can see here, this is a trade that I'm absolutely going to place. Now, I want to give you a slight variation here because I can go up to 108, but let's give you another example. Let's go back to roll and then click this and let's go back to March 28th. Let's say, for example, that you want more money and you're bullish on Palantir. So let's say 108 is not enough. Well, you can go for something like 112, okay? So 112 here, and I'm just picking a random strike price and I'm showing you the trade-off, right? So there's no perfect strike price. You can go for 108, you can go for 109. As long as you're rolling up and out, that's good because you're rolling up, which gives you more money and intrinsic value, and out, which puts more time on the option, which time is money. So as long as you're going up and out, that's good. So I showed you like 108. Now the 112 is equally as good. However, it's not a credit. You can see it's a $22 debit. However, you're getting a $700 step up in terms of the strike price or in terms of the amount of money that you're going to make in intrinsic value. So in the other example, you got $300 in intrinsic value plus $253 in terms of time, which is like a total of $523. Here, we get a total of $700 in intrinsic value, but we actually have to pay $22 in terms of cost and in terms of rolling. So this is a debit roll higher, right? So the first one was a credit roll. This one is a debit roll. Well, you tell me, is $22 worth making $700? I would say absolutely yes. So the discrepancy here is that one option, okay, there's a difference. Obviously, like nearly $700 is better than $523. But why would you get $700 and why is it $523? Well, that's because like the first option roll I showed you, the 108, it's deeper in the money, so it's safer. If Palantir pulls down, the option doesn't really get affected until like 108, right? This option gets affected sooner at 112. So this option is technically riskier because if Palantir pulls lower, you will lose money sooner. That's why the return is greater because you're gonna make more money, but you have a higher risk of the stock pulling down. So I just clicked into the Greeks here. So you can see the Greeks here as well. You can see the chance of profit here. The implied volatility is high. And you can see the delta is 0.62. The bid ask right now is really wide, but the market hasn't opened, so the bid ask might change. So this is a trade-off, and this is how you manage positions. And yeah, again, the reason why I do one-on-one coaching is because the situation can really vary. Like, for one person, they might decide like, hey, I'm more aggressive, so I'm happy to go higher to the 112 call option, like in this example right here. Whereas like me personally, I would go for the 108 covered call because I'm always looking for more consistent slow growth and I'm scaling a bigger portfolio, and you don't have to have as big of a portfolio as me to have the same mindset. I have many students that have 300K, 400K, and they're essentially like, hey, I want more passive income. I want a more slow approach, a more safe approach, because to them, $300,000 is the equivalent of like millions for someone else. Maybe they're already approaching retirement. Maybe they have less time. Maybe they're living abroad and 300K is a lot. So I would, again, challenge you to think that every single dollar really does matter. Like every 10K, every 100K, that's a lot of money. It's not the dollar figure per se. It's more so like the percentage of your portfolio at risk, right? So it's always about understanding like your overall risk level, how much of your portfolio percentage wise is in a single trade, and then what's your trade-offs. So here the trade-off is, hey, Palantir goes down to 112, I'm gonna start losing dollars here. Whereas in the first example, if Palantir goes down to 108, then I start losing dollars at 108. So I hope that example was helpful, and we have many more examples to go over for you to understand how to trade better and manage your positions. Portfolio diversification is something that everyone has to know, but not enough traders actually understand how to do it correctly, especially when it comes to option trading. Most people assume that diversification just means owning a bunch of different stocks so that if one crashes, the rest of their portfolio doesn't go down with it. And yeah, that is part of it when you're trading options, but diversification is a lot more complex and different than just owning many stocks. If you do it the right way, you can actually reduce the risk and improve consistency. This is not just by diversifying into many stocks, it's also by diversifying your strategy and the time to expiration that your options expire. Let's get one thing straight. True diversification isn't just about owning different stocks. A lot of people think, well, I own Apple, Tesla, Nvidia, Amazon, and I'm diversified. But what they don't realize is that all four of those stocks tend to move the same. In fact, a lot of people that work in tech, like let's say you have a person that works in tech at Nvidia, he holds Nvidia stock. That's a double risk. That's not diversified at all. Or even like a tech worker has 100% portfolio in 50 different tech stocks. It's not diversified. What they don't realize is that stocks move very similar to each other, especially in the same sector. If tech stocks are getting hit, then all tech stocks are probably going to drop. If you really want to diversify your portfolio with options, you need to think about diversification in 3 different ways. Diversification across sectors, so trading stocks that don't move altogether. Diversification across strategies, so using multiple different types of option strategies. That's a covered call, a leap option, sell put, or a spread. And diversification across time frames, spreading out expiration dates so all trades aren't expiring on the same date. So for me, some options expire in a week, some in a month, some in 2 months, and some in 3 months. If you have everything expiring, say May 25th, and then that month is not such a good month, and all your options expire in the same month, well, you can see the problem with that. Let's start off with sector diversification, because this is the first mistake that most traders make. When you're selling options or trading spreads, you don't own all of your positions in one single industry. For example, let's say that you're running a covered call strategy and your portfolio is full of only tech stocks like Apple, Nvidia, Microsoft, and Tesla. Well, this is a really good opportunity to also invest in consumer staples. Maybe that's Kraft Heinz, maybe that's Procter & Gamble, or maybe you want to invest in airlines. So in the industrials, right? So American Airlines, United Airlines, and maybe it's investing in energy, ExxonMobil, Chevron, right? Investing in different stocks across different industries is what real diversification is, because then you don't have exposure into just one sector. I mean, one sector can have a lot of disruption as well. Disruption doesn't just happen on the individual company basis, but in a single year, a whole entire sector can get taken down. So having diversification across things like even healthcare, Johnson & Johnson, and consumer staples like Costco, Walmart, restaurant stocks, Chipotle, Starbucks. All of these additions to your portfolio will reduce your volatility. This way, if one sector takes a hit, your whole portfolio isn't sinking with it. Some positions might struggle, but others will hold up just fine. Now, the second layer of diversification is strategy diversification. So way too many option traders, they go for just selling puts or covered calls. And I'll tell you right now, those strategies are fantastic. And I have many people that just focus on the simplicity. But again, in this section, I want to talk about diversification and portfolio management. And if you truly want to manage bigger money as you scale, then it's really important to have multiple different strategies and, of course, different expiration dates. In fact, I would say having different expiration dates are even more important than having multiple strategies. The top of the layer of diversification is having different stocks. Then is different time frames. And then the third one would be different strategies. Because yes, you can just use sell puts, covered calls in the wheel, and you can just run with that. But you can't just do that on Nvidia. You can't just do that on Palantir. You can't just do that on Tesla. Those stocks will crash at some point. They have corrections, and there's a lot of volatility to that. So the ideal situation is that you have a smart allocation to at least 10 stocks in your portfolio. And the smartest traders have multiple strategies such as covered calls, cash secured puts. They even have debit spreads. They play earnings by buying leap options ahead of earnings. They buy call options ahead of earnings. And all of this is really important for you to understand how to lower the risk of your portfolio having a big drawdown. In fact, right now, as I'm recording this video in February, in mid-February, I had a coaching session where some students have, had a tough time because we're invested in Tesla. However, my portfolio is at an all-time high. So despite Tesla falling a significant amount from like higher 400s to lower 300s, my portfolio has had literally no impact at all. The portfolio has actually gone up. And that's because I have hedging strategies, I have multiple industries, I have leap options that are performing very well. And one single stock, even if it's a fairly big size position, your portfolio can still have a fantastic return because you're invested in the right places and one single stock won't really affect you. Instead of focusing on how many positions you have, you should focus on the relationship between each of these positions. If you have 5 bullish trades, consider adding a bearish trade, such as a credit spread or a hedge against the market. So let's say you have 5 covered calls. Well, it's also okay to have a couple of call credit spreads. Those call credit spreads function as income in your portfolio, and if the stocks rise, and then basically your covered calls will make money, but your call credit spreads will lose money, or vice versa. Let's say the stock goes, stock market or the stocks you hold goes sideways, your covered calls benefit and your call credit spreads benefit. The stock market goes down. Well, you will lose some money on the covered call. Granted, you'll lose less money than a stock investor, but with the call credit spreads, you're going to make money. So again, having different positions, both bullish and bearish, is the true way to really generate alpha. Alpha is how much more money you make than the whole entire stock market, right? So let's say that the stock market had a return of 16%, but you had a 26%. That means you generated a 10% alpha in that period of time. You really need to find balance though, because position sizing is really important. But if you don't have big enough of a position, you also don't want to be in the situation where you have like 30 stocks. In fact, having 30 stocks in your portfolio is a lot of work. It turns into, really small positions that basically look like the S&P 500. So that also doesn't make any sense. The rule of thumb that I use is having 5 to 15% of my money in each and every single stock. So let's say, for example, that you have a $100,000 portfolio. Well, every single trade that you make should be between $5,000 to $15,000. However, if it's a bullish strategy where you're buying options, like a call option, you might want to go like 1/2 or even 1/3 of that. So if I'm buying call options, I'm only using 1 or 2% of my portfolio for a single position. That's because, of course, buying options has huge rewards, but it also has higher levels of risk. And true diversification is having multiple different positions in different sectors across different time frames, but it's also about having proper position sizing, because proper position sizing is what protects you, and you need to find that balance. So when it comes to buying strategies, 1 to 3% of your portfolio is fine. When it comes to generating income, like selling puts and covered calls, you can literally have like 10% of your money in every single position. And of course, this is a beginner's course, so I'm just telling you rules of thumb. It is going to come down to an individual basis. When I was scaling my portfolio, I had 70% of my money in Tesla. Right now, I have a lot of my money in Apple and Walmart, and those positions, although they're not the sexiest names that, they're not like the best performing videos on YouTube where everyone talks about the stock that's going to make you the next millionaire, where you put $50 into that stock and become a millionaire. That's like not what I'm trying to do. I'm trying to have consistent income, and just even going for boring trades sometimes, I make a lot of money. I make as much money or more from even the boring trades I make that have lower volatility than the really high volatility trades that I make. In fact, Warren Buffett talked about it. He said, it seems like there's an anomaly. Again, recall, an anomaly is basically like a weird situation, something that shouldn't be really like occurring, but is. And that was basically that lower volatility companies for Warren Buffett, like American Express, Coca-Cola, Bank of America. Some of these stocks that he's been holding on to for like decades have outperformed some of the best tech companies, because over long periods of time, slow, consistent compounding results outperform, fast-paced results that are, more short-term in nature. But of course, those stocks typically fall down and they revert back to their mean. Reverting back to their mean just kind of means like, imagine a person reverting back to their true colors, if it, we were talking about people. And it's that, stocks, they don't really rise too much in short periods of time without coming back to reality. So oftentimes there's an overreaction in the market. So when a stock is up like a ridiculous amount, you want to pay attention to the RSI. If the RSI is like 80, the Bollinger Band's like at a high, it's also like at the top. Well, in this case, that stock is probably going to come down, right? So you want to also understand that in terms of diversification, because you want to use diversification not just in time, not just in strike selection, not just in the stocks that you pick, but also in your technical analysis. Because in some periods of time, you can look at a stock that's at the bottom of its Bollinger Band, but maybe that's 2008, maybe that's another crash, and we truly don't know, which is why it's important to really diversify even across your technical analysis. So sometimes for me, like half my portfolio, when I look at the bottom of the Bollinger Band, I'm selling puts. But in other times, when I look at the bottom of the Bollinger Band, I'm buying call options. So you see, like being at the bottom of the Bollinger Band just means that the stock is likely cheap, but I'm also willing to do a lower risk play of selling a put, and I'm also equally as willing to buy a call option. But I'm just doing that in different proportions. I'm selling puts in high quantities because that's a really safe strategy. And the worst thing that can happen with the put is I get a sign, then I wait. Whereas the call option, if it doesn't shoot back up, I'm going to lose the money that I put on that call option. The smart approach is to base position sizing on probability of profit and risk to reward ratio of the trade. If a trade has a high probability of success, but a lower payout, you might size that pretty, medium trade. But if it has a low probability of success and a really high reward, then you probably don't even want to go a medium amount on that trade because again, it has a low probability. So you want to put in a little bit less into low probability trades and a bit more into high probability trades. It's very similar to dollar cost averaging. You see, what dollar cost averaging is, it's like the fifth wonder of the world or the seventh wonder of the world, however many wonders there are. Dollar cost averaging is the most powerful strategy because let's say that you get paid like $5,000 at work or $10,000 or whatever, right? And then per month, you're able to save $2,000. Well, if every single month you have a fixed income amount that you can put into the market, $2,000, then in the stock market or whatever stock you're buying, in bad months, that $2,000 will buy more of that stock because that stock is cheaper. And in good months, that $2,000 is going to buy less of that stock because that stock is more expensive. So dollar cost averaging is also really good because you don't even have to be a genius. You could just put the same amount of money into the stock market every single month, and then you get a compounding effect. And compounding is also like one of those wonders of the world where you guys don't even realize it, but compounding will actually take you from 5 figures to 6 figures, 6 figures to 7 figures. And it's all from the factor and passage of time. Time is the most important thing that we have here as humans on this earth. And time is the most valuable equation within finance. New York City was bought for $4. Now it's worth trillions of dollars. And the only thing that has changed is time. Obviously there's things built, but what has allowed that building and that advancement, it's time, right? Innovation and other things like that. But the main component is time. The reality is that option trading is a skill that takes time, discipline, and patience to really master. The best traders don't chase every single opportunity. They wait for the right setup, they manage risk carefully, and they think in terms of probabilities, not guarantees. This is like chess, this is like poker, this is math, this is physics, this is also art. This is also psychology. There's so many components to being a good option trader, and it's really dynamic. So of course, I'm teaching you all the beginner stuff here, but it really is a practice, just like doctors practice, dentists practice, right? Athletes, they practice. So repetition and practice is super important. And of course, supervised practice and having a mentor and a coach can also be extremely helpful because then you learn faster. And at the end of the day, time is one of the most important factors. So if you can figure this stuff out faster, you can get faster results and just go faster into compounding. And compounding is super important because when I had $2,000, it was incredibly hard for me to go from $2,000 to $10,000. And it was really difficult to go from $10,000 to $50,000. But once I hit $100,000, it was pretty easy actually to scale from there. The fact is that net worth really scales at 100K. That 100K is the hardest to make, okay? Once you have 100K in your account and once you can build 100K in profit, it's really easy to scale from there. It's just more time than taking calculated risk and then going from it took me 5 years to go from 2K to 100K. It took 5 years. I added money. I had summer internships. This was a long time ago, right? I was a teen when I started investing. But then after I hit 100K, I quickly went from 100 to 700 in the same year. And next year I went from 700 to 1.5 million, right? So it's really fast. And then I went from 1.5 to I think it was 2.2, 2.3. And then I had a double actually in 2024. I show my portfolio. It's $4.2 million at the end of 2024. And at this point, it's almost too easy to grow. And it's kind of a paradox because at first it's really hard and then later it's really easy. And I want you to understand that it's totally normal. For me, it was incredibly hard. I had super doubts that I would ever make it trading. I'm just speaking with confidence now because I have so much time under my belt and so much experience, but I had so much uncertainty, so much fear in the market. And yeah, it was really difficult to manage positions. I took losses in a very hard way because it was really hard to come to money for me. Like my parents were super broke. So diversification, position management, this is all stuff I had to learn the hard way. And I hope that you're taking a lot of lessons, you're taking notes, and you're learning here, because I spent a lot of time. Like I could have become a millionaire even faster, which is pretty wild because I did so, at a young age in my mid-20s, but I could have hit it sooner, could have done it better. But hindsight's 2020, like I can't be hard on myself, and you also can't be hard on yourself. Like if you're in the beginning of your journey, that's fine. You just need to get experience, have the mindset, study this course. I've covered everything, and I spent weeks on this course to give you everything step by step. And this free course is better than everyone's paid products, I promise you. Also, I want to show you a really interesting chart right now. This chart right here, it basically shows you that for every single stock that you buy, it helps reduce your volatility in your portfolio. But as you can see, there's diminishing returns. Diminishing returns means that for every single new stock that you buy, your volatility, your variance in your overall portfolio does decrease, but it's decreasing at diminishing amounts. Think about it in terms of utility. This is a basic economic principle which states that utility is a measure of benefit or reward that we get for a certain amount of risk or for a certain amount of consumption. So for example, I'll tell you, like if you're super hungry and you have one burger, you're going to be like, what economists say, like 100 times happy, right? 100 units of happiness. But that second burger, you'll be 70 units happier. That third burger, you're full. So you're gonna get 30 units of happiness, maybe. The fourth burger, like maybe have very little benefit at all, right? Because you're full right now. The same thing is for diversification. Like above 12 stocks, you get some benefit, but it's really diminishing. And at 15 stocks, I would just say doesn't really matter. Like 20 stocks is maximum diversification. 15 stocks is also like pretty much perfect diversification. And again, for me, I like to have a basket of stocks that I follow very closely, that I understand very well. Because if I understand them really well, then I can make better and more informed decisions. And at the end of the day, the stock market is about having your opinion and your expectation be more correct than someone else's opinion and expectation. So that's what the stock market's about. It's a bunch of expectations in the market in the short term, and then in the long term, it's the actual results of the company. How much money do they actually generate? And that's actually going to completely rely on how much the stock is worth. In the short term, you're just playing psychology. You're seeing what other people are investing in that company, and it's all based on supply and demand in the short term. But that can be incredibly misleading because the stock market is full of emotional people, men, women, people that have bad days, people that have good days, people that are enthusiastic, people that are on drugs, algorithms that are trying to exploit human behavior. And a lot of the volume on Wall Street is actually algorithmic trading. So it's not even humans that you're trading with. And these algorithms can also be incorrect. In terms of like, big red days in the market, these algorithms tend to overreact and sell a lot more than they should. And in good times as well, like investors get enthusiastic, and around like, they call it a Santa Claus rally. People are happy. It's holiday time, so people put in more money in the market. So there are anomalies to the market, and it's really important for you to manage your risk properly and then just understand how the math works out for every single position that you own. Having probability on your side, having an edge on your side, which is all of the stuff that I teach. That's everything that I do in my live coaching as well. I'm always looking for how can I gain an edge, and how can I have my entire community basically make smart decisions. Successful traders who manage risk properly and succeed focus on executing the strategy consistently, and they know that some trades will win and some will lose. It's all about having the wins be really big and the losses are, as small as possible. That way the difference in wins and losses is going to be, enough money for you to retire on and create consistent income with. So if you really want to get good at option trading, focus on practice, focus on having a mentor and a coach, focus on making mistakes and learning from your mistakes, technical analysis, fundamental analysis, the Greeks, and a lot of the other stuff that I taught in this course. I have full belief that you're going to be an intermediate trader at this point. Now, I have some most common questions that are asked on this channel. So let's get into the Q&A section as we wrap up this course. Oh, I can't believe it. Spent 2 weeks making this course, and now I'm super excited to just get into the Q&A section. So the first question is how to roll options in situations where you like to earn premiums and ideally not have your shares called away. That's by focusing on the Bollinger Band. So if a stock is in the middle of its Bollinger Band and you don't want to get the shares called away, you would go for the top of the Bollinger Band. That's from a technical perspective. From a fundamental perspective, you obviously want to try to form an opinion yourself. Let's say that Nvidia is at 135, and after doing some research or by following my research, you figure out that the stock is, $165. So you really have to pick a strike when you're selling the call option to begin with. The whole preparation is the most important part of the trade. So you have to properly enter into the trade, and then you have a higher chance of success. If the stock goes into the money, to manage that position, it's always best to roll that position by using my dog strategy or by simply sticking to some simple rules on rolling, like moving up by $5 or $10 and moving out that expiration out into the future. The difference between sell to open and sell to close, a sell to open is basically when you're opening a position, and selling to close is basically when you're closing a position. All right, the next question I have is from the username anarchoflow. Any information about possibility of getting assigned on spreads would be great. Okay, so spread assignment is a risk, and we went over that in our spread management portion of this video. Actually, I should finish the question. You're killing it in the amount of content you're putting out lately, Henry. Thank you so much. See you on Monday call tonight. So the way to manage a spread, if it goes into the money, is almost always closing that position. So if it goes against you, spreads are very sensitive to price movements. So as soon as it goes into the money, oftentimes both options will still have a lot of value. Therefore, by closing out the trade, most of the time you won't really lose that much money. So that has been, in my experience, the best. You can also close out the spread if it goes 50% down. So say you sold a spread for $100 in credit, and if it goes down and it's worth $200, you can close it out for $200, which would be a loss of $100. That would be much better than the loss of $500, of course. Next question is from Pablo Moren 8170. What would be the best specific path to follow for someone who wants to start with a low amount like 2 or 3K? For example, month 1 to 3, master credit spreads, month 3 to 6, focus on this. So it would be to definitely focus on spreads, so credit spreads and debit spreads. Debit spreads would be like the most beneficial, since a debit spread can, 2 to 3x your money, as we saw in that portion of the course. So, it is hard to trade a small portfolio. I'll be honest with you, I only work with folks that have at least 25K in their portfolio to work with, because scaling a smaller portfolio is harder and riskier than a bigger portfolio. So it's a little bit tough, but definitely going to be spreads. Next question is from South Fist. Can you cover stop losses for options? I don't use stop losses because options are already volatile instruments, and oftentimes a stop loss will do more damage than good, because an intraday move can be very high and you might get stopped out of a position. So I've never used a stop loss in my entire life, and I don't recommend it. Next question is from William Wise. What would you do when you sold a covered call that was initially out of the money and becomes deep in the money? I understand that you want to roll it, but when? And then how close to the expiration date or expiration date? How far up and out do you try? Great question. So ideally it doesn't become deep in the money. If it became deep in the money, that means you probably didn't really manage the position properly, or maybe the stock had earnings or something really big like that. In the case that it goes deep in the money though, that's usually a good situation since you've made profit. The only bad situation and the problem is you might not want to lose a stock for that price. So yes, you're right, and you already said roll, but when? Basically, it is case by case, but in the example of a regular stock, just a regular pretty big week, and it goes up 5 or 10%, and it's 5 to 10% in the money, right above your strike price, then you roll it up 5 to 10% up. I don't chase super hard. So if it's up 10% above my strike price, I'm not going to go for 20%. I'm going to move slowly with the stock. It is very much an art form to roll properly. You want to know how much to roll properly, and that's based on a lot of factors. So that's like the short answer to, you don't want to chase, but you definitely want to roll as soon as it hits the money. But if it's in the money by 5 or 10%, then you kind of go step in with it. It's kind of like salsa. You like salsa or like whatever dancing, you kind of go step by step with your partner. It's kind of like that. All right, here's another question from KC Bay Ander. Thanks a lot for your videos. You often speak about deep in the money leap calls. I would like to know, when is the last moment one should close out a position due to erosion of time value of the option? For example, I currently own a long call which is expiring May 2025 and I'm losing money on it. I would like to wait as long as possible before closing for the option to become profitable, but I know that waiting too long can make the option lose a lot of value. So basically, I'm asking, when is the moment of closing out a long call option? That's a really good question. and it can be very challenging. So going from a technical perspective, on the technical chart, if the stock has broken down and it's near the Bollinger Band bottom and it has a low RSI, you don't need to do anything because it's likely to come back up. However, if the stock is just generally having bad performance, but the technicals are still showing that the stock is somewhere in the middle of its Bollinger Band and the stock is just losing slow momentum, that is a harder position to be in because nothing has fundamentally changed about that position, but it has a breakdown and it could continue to break down and it's not as clear to have a bounce back. In that case, you would probably want to close out the option sooner than later. But yes, it's very difficult to say exact specifics, and I would obviously want to look at the exact position that you have. If you made it to this part, I seriously want to congratulate you because you're very few percentage of people in the entire world that has the attention span, the grit, and the ability to actually make it this far. So first of all, congratulations on that. That's rare. And that's already a huge sign that you're going to be very successful. As you know, it took a lot of time to make this free course, and I hope that you enjoy this free course. But I also want to let you know that if you're hungry to make more money, if you're hungry to get your option trading to the next level faster, and you don't want to go through a lot of trial and error yourself, I'd be more than happy to give you my trades, to have some one-on-one coaching with you directly, to have you part of my private community. And in this community, I do my live trading, I give trades, I answer questions, and it's where people share ideas. Option traders can make money. And this might be a fantastic opportunity for you. And if you want to apply for that and see if we're a good fit for you, it's a two-way interview to understand, is this program something I want? Is this something I need? Or is, maybe it's not a fit. Either way, I'd like you to click the first link in the description, submit your application, and learn more about the program that I have, the pricing of the program, and to see if, working together is something that we can do together and to build up your wealth. So here's to your success, and congrats again for making it to the end of the course. I'm super happy and I'm blessed that you made it this far. So thanks a lot, and can't even believe it. It's like put in so much work here, so I'm super thankful for you. Thank you so much. That's really all I have for you.